In this section, we're going to be looking at technical indicators. So technical indicators are the biggest part of technical analysis. And the definition for technical indicators, taken from Wikipedia here, is technical indicators are a fundamental part of technical analysis and are typically plotted as a chart pattern to try to predict the market trend. Indicators generally overlay on price charts, price chart data to indicate where the price is going or whether the price is in an overbought condition or an oversold condition. So what this means is, so if I pull up a chart here of, I'm looking at Euro USD. If I want to look at a technical indicator is going to be something that's going to be plotted, overlaid on this chart. And this technical indicator, which there's different indicators, the way it's computed is going to be based on the prices that you see here and or the volume. Nothing else. It doesn't take any news, anything else. The only thing it uses to compute itself is this chart that you see here in front of you. Okay? Now, different indicators are going to use different things to compute themselves and different ranges. So if I'm looking here at Euro USD, I can go on the top here and click on indicators. When I click on indicators, I'm going to see that there's all of these indicators that I can use. So there's average true range, there's oscillator, there's Bollinger Bands, there's RSI, there's moving average, there's VWAPs, there's all of these indicators, okay? And each of them is going to be computed in a different way, but all using the prices here and or the volume. So now we're going to look at different indicators. I'm going to look at the ones that I like the most for the Forex markets. Now, there's a lot of them. And it's not because there's a lot of them that you need to know all of them. A lot of them are useless and they're worthless, honestly. You can create your own indicator. A bunch of these indicators are just indicators that somebody just created, right? So you don't want to use too many of them, okay? And the one thing to remember is that all these indicators, they only serve to highlight something that's already visible. Since these indicators are calculated based on the prices, then you don't really need to put them on. You can just look at the prices and that would tell you what the indicator would tell you. The only reason why we actually use them is it makes it easier for us. It highlights this thing that we might be looking for that without having the indicator on and just looking at the chart, we might not see. So it just serves as a highlight. Now, you don't want to use too many indicators. You want to find a few that you like and that work well for your type of trading and use those. And the reason for that is when you use too many things, you lose predictive value. You know, if you do any type of mathematics, you know that when you have a formula and there's several unknowns, like let's say y equals ax plus bz plus whatever variables, right? And you have many unknowns. If you try to add too many unknowns, you're going to lose predictive value. And they found in mathematics that if you use over more variables, more than 5 variables, you start predicting less efficiently than if you had less variables. For example, if I'm telling you, how can you predict if it's raining outside based on, you know, what your girlfriend, boyfriend is wearing? Well, you can type kind of predict, right? Because if she's wearing something like a raincoat, then it's probably raining. If she's raining a skirt, then it's probably sunny. So, okay, that's good. Well, how could you predict the weather outside based on what she's eating? Well, I'm not too sure. How could you predict the weather outside based on her mood? Okay. How could you predict the weather outside based on the TV shows she's watching? How could you predict? If you start adding too many variables to try to predict this thing, you're not going to predict as well if you just took a few variables that have more value and just use these. And it's, I don't know if my example was good to get to what I want to say or the meaning, but a mistake that, you know, new traders do is they try to use as many indicators as possible. And I look at their chart and they have so many indicators. They're just going to go in and they're going to just add everything. They're going to add everything and they're going to look at everything. And they're going to be like, oh, well, this says this and this says this. If I have 20 indicators and 15 of my 20 indicators tell me that, then it should go up. Not necessarily. No, because some of them are going to be conflicting. You're not looking at the same thing. So it's a mistake that all new traders do. Okay. And I'm here to tell you, don't do that. Take a few indicators and we're going to look at a few and you're going to see me use them and stick with those and you're going to have way better results than just throwing all the indicators out there. So without any further ado, let's jump into the first indicator, and I'll see you guys in the next lecture. In this section, we're going to be looking at technical indicators. So technical indicators are the biggest part of technical analysis. And the definition for technical indicators, taken from Wikipedia here, is technical indicators are a fundamental part of technical analysis and are typically plotted as a chart pattern to try to predict the market trend. Indicators generally overlay on price chart data to indicate where the price is going or whether the price is in an overbought condition or an oversold condition. So what this means is, so if I pull up a chart here of, I'm looking at Euro USD. If I want to look at a technical indicator is going to be something that's going to be plotted, overlaid on this chart. And this technical indicator, which there's different indicators, the way it's computed is going to be based on the prices that you see here and or the volume. Nothing else. It doesn't take any news, anything else. The only thing it uses to compute itself is this chart that you see here in front of you. Okay? Now, different indicators are going to use different things to compute themselves and different ranges. So if I'm looking here at Euro USD, I can go on the top here and click on indicators. When I click on indicators, I'm going to see that there's all of these indicators that I can use. So there's average true range, there's oscillator, there's Bollinger Bands, there's RSI, there's moving average, there's VWAPs, there's all of these indicators, okay? And each of them is going to be computed in a different way, but all using the prices here and or the volume. So now we're going to look at different indicators. I'm going to look at the ones that I like the most for the Forex markets. Now, there's a lot of them. And it's not because there's a lot of them that you need to know all of them. A lot of them are useless and they're worthless, honestly. You can create your own indicator. A bunch of these indicators are just indicators that somebody just created, right? So you don't want to use too many of them, okay? And the one thing to remember is that all these indicators, they only serve to highlight something that's already visible. Since these indicators are calculated based on the prices, then you don't really need to put them on. You can just look at the prices and that will tell you what the indicator would tell you. The only reason why we actually use them is it makes it easier for us. It highlights this thing that we might be looking for that without having the indicator on and just looking at the chart, we might not see. So it just serves as a highlight. Now, you don't want to use too many indicators. You want to find a few that you like and that work well for your type of trading and use those. And the reason for that is when you use too many things, you lose predictive value. You know, if you do any type of mathematics, you know that when you have a formula and there's several unknowns, like let's say y equals ax plus bz plus whatever variables, right? And you have many unknowns. If you try to add too many unknowns, you're going to lose predictive value. And they found in mathematics that if you use over more variables, more than 5 variables, you start predicting less efficiently than if you had less variables. For example, if I'm telling you, how can you predict if it's raining outside based on, you know, what your girlfriend, boyfriend is wearing? Well, you can type kind of predict, right? Because if she's wearing something like a raincoat, then it's probably raining. If she's wearing a skirt, then it's probably sunny. So, okay, that's good. Well, how could you predict the weather outside based on what she's eating? Well, I'm not too sure. How could you predict the weather outside based on her mood? Okay. How could you predict the weather outside based on the TV shows she's watching? How could you predict? If you start adding too many variables to try to predict this thing, you're not going to predict as well if you just took a few variables that have more value and just use these. And it's, I don't know if my example was good to get to what I want to say or the meaning, but a mistake that, you know, new traders do is they try to use as many indicators as possible. And I look at their chart and they have so many indicators. They're just going to go in and they're going to just add everything. They're going to add everything and they're going to look at everything. And they're going to be like, oh, well, this says this and this says this. If I have 20 indicators and 15 of my 20 indicators tell me that, then it should go up. Not necessarily. No, because some of them are going to be conflicting. You're not looking at the same thing. So it's a mistake that all new traders do. Okay. And I'm here to tell you, don't do that. Take a few indicators and we're going to look at a few and you're going to see me use them. and stick with those, and you're going to have way better results than just throwing all the indicators out there. So without any further ado, let's jump into the first indicator, and I'll see you guys in the next lecture. In this section, we're going to be looking at technical indicators. So technical indicators are the biggest part of technical analysis. And the definition for technical indicators, taken from Wikipedia here, is technical indicators are a fundamental part of technical analysis and are typically plotted as a chart pattern to try to predict the market trend. Indicators generally overlay on price charts, price chart data to indicate where the price is going or whether the price is in an overbought condition or an oversold condition. So what this means is, so if I pull up a chart here of, I'm looking at Euro USD. If I want to look at a technical indicator is going to be something that's going to be plotted, overlaid on this chart. And this technical indicator, which there's different indicators, the way it's computed is going to be based on the prices that you see here and or the volume. Nothing else. It doesn't take any news, anything else. The only thing it uses to compute itself is this chart that you see here in front of you. Okay? Now, different indicators are going to use different things to compute themselves and different ranges. So if I'm looking here at Euro USD, I can go on the top here and click on indicators. When I click on indicators, I'm going to see that there's all of these indicators that I can use. So there's average true range, there's oscillator, there's Bollinger Bands, there's RSI, there's moving average, there's VWAPs, there's all of these indicators, okay? And each of them is going to be computed in a different way, but all using the prices here and or the volume. So now we're going to look at different indicators. I'm going to look at the ones that I like the most for the Forex markets. Now, there's a lot of them. And it's not because there's a lot of them that you need to know all of them. A lot of them are useless and they're worthless, honestly. You can create your own indicator. A bunch of these indicators are just indicators that somebody just created, right? So you don't want to use too many of them, okay? And the one thing to remember is that all these indicators, they only serve to highlight something that's already visible. Since these indicators are calculated based on the prices, then you don't really need to put them on. You can just look at the prices and that would tell you what the indicator would tell you. The only reason why we actually use them is it makes it easier for us. It highlights this thing that we might be looking for that without having the indicator on and just looking at the chart, we might not see. So it just serves as a highlight. Now, you don't want to use too many indicators. You want to find a few that you like and that work well for your type of trading and use those. And the reason for that is when you use too many things, you lose predictive value. You know, if you do any type of mathematics, you know that when you have a formula and there's several unknowns, like let's say y equals ax plus bz plus whatever variables, right? And you have many unknowns. If you try to add too many unknowns, you're going to lose predictive value. And they found in mathematics that if you use over more variables, more than 5 variables, you start predicting less efficiently than if you had less variables. For example, if I'm telling you, how can you predict if it's raining outside based on, what your girlfriend, boyfriend is wearing? Well, you can type kind of predict, right? Because if she's wearing something like a raincoat, then it's probably raining. If she's raining a skirt, then it's probably sunny. So, okay, that's good. Well, how could you predict the weather outside based on what she's eating? Well, I'm not too sure. How could you predict the weather outside based on her mood? Okay. How could you predict the weather outside based on the TV shows she's watching? How could you predict? If you start adding too many variables to try to predict this thing, you're not going to predict as well if you just took a few variables that have more value and just use these. And I don't know if my example was good to get to what I want to say or the meaning, but a mistake that, new traders do is they try to use as many indicators as possible. And I look at their chart and they have so many indicators. They're just going to go in and they're going to just add everything. They're going to add everything and they're going to look at everything. And they're going to be like, oh, well, this says this and this says this. If I have 20 indicators and 15 of my 20 indicators tell me that, then it should go up. Not necessarily. No, because some of them are going to be conflicting. You're not looking at the same thing. So it's a mistake that all new traders do. Okay. And I'm here to tell you, don't do that. Take a few indicators And we're going to look at a few and you're going to see me use them, and stick with those, and you're going to have way better result than just throwing all the indicators out there. So without any further ado, let's jump into the first indicator, and I'll see you guys in the next lecture. The first indicator we're going to look at is the simple moving average. What the simple moving average is an indicator which is basically just a line that we draw on top of the chart. And that line is basically computed using X amount of periods, averaged, and plotted on top of the chart. I'll show you exactly how it's done and what it's used for. So I'll grab an Excel sheet. Let's say we want to draw a 4-period moving average. A 4-period moving average. So basically we take 4 periods. Now it could be, by 4 periods, what I mean is candles. And when we talk about candles, we talk about the closing price of that candle. So if I'm taking, let's say, the last 4, if I'm looking at a daily chart, then I'm looking at the last 4 days. So I could have day 1 here, day 2, day 3, and day 4. Let's say on day 1, the closing price on that day was $10, right? The second day was 11. The third was, let's say, 12. And the fourth came back or continued going up to, let's say, 12 or 14. Okay, prices kept going up. Now, on the 5th day, what I'm going to do, this is the prices here. And I'll zoom in a bit here. You have the prices. Here I'm going to have the moving average. The simple moving average, and we'll call this 4 because it's 4 periods. So what I'm going to do here is I want to compute what is the average of these 4 previous days. Well, the average is going to be the first day plus the second day plus the third day plus the fourth day. This is the sum, so I have 47 divided by 4 because there's 4 of them. And this gives me the average of the last 4 days. And the average of the last 4 days is 11.75. Now, on the 5th day, maybe the price drops back to, I don't know, 9. Okay, price suddenly drops. Well, what is going to be the average on the 6th day of the last 4 days? Well, it's going to be this, right? It's going to be 11 plus 12 plus 14 plus 9. So we dropped the 10 because the 10th is 5 days before and I want to use the last 4 days, and I add the 9. So I do the average of those, and now the average is this. Now maybe the price stays at 9 the next day. Well, on the 7th day, what is going to be the average of the last 4 days? Well, it's going to be 11 because I'm using these 4 prices. So I dropped the 11, I added another 9. So it's dropping a bit. So what the simple moving average does is it takes prices and it does an average of the last X periods. And what that does is it removes the noise. So if something is really moving wildly, you don't want to see all this noise. You want to have an average of these days to have a better idea of what's going on, right? So in this case, I would see that, okay, prices are starting to drop, okay? And it's more fluid. And I'll show you on a real chart here in a second. But these moving averages, you can have a 10-day moving average or a 10 period or a 20 period or a 50 period. It's really up to you. So if I grab back my chart here, and let me just remove some of these indicators that I've added in the last lecture. If I look at this chart, I can go here and I can go on indicator, and you can look for it here. You can go to moving average, which is this one. There's a bunch of different averages, and there's exponential moving averages, which I'm not going to cover here because I've always just used simple moving averages. You can get the same thing from the simple one than the exponential one. So I don't really know a lot of people who use the exponential one. And the simple one just works pretty well. So you can Google the exponential one if you want, but for now, stick with the simple moving average. You can just write here MA for moving average, and you can find it. So all you have to do to add an indicator is just click on it. And here we go. We have this moving average now. You see, this line was not there before. And this line, I have a daily chart. The way it's calculated is basically like, let's say this point here, the way it was calculated is by using the last X periods to compute itself. Now, how many periods did they use? I can double click on it. they use the last 9 periods. So when you do a moving average indicator on TradingView, they default it to 9. So you can change it. Okay. So how many periods you want to use, I'll tell you in a second. But here, if let's say I put 4, then you would see that, let's say here, the way they drew this is by using the close of this one, 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 just sort of like we did. Now you'll see that if you have a very short period moving average, this line here is going to follow the prices very closely, right? If I have a longer period moving average, let's say 20, you're going to see that the line is going to lag a bit. The moving average isn't going to be as fast to catch on to the price. You see? Now it's more smooth. So if you want a smoother moving average, you put it longer term. It's going to be less impacted by the noise and by these candles. And it makes sense, right? If I'm using 4 periods and then the price jumps and I'm removing one candle and adding the new price of the other one new price entry over 4 has a lot of weight. So it impacts my moving average a lot. If I was using a 100 period moving average, I'm looking at the 100 periods. Well, if I'm dropping 1 day or 1 period and I'm adding a new one, even if this new one moved by a lot, it's only 1 out of 100 of data points. So it doesn't have a lot of impact on my moving average. So my moving average doesn't move as fast. It's very slow, right? So the longer term you're doing, the longer term moving average you want to look at, because you don't want to get caught up with all these small movements, right? Now, the moving averages that I recommend is the 20 period moving average and the 50 period moving average, and that's for Forex. Now, if you're doing stocks or something else, you want to look at the 200-day moving average, you want to look at other things, but for Forex, which is what this course is about, I really like the 20-day moving average and the 50-day moving average. So this here is the 20-day moving average, and you can see that it shows you something. Well, what does it show you? The moving average, what it shows you is the direction. So it's a trend. So instead of just looking at the prices and being like, okay, it's going down, or you can look at the moving average, and the moving average gives you the average of the last 20 periods, in this case, because it's 20 period moving average, and you can see that the direction is downward. So it's downward sloping. So it gives you an indication of the trend. Now, if you use longer period moving averages, it could also be used as support and resistance. In Forex, I don't use it as much for that. I use it in a different way, which I'll be showing you in another lecture. But you can be using the 50-day and the 20-day moving average, play around with it, and it'll give you an indication of the direction we're going. Now, you could use it as resistance points, support points. You would need to use longer period moving averages. But yeah, you can use the moving averages on either daily charts like this or any type of charts. You can use 1-hour charts. You can use, let's say if I'm going here, I can put 1-hour chart. And you'll have the moving averages as well. You can do 15-minute charts. Whatever time frame you're looking at, it'll use the X amount of candles. So if I'm using a 1-hour chart and I'm using a 20 period moving average, I'll be looking at the last 20 times 1 hour, so last 20 hours to draw it. Okay. So this is going to be the simple moving average. And what we'll do in the next lecture is actually add on top of the moving averages to see how we can use them to find entry and exit points. In this lecture, we're going to be looking at moving average crossovers. So moving average crossovers, what are they? The way it works is you draw 2 different moving averages on top of a chart. For example, let's say I look at this currency here. I'll go on, and it doesn't matter what time frame you're looking at. Again, the time frame depends on how long-term or short-term you want to be trading. If I'm looking at a 4-hour chart here of New Zealand dollar to US, and I add an indicator, moving average, I'll plot it here, and let's add a 20 period moving average. So I'll change this to 20, and you see, oops, yeah, 20. Okay, then I'm going to add another one. I'm going to add another one, and I'm going to have the 20 period, which is the one I'm going to call my short-term moving average, and I'm going to add one that's longer term, okay? That's slower to react to recent price changes. Now, the second one here that I just added, I'm going to change it from 9 to 50. So I'll have a 20 period moving average and a 50 period moving average. And look at this. The 50-period moving average is slower to react than the 20-day moving average, right? Makes sense. 50-day, more data points. Each data point has less value. So a new day, a new move impacts it less than the 20-day moving average. And what this tells me is that if I use moving average as an indicator of the direction we're going, as a trend, well, what if I have one that's shorter in term? So a 20-day one versus a 50-day one. The 20-day moving average is going to tell me about the direction in the short term versus the 50-day moving average, which is going to tell me the direction in a longer term. And what I can do is I can look at these two different moving averages and see if one changes versus the other. For example, if my 50-day moving average is going down and my 20-day moving average is going down faster, what that tells me is the last 20 days were worse than the last 50 days because the 20-day moving average is lower than the 50-day moving average, right? But then if at one point the 20-day moving average goes above the 50-day moving average, so it crosses over the 50-day moving average, what that tells me is in the last 20 days, prices were better than in the last 50 days. So we might be reverting. So we've been going in a direction, but recently we're starting to go in a different direction because the shorter term period moving average crossed the longer term moving average. We'll look at it here. So let's say here, for example, okay, we're starting off and we have the short-term moving average, the 20 period, crosses below the long-term moving average, which tells me in the last 20 days, and if I look at the last 20 days, this, the prices are lower than in the last 50 days, okay? And because the last 20 days has this really big, there's these few bad prices, and these few bad prices really impact the last 20 days more than they impact the last 50 days. So that would tell me that I need to short, okay? So at this point here, I need to short, which the price is, I'll be shorting at this price because here is what the price is. But this is the indicator. And since the shorter term moving average crossed below the longer term moving average, I want to short. I'll be shorting somewhere here, okay? Now, as long as the shorter term moving average is lower than the longer term moving average, I know that, you know, in the short term, prices are going in that direction compared to the long term. So I would stay in that position until we get to here. And I'll be closing my trade here. So I would have made some profit, okay? Now, at this point, we'll zoom in. The shorter term moving average goes above the longer term moving average, which tells me that now prices in the short term, in the last 20 days, are a bit higher than in the longer term, right? Because in this short term here, I have these days that have a bigger impact than on the last 50 days. So here I might have went long. I would have bought. This would have been a bad trade because I would have bought, but then right away, the 20-day moving average would have crossed below again because of this huge red candle, and I would have taken a loss. But that's okay. One good trade, one losing trade, which is smaller. Now, we crossed the shorter term moving average, crossed below the longer term moving average again. That would have been another sell indicator, another short. I would have shorted here. Then prices went down and again recrossed over here. So I would have closed my position at this point, another winning trade. And again here, there's a whipsaw. I would have went long. I would have lost on this trade, but barely. I would have bought here and sold here. Barely a loss. But here I would have shorted again because the shorter term moving average crossed below the longer term moving average. And I would have still had this trade open until today, which is pretty good because it's really deep in the money now, right? So this is how you would use it. It really tells you when there's a change in direction, okay? Because you have two different moving average, one short, one long, and the short really tells you what's going on more recently, the long, what's going on more not so recently. And when the recently moving average crosses below the not so recently moving average, it tells you that there's a shift or we might change. So you can use that to enter and exit positions. And that's where some of the indicators that you hear people talking about, like MACD, moving average conversions, divergence, all of these other indicators, they're just based on that. So all you need to do is just use that. because that's what they do. They take moving averages and they see how much they diverge or they reconverge, and they try and do these things. Well, here you go. You can just look at it like this, and when there's the crossover, you know that there's a shift, right? And you can look at this in different places. Like, let's say on this one, you can see that we crossed over. Well, we crossed over here. So you would have been in a long position and you would have stayed in this long. And you see the shorter term moving average. So the last 20 days here, right? Starting to slow down. Okay. And because these new days that are lower, the last 20 days are about to be less than the last 50 days. So we're about to cross below, and this would be a sell indicator. So we get out of it. We get out of our long position. So we take our profit on it, and we even go short. And, you know, it's whenever you start trading and you learn about moving averages, it's the easiest way to get rolling, you know, and just to practice. Obviously, when you're practicing, you practice with fake money. So it's not a bad idea to just play around with it, because it's such a simple way to trade and to get experience in sending orders, seeing your positions, doing all of these things that you want to learn about. It's a nice way to learn about them, because it's just a simple way of doing things. And you might like trading with moving averages, and this could be your way of trading, or you could trade with something else, but it's a good way to get practice. So, you know, add some moving averages to your charts. See if you can see a crossover where you would want to enter a position or not. Anyways, we're going to be looking at entering positions and all that stuff at the end of the course. But start looking at your charts to see if you can see some crossovers. And that's really what crossovers are. You can play around with the time frames for your moving averages. You can try two shorter ones, two longer term ones. You can try different time frames on your charts. Play around with it. And yeah, that's it for moving average crossovers. The indicator we're going to look at in this lecture is called Bollinger Bands. So Bollinger Bands is one of my favorite indicators to use. I use it in stocks, in Forex, in cryptocurrencies, and it makes a lot of sense to use. And it's very intuitive. And, you know, you wouldn't, even if it didn't exist, I would have used it by looking at the chart, but it just makes it so much simpler. It really highlights what I want to look at. So what is Bollinger Bands? We can go on indicators here, you can write Bollinger Bands, or you can just write BB. It knows it's Bollinger Bands, and it's the basic Bollinger Bands that we're going to be using. And what Bollinger Bands is basically, and I'll go here on this chart, is basically a moving average that's drawn in the middle, and here you can double click on it. It's a moving average that's based on the last 20 periods. Okay, so it's a 20 period moving average, and there's a upper band that's drawn above this moving average and a lower band that's drawn below it. Now, how is it drawn and how is it used? Very simple. Now, the way it's drawn is basically they're using what we call a bell curve. So in mathematics, you have what we call a bell curve. And a bell curve here is used to measure distributions around a variable. And this could be anything. It could be, I don't know, grades in your class. It could be height of men. It could be prices of houses. It could be whatever, okay? You can use the normal distribution to draw these entry points. So example, I could say that the average height of a man is 1.7 meters, okay? And then I could try and see, well, what is the probability that a man is 1.5 meters or 1.4 meters? What is the probability that a man, or how much of the population is above 2 meters, right? And it would be like this part here. Now, what we want to do is use the bell curve, or use this normal distribution, but for prices, okay? The way the bell curve is drawn is it uses what we call a standard deviation. And the way we use it is we take all these data points and we say, okay, well, what if we want 66% of the population, okay, to be within one standard deviation of the mean? Well, then what is a standard deviation? So example, if I say I want to know between which range are going to be 66% of the population between this height. And then I'll figure out what a standard deviation is. And maybe I'll find that, you know, one standard deviation is going to be equal to 10 centimeters. So then I know that there's 66% of the population between 1.8 meters and 1.6 meters, right? Because I know that in a normal distribution, there should be about 66% of the variables within one standard deviation. And you can actually just Google it. I'll Google it real quick. Bell curve standard deviation. So there should be between two standard deviations, 96% of the population, and then between three standard deviations, 99% of the population. So let me find a good one here. Okay, so between one standard deviation, you have 98%, two standard deviation, you have 95%, and three standard deviation, you're going to have 99% of the population. Okay, here you have it here, right? 68, 95, and 99. So what we're doing, without getting into the math and calculating standard deviation, because you can go look at it, but I want to keep this as concise as possible. We're, instead of using it on men heights or anything like that, we're using prices. So we're looking at the last 20 periods. We're looking at the prices. And based on the volatility, the more something is volatile, so let's say if men heights were very volatile, some men were really tall, some were very small, then one standard deviation would be maybe 20 centimeters, right? So to have 66% of the population within that range, it would have taken a bigger range, right? So the more volatile something is, the bigger the standard deviation is. So what we want to do is look at prices. We're looking at the last 20 periods of prices. We're looking at how volatile they are, and we're deciding on what a standard, the math decides on what a standard deviation is. And then what we do is we draw a bell curve around the price. So imagine this. Imagine I have my chart here, and I have prices who fluctuate. What I'm doing is, based on these prices, I'm drawing a bell curve. And I'm saying, you know what? This is the prices and this is how they act. The price acts. What is the probability that the price stays within two standard deviations? Well, I know that there's 95% chance that it stays within two standard deviations. Okay. So now I can say, well, I'm very confident that the price is going to be within there. So I'm going to draw a lower band at this two standard deviation here, and a higher band at two standard deviations above. And then I can be confident that the price of this currency is going to stay within those standard deviations, because it's very unlikely that it goes outside of it. It's only 5% chance that it goes outside of it. Or I could say I want to draw bands at three standard deviations. So it's 99% chance that the price stays within those bands, right? So this is what's done here. When you're drawing this, we are drawing a moving average with a lower band at two standard deviations below the moving average and two standard deviations above. So we have a 95% confidence that the price will stay within those bands. And if I double click here, you see that it's using a standard deviation of 2. Now, if I want to be more confident and I want to widen my bands, I want to take the extremes out of this bell curve, I want to be 99.7% sure that prices will remain within this range, I can increase it and put a 3 standard deviation. And you'll see that my bands are going to widen, right? And now my bands are bigger, okay? The way you would use the bands is be like, okay, well, you know what? If prices drop, it's very unlikely that it keeps dropping because, it's already so far out. So I'm going to buy when it touches the lower band. And then when it comes back, I'm going to get out here. I'm going to take my money. And here I'm going to buy again because it touched the lower band. And here when it touches the middle band, I'm going to get out. And here again, it barely touched them. So here I would have shorted and here I would have gotten out. So these are all profitable trades. But you could have used a 2 standard deviation and gotten way many trades, but again, you would have gotten them early, but you would have gotten a lot more trades here. So, if you're more aggressive and you want to get more trades, you use tighter bands. If you want to take very fewer trades, you use wider bands and get those trades that are at extremities. Now, when do you use a Bollinger Band as an indicator? You're just not going to use it all the time. A Bollinger Band really looks at deviations from the mean. So you want to use it in a mean reverting strategy. That means when you're trading something that you believe is going to mean revert, meaning that when it goes up, it's more likely to come back down, and when it goes down, it's more likely to come back up. Not in something that's trending or that could go in a momentum in a direction. You don't want that. So I would like to use something like Bollinger Bands between currencies that are very similar. Example, Canadian and Australian dollar, which have very similar economies that move in similar fashions. So when they deviate from each other, they reconverge, and when they converge too much, they redeviate. So to trade this currency pair using an indicator like Bollinger Bands makes a lot of sense, because when they deviate from each other, they reconverge back. When they converge too much, they redeviate back. So you can use this to see how far have they deviated from each other, and at that point, get into a trade. And you'll see in something like this, even I'm looking at this currency here, you can see that here you would have gotten a lot of good trades. You would have been able to buy the lower bands, get out in the middle, short at the higher bands, get out in the middle, buy the lower bands, get out in the middle. Here, short, get out, buy, get out, short, get out, buy, get out, short, get out. Here you would have shorted, and when you would have gotten out, you would have lost money. So here's a losing trade, but all of these were winning trades. And here, all of these are winning trades. So one losing trade and all of the others were winning. So very good indicator for this currency at this particular time. Now, one thing you want to watch out for is that in the financial industry, the bell curve is not a regular bell curve. So usually the bell curve, regardless of the industry, looks very similar. But in the financial industry, what we have is what we actually call a fat tail curve. So instead of having a regular bell curve like this, what we have is a fat-tailed curve where it looks more like this. Well, sorry for my drawing. Wow, this is so bad. Let me just redraw this. Might be even worse. Okay, so basically, things that usually happen here in the middle, they're more likely to happen, and things that are very unlikely usually, things that usually in a regular bell curve are very unlikely, are more likely in the financial industry. So this is why we don't really call them bell curves in the financial industry. We call them fat-tailed bell curves, because things that are very unlikely tend to happen way, way, way more often in the financial industry, in trading. Things that you would think would never happen, they seem to happen all the time. So just understand that it's not because you're at 3 standard deviations or 4 standard deviations that the price will never go there. Prices will go there often. So you just want to be careful in your position sizing and all of that, because prices can go to those extremes very often. So this is what Bollinger Bands are. So what I would challenge you to do is look at your charts again, see if you can find a currency where Bollinger Bands look to work pretty well on, and see if there's a reason for that. See if those currencies are actually or have similar economies, and you would want to use this indicator to trade them or not. In this lecture, what we're going to look at is the RSI, short for Relative Strength Index. Now, what the Relative Strength Index is basically an indicator that's drawn at the bottom of your chart. You'll see it at the bottom of your chart that tells you something about if this product that you're trading is overbought or oversold. Now, the way that it's calculated is it takes a look at the last 14 candles. Okay, it takes the last 14 candles and it takes a look at the size of the green candles versus the size of the red candles. Now, if the green candles are way bigger than the red candles, so if the green candles are bigger than the red candles, then the RSI is going to give you a big value. So the RSI, the values that it can range between are between 0 and 100. So if the green candles are way bigger than the red candles, it'll be closer to 100. Now, if the red candles are way bigger than the green candles, then the RSI's value will be closer to 0. Okay? Usually around the RSI line that you see here, we are going to draw a line at the bottom and a line at the top. Now you can decide at which location you want to draw these lines, but usually they are drawn at the 30 level and at the 70 level. And that's the default, and that's what everybody uses. Some people are more aggressive, they use 20 and 80, but usually it's 30 and 70. So what we say is, if the value is below 30, we say that the product that you're trading is oversold. Why? Because the red candles are way bigger than the green candles. So it's oversold. Now, do you want to buy something that's oversold? Well, what do you think? If the RSI's value is above 70, we say it's overbought. Why? Because the green candles are way bigger than the red candles. Okay? So it's overbought. People are buying it more and more aggressively, right? That's why the green candles are way bigger, because the buyers are buying it so more aggressively. We say it's overbought. Do you want to short something that's overbought? Now, the reason why you don't just want to short something that's overbought or buy something that's oversold is things can remain overbought or oversold for a very long time. Imagine this. Imagine there's something that's dropping. Red candles are way bigger than green candles. So it's oversold. And you see it's oversold, then you're like, you know what? I want to buy it because it's oversold. It's going to come back up because sellers are selling it more and more aggressively. Red candles are way bigger. And you buy it. And then guess what happens the next few days? Red candles keeps getting bigger and bigger than the previous red candles. And the green candles keep getting even smaller. So then it's even more oversold. So things can remain oversold for a very long time. If you're looking at stocks, some stocks go down to zero. So people can, and even when you're looking at currencies can fluctuate a lot. So things can remain oversold or overbought for a long, long time. So you don't want to just buy something that's oversold, and you don't want to short something that's overbought. What you want to do is wait for it to stop being oversold or overbought and then get into a position. For example, if you look here, prices, red candles are getting bigger compared to the green candles. And you see here it becomes oversold. Now, I don't want to buy as soon as it became oversold. I want to wait until it stops being oversold and the RSI line crosses over above the oversold line, because you see here green candles started being bigger than the red candles and it's not oversold anymore. So then I would buy the position. And then as it goes up, here it became overbought. I don't want to short right away, but when it stops being overbought, again, because of this red candle, that's way bigger than the green candles, then I want to get into my short position. And again, here, it would have been a profitable trade. Again, oversold, I don't buy right away. I wait until it stops being oversold and then I buy, right? So if I'm looking at a currency here and I want to look at the RSI, all I have to do is go in indicators, type RSI. The first one, it shows up, Relative Strength Index, click on it, and you see the RSI at the bottom here, okay? So let's say if I'm looking at the price here right now, well, imagine this. Imagine I want to buy this currency, or imagine I want to short it, sorry. Imagine I want to short it. Well, would I short it right away? Not necessarily, right? Because it's trending up. And then look at this. Here it becomes overbought, because the green candles are way bigger now. You can see them. So it's overbought. Well, am I going to short right away? No, not necessarily right away. I want to wait until it stops being overbought. Okay? So there's the potential for reversal. Okay? And this is what this indicator is going to help me with. And I see here that red candles became bigger all of a sudden, and green candles became a bit smaller. So then it stopped being overbought. So this would tell me that, you know what? At this point here, that it stopped being overbought, is a good place to short. Okay? And then, guess what? Well, that was a good place to short. So it helped me in not shorting too early, right? And this could have been done the other way around. Prices could have been dropping, and if I wanted to buy this product, well, or let's say here, right? Let's say while it was dropping, I wanted to buy. Well, when do I buy? And there's this big red candle. Do I just buy here? No, because this could have continued dropping, right? But then when I see that, okay, the green candles came back bigger and the red candles became smaller again, we're not over sold anymore. We were, but we're not. Then there's a potential for reversal. Then I would get in here. And again, that would have been a really good trade. So you can use it in both sides. It's used for reversals. And you want to always not buy as it's overbought or oversold. But when it becomes that and then stops being that, that's when you enter a position. So my challenge to you is look at your charts, put the RSI indicator on, see if you can find some places where there is a reversal that happens and you could have spotted it through the RSI. Again, with all these indicators, the more you use them, the more you play with them, the better you'll get at spotting when to use them and when not to use them and how to use them, and you'll get better at using them as well. So that being said, that's the RSI, and I'll see you guys in the next lecture. In this lecture, we're going to be talking about the Fibonacci retracement indicator. So this indicator is based off the Fibonacci sequence or the Fibonacci ratios developed by Leonardo Fibonacci, who's an Italian mathematician. And all of this is going to be based off the Fibonacci sequence. And the sequence is basically a series of numbers. And each number in the series is the addition of the previous two numbers. For example, you have 0, 1, and then the next number is going to be 0 plus 1, which gives you 1. The next one is going to be the addition of the previous two numbers. So 1 plus 1, which gives you the 2. Then here we have 2 plus 1 gives you 3. 3 plus 2 gives you 5. 5 plus 3 gives you 8. 8 plus 5 gives you 13. So each number that you have is just the addition of the previous two numbers. And this keeps going on forever, right? So I can just open a Google tab here, and we can just write Fibonacci sequence. And you'll see here that the sequence keeps going, right? Now, one really nice thing that we get out of the sequence is some ratios. And the ratios that you can get are basically when you divide one of the numbers by the next number. Okay, so I'll pull up a calculator here, and I'll go 610 divided by 987. It gives me 0.618. Okay, if I take any other numbers, like let's say 6, I'll take this one here, 6765 divided by the next one, 10946, I'll get again 0.618. So whichever two numbers I divide like that will give me the same ratio. And you can look into the Fibonacci sequence. There's a bunch, and this is one of the reasons why it's used in trading, because it's something that you can see throughout nature and throughout architecture, throughout beauty. You can see it in the face of people that we find beautiful, ratios between different aspects of their faces. You can find it in nature, you can find it in the pyramids, you can find it everywhere. And this is why it's very well known. You've probably heard of it before. Either you've heard of Fibonacci sequence, or you've heard of the golden ratio, which is based off of that, or phi, or any of these things that relate to the Fibonacci sequence. So you can actually watch documentaries about that. Anyways, now how do we use these ratios in trading? So there's an indicator that we can use here, and I'll pull a chart here, that's called the Fibonacci retracement levels. So when you open TradingView, you can go here, and then you have a bunch of different indicators that you can use. One of them is called Fibonacci retracement. And you'll see that there's a lot of other indicators based on the Fibonacci here. Fibonacci channels, wedge, and you can look into those. But the one I prefer is the Fibonacci retracement. And the way it works is once you select it, you have to select a true and a peak. So you select here the lowest point that you see and the highest point. Now, once you select the highest point, you can just extend this further so you can include the rest of the chart that you want to see. And basically, what's going to be drawn here is some of these Fibonacci ratios. So you see here, we went from 1 to 0, or 0 to 1, it doesn't really matter. And you have levels at the 23.23, so the 23% from this level here, 38% from this level, 50%, 61.8, and 78.9. So you remember here the ratio we just calculated? 61.8. That's the level here, right? Now, how do we get these other levels? Well, take a look at this. If I take, let's say, 610, instead of dividing by the next one, I'm going to divide by the next one after that. So divided by 1597, what am I going to get? 38.1. And this is the level here, 38, right? And if I go another one further, so let's say I go 610 divided by, not this one, but this one, 2584. And I could have chosen any numbers and divided it by the 2 after that. It'll give me the same thing. I'll get the 23.6 level here. Now, one of these levels here on the Fibonacci retracement isn't actually a Fibonacci level, and this is the 50 one, the midpoint one. This is just added because a lot of times you'll see that retracement does happen to this level, so it's been added there. But it's not an actual Fibonacci ratio. And you can actually play around with this. There's some really nice mathematical properties. Let's say if you go 610 divided by 1597, and we get back the 0.381, which again is this one here, right? Well, look at this. If I do the square root of this number, guess what I'm going to get? So square root, I'm going to get 618. So I'll get this one here. Now, if I do the square root of that one, 78.6, which is this one here. Right? So there's some very nice mathematical properties with this sequence here. And the way it's used basically for this indicator is once you draw the true to the peak, you're looking at something that's going in one direction and you believe it's going to keep going in that direction. But it's a natural and healthy thing for things to pull back or retrace before continuing in that direction, right? Now, the thing is, how far are they going to retrace? And what we found is, or what has been found, because I didn't do the research, just what has been found, is that retracement tends to happen to levels that are computed through the Fibonacci sequence. So it's more probable for retracements to happen to some of these levels here, like the 0.38 or the 61% level or the 78% level. So because of that, when you draw this indicator, you get all these levels there. So you know that there is a high probability that we pull back to one or several of these levels. So if you're planning on, or if you think that this position or this currency is going to continue in that direction, but you don't just want to buy right away, you want to wait for a retracement, you can place your orders at those key levels because you expect it to bounce back off of one of these levels and then continue. So one of the ways you would be trading something like that, if you want to go long, in this case, USD CAD, and you just don't want to buy at any level, and you expect the trend to continue, well, you can place your order at, and you can split your orders. One of the ways I like to trade is split my orders in 3, put a quarter of it somewhere, another quarter somewhere else, and then half of it somewhere else. So I do pyramid position sizing, which we'll look at later when we talk about position sizing and how much to buy and where to buy. But basically, you can place part of your order here. So you can buy 25% of your position here. And then if the position keeps going against you, you know that at the 50% level, there's a high likelihood that it goes back up. So you put another quarter of it here. Once it goes back up, you can sell that quarter that you bought here at a profit while keeping the previous quarter that you bought here longer. It falls back. You can buy again that quarter here. It falls to this level, the 61 level, then you can buy the remaining half here. And as it goes up, you can sell that half here. Goes up, you can sell the position you bought here over here. Goes back down, you can buy again. So you're trading this range here, right? Comes back down, you can rebuy the position that you had bought here previously. Goes back up, you sell it, goes back up. The position that you bought here, you might have sold here, unless you wanted to keep it for longer. So you can really trade those ranges and have, specific entries in the same way we use all technical analysis, just for finding entry zones and exit zones and being able to get in, get out, get in, get out, and, go back on another currency and do trades with your funds while not using them in this position, instead of just buying and holding it and, just holding long term and going through all these movements without capitalizing on those movements. So this is the Fibonacci retracement indicator. It's based off the Fibonacci ratios, based off the Fibonacci sequence. And, you can use it when you're looking at something that's going in a specific direction. You're expecting a retracement and you want to find optimal entry zones based on the Fibonacci ratios to get in and get out of your position. In this section, we're going to be talking about fundamental analysis and how we're going to be using it for the purpose of this course. So we've looked at technical analysis. Now, what fundamental analysis is basically everything else. So everything that might affect a currency: GDP, employment, export, import, trade, policies, companies going to war, everything and anything that can affect a company's currency. Now, like with my other courses, for example, my stock trading course, which is the bestseller on this platform, I've created the first course, which is the foundation course, which covered everything for stocks except fundamental analysis, where we looked at how do we avoid fundamental event-based news while trading. And then I created another advanced class where I really delved into the fundamental analysis, which took the majority of that course. And then we looked at strategies based on fundamental analysis. This is what I'm going to be doing for this course as well. It's too much stuff to look at every single fundamental aspect that will affect currencies in this course. Why? Because we actually need to cover a few macroeconomic courses to cover some of these things in terms of, GDP, exports, imports, how it'll affect the currency, monetary policy, fiscal policy, all of these things. So it's really a whole course. So I'm going to do with this course the same thing I did with my stock trading course. I'm going to have an advanced course as well, where we're going to cover a lot of these fundamental topics that are very broad and very large and very, very deep. So it'll take us a lot of time to cover all of them. That course will probably be bigger than this one. But in this course, what we're going to do, we are still going to look at these events that I want you for the time being to avoid, because you don't understand them enough. And we're also going to look at how you can learn by going through these events. So in the future, you will gain more knowledge and will be able to trade them as time goes by. Not right away, but as time goes by and you see enough of them and you learn through this experience what to do, what not to do. So we are going to cover that. But yeah, we are going light on the fundamental analysis. We're looking at how to avoid these events so you don't get caught in a trade while there's something very big happening, how you learn from them. So with time, you're going to be more comfortable to trade these fundamental event-based news. In this lecture, we're going to look at economic calendars and how you can use these calendars to avoid certain fundamental events that can impact your currencies wildly. Okay, so if I go here on the Google Sheet that you guys have and I look in calendars, and right now I only have one set up here, but I'll have some more by the time this course is up. And I open one of the ones for calendars, which is Forex Factory. This is one of the most popular ones. And you can go here and you can go on calendar. Once you go on calendar, you'll see that you have all of the events that will be coming out that will impact these currencies. So you have your currency here. So this one will impact the euro. This one will impact the Japanese yen. And you have all of the currencies here. Now you have them by date as well. So today is Monday. And this is what we have. We can see that tomorrow, Tuesday, May 28th, 2019, we have a few events, right? And the color here that you have is going to tell you the impact that this event will have. So something that's yellow has a low impact, okay? Not very high, so it's low. So you can have a position through that event. Unless something really crazy happens, it's not going to impact it by much. But if you have something that's red, right, then you have high impact expected. So then your currency really might move, or let's see here, the day after, Canada. So I live in Canada, right? And I trade a lot of pairs with the Canadian dollars. We have overnight rates that are coming. So here, high impact. Okay. I know that any currency that I have that I'm trading versus CAD is going to be impacted. So I want to watch out for that. So as a new trader, you might not want to be in a trade at all at this time, right? Or you might want to wait after the news gets out. And then you also have here, if you want to read more about it, you can open details. And it'll tell you, well, the source is going to be from Bank of Canada. Measure interest rate at which major financial institutions borrow and lend overnight funds. So they might increase the rates, they might not. We don't know, right? So then usual effect, actual graded or forecast is good for currency. And this is how you're going to be learning fundamentals for the currency market, is by going over these things. So every day that you trade and you're looking at the economic calendar and you see, well, what's going on today? These events are happening. Okay, well, how would the interest rates affect the currency? Oh, okay, well, this is how it would affect it. Then when is this coming out? Why traders care? Here, short-term interest rates are the paramount factor in currency valuation. Traders look at most other indicators merely to predict how rates will change in the future. What else do we have here? We have historical. So we have the last times that the overnight rate could have been affected, and the actual versus the forecast has always been the same. So here in October 2018, the rates were 1.5. Everybody thought we were going to increase them. The forecast was 1.75, and we did increase them. So there was no surprise. So you can see here that we're forecasting the previous here is 1.75. We're forecasting 1.75. The actual is not out yet. It's going to be out in 2 days. For the 27th, the 29th, the actual rate that they're going to come out with is going to be out at 10 a.m. So if I'm trading this currency, I might not want to be in a trade, right? I might want to wait. And then the actual rate is going to come out. And if it's 1.75, well, that's what everybody expected. There's not going to be a big impact. But if there is a surprise, if they come out and they raise the rates, then there's going to be a big impact. It's a surprise. Nobody was expecting it on the currency you're trading. And this is why in the beginning, you don't want to really be trading a news or a currency that has a high impact news that's coming out. What you want to do is just watch it. And then as you go with time, you're going to see that, okay, well, this time there was a surprise. The rate was higher than expected. Then you're going to see what happens in the next 5 minutes, in the next 10 minutes, in the next 1 hour, in the next day. How long has this impact rolled over? And then you're going to be able to understand how, something like this affects the currency you're trading. And in the future, if you want to trade these events, you might see them, and when there's a surprise, well, you know what happened last time and how a currency was affected by that, and you have confidence in entering a trade based on a fundamental event or a fundamental news like this one. So very important for you to go on this. Make sure that any currency that you're trading doesn't have a high impact news coming out. If it does, maybe not be in it for that time, or maybe be very small, because you know that there could be something, your currency could be very volatile at this time, and then learn from them. Even if you're not trading them, you can go on something else and see, well, what is this annual budget? What is this? Can I read about it? What has happened in the past? How does the currency behave after this event occurs? And learn this way as well. So this is economic calendar. 100% you have to be on there, and you have any good trader looks at the economic calendar every day and makes sure he knows if there's anything happening with any of his currencies and uses it to learn as much as he can as well. Congratulations on making it this far. We've already covered a lot of topics. And now in this section, we're going to start looking at trading platforms and answering the question of which trading platform should you use. So each broker has their platform. For example, if I go here on Wanda, the broker I recommended, if I go in my account, you'll see here that they have desktop trading platforms. Which ones? Well, they have Wanda Desktop, which is their in-house developed platform that their members can use, right? That we can use as traders going through them. And they also offer MetaTrader 4 and MetaTrader 5. Now, each broker is going to have their own platform. So if you go with another broker, you won't have Wanda Desktop. For example, the trader I was trading before Wanda, they had CTrader, which I used and I really liked. But each broker is going to have their own platform. And they're all going to have 1, 2, or maybe 3 other platforms. Now, the other platforms that they're going to have are always going to be MetaTrader 4 and MetaTrader 5 often as well, okay? For this reason, what I recommend is you actually use the MetaTrader platform. Why? Because if you change brokers, then you can still use the same platform. Also, there's some other benefits with those platforms that I'm going to talk about later. But there's also another reason. And that reason is that MetaTrader 4 is so popular that most of the resources that you're going to find online on YouTube are going to be for MetaTrader. So as a beginner, I highly recommend using MetaTrader 4 for those reasons, right? If you change brokers, you'll have the same platform. And if you need help, if you want to find something, you can just Google it and you'll find help and resources on how to use MetaTrader 4 all over the internet compared to these other platforms. As you get better and you have more experience, then you can change platforms. It's not a problem. I highly doubt that you would want to change platforms anyways. But then across platforms, it's usually the same thing. So it's not hard going from one platform to the other. So we have 2 MetaTraders. You have MetaTrader 4 and MetaTrader 5. Now, the one I'm going to recommend using is MetaTrader 4. So MetaTrader 4 is actually 15 years old right now. MetaTrader 5 is way more recent. Now, why would I recommend MetaTrader 4 if MetaTrader 5 is more recent? Because contrary to, public belief, MetaTrader 5 is not an upgrade to MetaTrader 4. It's a completely different platform. MetaTrader 4 was made for Forex traders and only for Forex traders. MetaTrader 5 is made for people who want to trade Forex, but other things like CFDs and stocks simultaneously. So it's not just for Forex. For this reason, MetaTrader 4 has remained the most popular trading platform for Forex and the standard for Forex trading. So that being said, you can just download it on your broker's website, start the installation, and in the next lecture, we're going to go through the platform itself. All right, so once you have your MetaTrader 4 installed, you'll have an icon here, and I'm not going to go through the installation with you because you guys can click next all the way through, no problem. Once it's installed, you'll have an icon here. Just double click on it and it'll open your MetaTrader 4. Now, if it asks you for your login credentials, you'll have those login credentials somewhere on your broker's account. In the case of if you have an Wanda account, all you have to do is go on sub accounts here, and in this section, you're going to have your different accounts. So one thing that most brokers will permit you to do is create different sub-accounts and transfer funds from one account to the other. So you can have different accounts for different strategies. You can have demo accounts, live accounts, accounts with a little money, accounts with a lot of money, and you can have login credentials for each of them. So that would be in a section like sub-accounts, okay? Now, once you open it, it's already going to be logged in, okay? And in my case, I've logged into a practice account here. It's a demo account, which is what you should start off with. Okay. Now, when you open it, it usually, it'll look something like this. Okay. And this is the charts you're going to have. We'll go over a few of the things here so you know how to use it. If you want to add a new chart, all you have to do is go here and add a chart. Let's say I want Australian USD. Okay, so it opens this chart here. Now, what you see here is now I have 2 charts, but these charts are a little bit ugly. So I want to change them, okay? Because I don't like this color here. So what I'll do is I'll go here. I want this is a bar chart. I want a candlestick chart. Click on it. I don't like the colors, and you see it didn't even change anything because it's so ugly. I'll right click, I'll go in properties, and I want to change this a bit. Here, I don't want the background to be black, I want it to be white. So I'll change this. The foreground, so the writing, I want the writing to be black here. Bar up, I want this to be green. Bar down, I would want it to be red. Bull candle, I guess that's the same thing as bar up. Bear candle, red. What else? Line graph. What is the line graph? I think that's just a line. Let's just put it purple. Volume, let's just put it, I don't know, midnight blue, why not? Okay, let's just leave it at that. Anything else? No. Okay, so now I have this chart here. Okay, can zoom in it a bit. Okay, this is way better, right? I like this. Now, once I have this, I can save this as a layout. So when I open new charts, I can just use this layout that I prefer. And you can change it. You can remove the grid. You can do whatever you want, right? If I don't want the grid or if I want something else, I can change that here, okay? But what I want to do is I want to save this layout. So I'll right click, I'll go on templates, and I'll do save template. And let's call this test, I'll save it. Now, next time, if I want to open a chart, and I can open charts from another location, I can open it directly from here. Let's say I'm looking at these symbols here, and I want to look at Euro USD. Well, what I could do is I can right click and click on chart window. So it opens a new chart. Now, I don't like this layout, so I can load a different layout. I can go here on templates and load the template, and I'll load my test template. And bam, I got it. Now this kind of sucks because every time, am I really gonna load template, remove template? No. So what I can do is I can do something like this. I can save this template. Let's go on templates, save template, and I'm gonna save it as, and I'm gonna put the name default. And when you put the name default, well, what MetaTrader is gonna do is every time you open a new chart, it'll see that one of the templates is called default, and it'll use this template already because it knows that this is what you want. So here, if I want to look at something else, I'll open this one here. I'll do new chart, and right away it opens it in my layout that I want. So this is the first thing we do. We have a layout that looks a little bit like TradingView because I like, and it looks like normal charts, right? It's green and red. So that's what you want. So this is how you have your charting. Here is your market watch. Your market watch is basically things you're looking at. You can remove things, you can add things to it. So it's really up to you to what you want to have there. Now, if you want to change the time frame that you're looking at, you can change it from here. So right now I have 1 hour candles. I can change this to 30-minute candles, 15, 5-minute. I can go daily, I can go weekly, whatever you want, right? So you can change that from here. If I want to add some text, I can use this. If I want to add some lines, let's say a horizontal line, I can just add it like this. If I want to change it, I'll just have to double click on it. I can move it up and down. If I want to delete it, click on the delete key. So very easy. If I want to insert some indicators like we've looked at, I can click on insert at the top, indicators, and I have all of these indicators here. Oops, insert indicators. And I have all of these indicators here, oscillators, so MACD, momentum, RSI. You can select the period. Everything we've seen in TradingView, click OK, and you'll have it here. You can add lines. You can do whatever you want. Okay. Now, you can also add, anything else that we've seen in TradingView almost, you can add from here. Fibonacci levels, retracement levels, all of that stuff. You can then zoom in by clicking here or zoom out. You can scroll to the left or to the right using your scroll wheel on your mouse. Now, if you're looking at a chart like this and you want to look at historical prices or something like that, and the price updates, it'll automatically come to the front. If you don't want this happening, click on this button here. Scroll the chart to the end on tick incoming. So if you remove it, if there's new ticks that come in, it's not gonna come all the way to the front and then you have to scroll back. So if that's something that's happening, if you have like a 1 minute chart and then every minute there's a new update, or at every tick there's an update, you don't want the chart to always go up, remove this. Otherwise, you can leave it up there and it'll always go to the front. Now, if you want to look at multiple charts simultaneously, you can just minimize the chart and put it wherever you want. You can have multiple charts simultaneously in different locations. You can have a chart here and just go through them like that. Or you can even go here on Windows, tile windows, and it'll put them in tiles for you. You can click on Cascade. You can click on, I guess, vertical tiles, whichever way you want to look at them, right? Now, if I want to place a trade, I can click here on the stop button here, and then you're going to have this buy and sell button. So you add, and the quantity, so how much you want to buy and how much you want to sell, and you can directly place orders from here. Otherwise, you can just right click and send a order by clicking on this here, sell limit. If your mouse is above the current price, it will send a sell. If your mouse is below the current price, it'll send a buy, and you can change that from here. You can change anything from here. Or you can actually send the order directly from the Market Watch window by just double clicking on it, on the symbol you want to execute, and you'll have the order execution window that comes up here. You can also do it by clicking on New Order, and this pops up. So example, if I want to buy this currency, all I would have to do is put the volume that I want to buy. So is it 0.1, 0.2, 1 lot? I'm going to go 0.01 lot, okay? Then I can do a market execution. Market execution means that it will send the order at market. So in this case, if I want to buy, I'll buy at 1.11925 because that's the ask price. If I want to sell, I'll be selling at 1.11911 because this is the bid price. So I'll be selling, I can either sell at this price or buy at that price, okay? That's a market execution. If I don't want to do that, I can do a limit order, which here they call it pending order. Now, once I send a buy or sell, I can simultaneously attach a take profit and a stop loss. So if I'm, let's say, buying, I can send a take profit simultaneously. Let's say I'll be buying at this price, right? Because you're buying here. I can take a take profit a bit higher, like here, or wherever based on my analysis. I can also send a stop loss somewhere here. Now we're gonna talk about stop losses later, but that's where you're taking your loss, right? Now, that being said, I don't just want to buy right now. Maybe I want to buy because my analysis says that if the price falls at 11755, it's a good buying location. So I want to buy there. So what will I do? I can go and say pending order. And the price that I want to buy at is, like I said, 11755. I want to buy there. And then my stop is going to be, or my take profit somewhere way higher. And my stop, well, my stop is going to be, it has to be lower than that. So let's say it's at 655. Okay, I'll just put this and I'll place my order. Now it tells me all the information. I can print it. I'll just click OK. So right now I have a buy order here. If the price falls down to 1.11755, my order will get executed and I'll have, you see, there's a buy limit there. I'll get executed and I'll buy my position. Once that's opened, then there's going to be a take profit and a stop loss that are going to be sent. So basically, if the price goes back up all the way to here, where there's the red line, my take profit, and you can see it here, is going to be executed and I'm going to take the money that I've made on this trade. Now, if the price keeps going down, my stop loss is going to get executed and I'm going to take a loss on this position. Okay. So very nicely done here where you can place your trades, you can visualize them, you can update them, you can do whatever you want, right? You can delete a trade. Very intuitive. So you can practice by sending orders right now on your demo version and, you know, start testing it out and see, because you're going to make mistakes in the beginning. Sometimes you're going to mistakenly send a limit order or a market instead of sending a limit. Sometimes you're going to send the wrong price. It happens. Now, at the bottom here, you're going to see your trades. And you'll see here that I have a buy limit order at this price with a stop loss and a take profit here. So you see that I have an open order, right? I can cancel it by clicking here at the bottom, there's an X here. I just realized you can't see it because my face is there. So here at the bottom, there's a X. I can just click here and delete this order, right? So I can just delete it if you want. You can see all your orders here. If you have multiple orders, you can see your exposure. So if you're trading multiple currencies and all the currencies you're trading have the same currency, you might be overexposed to a currency. You can see that here. You can see account history. This is just a demo account that there's no history. There's just one trade that was done on it before. You have news, alerts, mailbox, market. That's not too important. Signals, not important. And yeah, that's pretty much it. You have journal to see everything that was done. Now, if I want to cancel this trade, just click here and delete. Bam, gone. So this is a very nice platform. They also have the cell phone version. So if you have your cell phone, it connects to this. You can see your positions, you can see your trades, you can see your balances. So very nicely done. I highly recommend you playing around with it as much as you can, even if you don't know what you're doing, or even if you don't have a solid strategy yet, just to get some practice of sending orders, getting orders executed, seeing your balance. And then once we're going to be talking about risk management and position sizing, the calculations that they make here for your margin and your equity and all of that, they'll make sense. And yeah, this is MetaTrader 4, the industry standard, the most used trading platform for Forex. Now you know it, now you can play around with it, and I'll see you guys in the next lecture. Okay, so this isn't something that I recommend, especially if you're a beginner, but you can possibly trade through TradingView directly. So when you go on TradingView, there's a section here at the bottom that says Trading Panel. And here it says, select your broker to connect the broker account. Now you could use this just to paper trade and practice. So using paper trading by TradingView, which is basically just a paper trading platform. You can just execute trades with fake money and see how you perform because, it's easy to use and you can trade directly off the charts without going through, another channel. But you could connect to one of these brokers. And look here, they have Oanda. So I could connect to my Oanda account directly from here. And instead of opening my MetaTrader 4 or Oanda desktop and trading through them, I can trade through TradingView. I can send an order on TradingView. TradingView is going to connect to Oanda through their API and send my order, and my order will be executed in my own account. So if I click here on Oanda, I'll go on demo, and then I'll click continue. It'll ask me for my credentials. I click sign in, and then it'll tell me which one do you want to use, and I'll use my practice demo account, I guess. Yeah, and then I click allow. Okay, we're logged in, and you see here I have individual positions 0, net positions 0. I have the same balance, and I can trade through here. So if I want to do a trade, I can select, which currency I want to trade. So let's say USD CAD, and I'll go here on a 1-hour chart. Okay, so if I want to send an order here on this currency, and remember, it has to be on a currency that's trading on Oanda, okay? All I have to do is go here, right-click, trade. I can create new order, or I can just send a order at the price I clicked on. So I'll just do that. And, I could put a take profit or a stop loss, but I'm just, for simplicity, I'll just send an order at, at this price without any take profit or stop loss. Send it. My order is sent here. I can see it. It's nice. It's on the chart. I can go in orders and I can see this order here. That's working. So it is open. I can cancel it if I want to cancel, right? And I can see my account history, my transactions. I can see everything here, right? So very nice. If I go here and I send an order right now, let's say buy limit, I'll send that. Okay, let's just send one here. You'll see that, okay? As soon as I send it, if I go back here and I look at orders, here's my order. The 2.02, right, is here. So the order that I just sent here, that you can see here, is showing here. And I can cancel it from here. And when I cancel it from here, you see it just disappeared. So they're both connected. You can trade from here or from there. Now, I don't recommend doing this because TradingView doesn't work with all brokers. So what happens if you change brokers? Also, you have less information here than you have on MetaTrader 4. So yes, you could use it if it's on the fly. You see something nice, you only have your charting in front of you, send the order through it if you are using Oanda. But make sure to get back to your trading platform and make sure everything is correct, because this is a third-party provider, right? Maybe something happens, maybe they don't send the order correctly. You never know. And it's the same thing with your cell phone, right? You have your cell phone on you. If there's something that's happening and you want to send an order on it, okay, it happens, but you don't want to just be using that. This is not the go-to thing. The go-to thing is the MetaTrader 4 platform. And then you could, if you're in a tight spot or if you're somewhere else and you don't have everything on you, you could use your cell phone. You could send the order directly from here, but make sure to get back to your trading platform. Trading involves you, doing some good analysis. So you have to have the trading platform. You have to see your margins. You have to see your exposure. You have to see everything. We're going to be using some Excel sheets to calculate things for historical trades. So you are going to have to use a computer and sit down, but it's a nice thing to have something like that where you can just connect and send an order when you want to do something quickly. So pretty cool stuff, sending orders to TradingView that you could do. So we've covered a lot of ground so far, but we're still not ready to start trading yet. So even though we've covered topics like the history of money, the Forex market, quotations, Forex terminology, like pips, lots, leverage, short selling. We talked about brokers. We talked about technical analysis, like charts, trends, candlestick patterns, chart patterns, technical indicators, how we use fundamental analysis and economic calendars, platforms. We're still not ready to place a trade yet because the most important topic of them all is the one we're going to cover now, which is risk management. And if you guys look at any private investment firm and you go online and see what type of jobs or careers they offer, you're going to see a lot of job postings for risk managers. Why? Because this is the most important thing. Managing risk. You are going to see some analyst positions, but you're not going to see, profit-taking management. These companies don't focus on how much money they're making. They focus on how to minimize the risk. Because ultimately, by minimizing risk and minimizing how much money you could lose, you kind of maximize how much money you'll be making in the long run. So this being said, you have to understand that without proper risk management, even if you understand everything else, you will not be successful in trading. So what is risk management exactly? And what is even risk? So risk is basically just an action or an activity that has a potential to go wrong. And when you think about it this way, you'll realize that everything you do in life involves risk, right? If you want to jump off an airplane and skydive, well, there's risk. You could die, right? But you perceive that the risk associated with that activity is so small that it's worth it, right? The probability that it materializes is small and the gain that you get out of it is worth it. If you want to go to, Mexico for vacation, then there's risk. The plane you're on could crash and you could die, but it's a small risk. You perceive it as a small risk and you're willing to take that risk for the outcome or for the benefit. If you get married, there is risk. If you have a kid, there is risk. If you drive to work, there is risk. There's risk in everything. And your job is to see if the risk is worth it or not. And then if you can minimize that risk in any way possible, you have to do so. And this is the objective of this lecture. So risk management is basically going to be the action of figuring out what the risk is and then seeing what you're going to do with it. Now, you have several risk management techniques, 4 of them to be specific. The first one is risk acceptance. And risk acceptance is when you see that there's a risk and you just say, okay, well, you know what? I'm willing to take that risk and I'll take all of it, right? So this is something that we're never going to do in trading, because in trading, when you're just accepting risk, that means that you're willing to buy a currency at this price. And if it goes completely the other way and it goes, to zero, then you're willing to take all that risk and you're willing to lose everything you have, which we're never going to do. Okay. So risk acceptance is never something we're going to do. And an example of this would be basically like looking at USD CAD and saying, you know what, I'm going to buy it at $1.34 and that's it. If it goes down all the way to 40 cents or 30 cents or 20 or 1 cent, I'm still holding. That's it. I accept the risk. We're never going to do that. The second thing is risk avoidance. Risk avoidance is when you see something and you perceive that the risk is too high. And you say, you know what? I'm just not going to partake in this activity because the risk is too high. I'm just not going to do it. And I'll walk away from that. And this is something we will do in trading. Example, when we're looking at the economic calendar and we're seeing that there's an event happening, so we just don't want to have a position throughout this event because it's too much risk. We don't know what's going to happen. We don't want to take that risk. This is something that we'll do. The third risk management technique is the one that's the most popular and the one that will do the most, which is risk limitation. So you perceive that there's a risk and you want to limit the loss if that risk materializes, so you don't lose too much. And this is done through stop losses, which we'll talk about more in the next lecture. But this is really what we're going to be focusing on, is limiting our risk. And in this situation, if we're looking at a currency like USD CAD, and we think it's going up, and we buy it at 134, then we might say, you know what? If it doesn't go our way and it doesn't go up, and it starts going down, well, I'm going to limit my risk, and I'm going to take a loss. And I'll take a loss at 1.32 or 1.30 or 1.28 or 29, whatever it is. I'm going to limit my loss. If it goes against me after a certain point, I'm going to take my loss and I'll move on and to another trade. And that's it. That way I limit my loss and the maximum amount I could lose is quantified and I'm okay with it, right? And this is what we're going to be doing the most, okay? The fourth risk management technique is risk transference. Risk transference is basically when you give the risk to somebody else. It's like when you buy insurance for your house. You know that when you buy insurance, you're paying a bit more than what it's actually worth because the company makes money off of you, but you're willing to do that because you're scared that, you lose your house. Now in trading, we don't do that. We don't, you can buy options, you can buy different things to transfer the risk to another party, but then you'll be paying a premium for it and you'll be losing in the long term. When we're trading, we're willing to accept small amounts of risk and get paid for them a bigger amount of money. But if we transfer that risk and we pay for it a bigger amount, then we're not making money in the long term. So again, this is not something we do. The only two things we're going to be doing is going to be risk avoidance and mostly is going to be risk limitation. Okay. And this is what we're going to be looking at in the next lecture. In this lecture, we're going to be talking about stop losses. A stop loss is what you're going to be using to limit your risk on any given trade. So whenever you're getting into a Forex position, example, USD CAD, there's going to be three things that you're going to have to think about. First one is your entry price. Where do I want to get in? For example, here, if we're looking at this channel, you might say, I want to get in somewhere around here. Let's say if the price falls to this zone, I might want to buy somewhere just above this support. Well, if you buy here, where are you going to be getting out? Well, you are going to be either getting out at a profit or at a loss. So what you need to do is send a take profit and put a stop loss. A take profit is going to be higher. So if it goes higher and you make money, you get out at a profit here. A stop loss is going to be lower. So if it falls lower, then you're going to take your loss and move on, right? So what we have to do is, first of all, figure out where we want to take our loss, okay? So whenever you're going into a long position, and I'll put this here, you're going to be buying somewhere, and then you're going to be, let me take this off, and then you're going to be getting out either at a profit somewhere higher, right? You might say, I want to get out here, if it goes up all the way here. But then if it drops, you're going to have a stop that's going to be at a lower amount. And the stop is always going to be, somewhere below a range or a support or somewhere that you feel the currency is going to have a harder time reaching. So your stop loss is always going to be at a lower price than your entry. That's when you're going long, okay? So you have your entry, your stop loss that's lower, and your take profit that's higher. Now, take profit, we don't even consider right now. The only thing we care about in risk management is our stop loss, because that's when we lose money. That's what we care about. It doesn't matter if we make way too much money. It's not the end of the world. But we don't want to lose too much money. That would be the end of the world, okay? And we'll talk about that even more as we go on, because we have a few lectures talking about how we calculate, where we put the stop loss, the quantity that we buy. That's coming up in the next few lectures. Now, if you were shorting, let's say I want to short here. Let me take this. Let's say I want to short. Let's just draw a new one. Let's say I want to short if the price goes up here, right? I want to short, okay? If you're shorting, you're betting that the price goes down. So I'm going to use this tool here, the short position. If you short here, you think that the currency is going to go down. So if it goes down, you're going to make money. So you might be, well, you know what? If it goes down here, I'll take my profit. And then your stop price is going to be higher. So you might short at a particular price, and then your stop is going to be higher than that price, because if it goes higher, you're losing, because you remember, you're shorting, and when you're shorting, you're betting that the currency is going down, right? So if it goes up, you're starting to lose money. So in this case, your stop loss is at a higher price than your entry price, and your take profit is at a lower price, right? So that would be the difference. So depending on which side you're going, if you're long or short, the stop price is going to be at a different price. If you're long, stop price is lower. If you're short, stop loss is higher than your entry price. That being said, knowing that risk management is one of the most important topics in trading, and that risk management basically entails putting stop losses, we understand the importance of setting correct stop losses. Now, where are we going to set those stop losses? What is the position size? So how many lots do we buy based on our account size? These questions we're going to answer in the next few lectures, but now you know that setting stop losses is one of the most important things for you to be successful and to generate income. It's not the actual money that you're going to be making, but it's the amount of money that you're going to limit yourself from losing. So we've talked about risk management and how risk management entails minimizing risk for a given position. Now what we need to talk about is money management. And the difference between money management and risk management is that money management is not for each position, but for your global account. So for your portfolio. So earlier we said, okay, well, we're going to try to minimize risk for a position. So we put a stop loss to limit our loss. But when we put a stop loss, we want to calculate, okay, well, how many lots should we buy and where do we put our stop loss so we don't lose more than X amount of money? But what is that X amount of money that we're willing to lose? Well, that depends. What is our portfolio size, right? And this is where money management comes in. Money management comes in because it tells us, okay, we have this portfolio. We want to make sure that we don't lose it. Okay, so whenever you're taking any specific trade, you got to keep that in mind, because you don't want a bad trade to ruin your account. You don't want 5 bad trades to ruin your account. So a very important thing to understand is when you're trading, regardless of how good your strategy is, you can have the best strategy in the world. You are going to lose X amount of times. You are going to lose. For example, when you go to the casino, they win about 52% of the time. They lose 48% of the time. But they're able to play these games that make them win so often that they end up making a lot of money. This is the same thing in trading. I've worked professionally as a trader at different firms since 2011, 2012. So that's about 7 or 8 years now, professionally, right? And across these firms, I've seen hundreds of very, very good traders, the best traders in Montreal. And the best traders I've seen, okay, across all these firms, they all have winning batting averages or winning percentages of about 65%, which is really, really good. Because some people, when they come into trading, they think that they're going to win 90% of the time or 80% of the time. That doesn't happen. It doesn't exist. If you're able to win 65% of the time, you're going to be so rich, right? And you have a good win-loss ratio as well. But these are the percentages that are really good. And again, when I compare it to the casino, I'm like, look, the casino wins 52% of the time and they're making a killing, right? So you don't need to win that much. So imagine this. Imagine you're a great trader and you win 65% of the time. You're so good that instead of it being 50-50, you're winning 65% of the time and you're losing 35% of the time. That's amazing. So it's like basically you have a coin, and when you play head and tails, but Every time you get heads, you win, and when you get tails, you lose, but you get heads 65% of the time, and you only get tails 35% of the time. Great game. The thing is, even if you get tails 35% of the time, there are going to be times where you get tails 3 times in a row, 4 times in a row, 5 times in a row. So even if you have a great strategy, this strategy is bound to lose several times in a row at different times. That's just mathematics. Okay? It's not that you're a bad trader. It's not that you're not good. It's just that it's part of the formula that you lose sometimes. Now, so what are you going to do when you lose 3 or 4 times in a row? Imagine you bet too much every time you played. Then you might wipe out your account and lose all your money. And this is what you don't want to do. So money management comes in because it'll come in and tell you, okay, you know what? We have this great formula that makes you money in the long term, but we don't want to get caught when we lose several trades in a row and lose all our balance. So we need to figure out a way that we don't lose too much money. So when these bad sequences happen, we're okay, right? So when we're looking at money management, just think of it this way. If we lose a percentage of our account, it's very hard to get back from there. Example, if we lose 20% of our account, let's say we have $1,000. We lose 20% of it. We lose $200. Now we have $800. How much in percentage do we need to make to get back from $800 to $1,000? Not 20%, because now we only have $800. We now need to make 25% to get back to break even, to get back to $1,000. Well, what if we lost 30%? So from $1,000 to $700. Well, now if we want to get back from $700 to $1,000, we need to make 43%. If we lose 40% of our account, we would need to make 67%. What if we lost 50% of our account? So you have $1,000, you start betting too much, you have a few bad trades in a row, and you lose 50% because you bet too much. So now your $1,000 became $500. To get $500 back to $1,000, you have to double it. So you need to make 100% return. That's crazy, right? Imagine if you lost 60%, now you need to make 150%. So when you lose too much money on an account and your account shrinks a lot, it becomes extremely hard to bring it back up. So our objective is to never lose so much money that we fall somewhere down here, because then it's too hard getting up. We have to limit how much we're able to lose. So even if we have, let's say, 10 bad trades in a row, right? We have really bad luck. We're a good trader, but we have really bad luck, and we got 10 bad trades in a row. It's not the end of the world, because we only lost a little bit, and then we're able to make it back, right? But if we're betting too much and we get 10 bad trades in a row, then we lose everything, and then there's no way of getting back from that. And this is the problem with most novice traders. They bet too much, they blow their accounts, and they don't stay in the game to keep playing. And this is what we want to avoid. So we're going to add on top of this in the next lectures and see how we use money management techniques to protect our account and to calculate our position sizing, how many lots we should buy in order to not lose too much. So now it's time to talk about position sizing, which is basically how many lots or partial lots should we buy for a given position. Now, when we looked at money management, we said that we didn't want to lose too much on any given trade to not lose too big of a percentage of our portfolio. Now, because of this, whenever we're doing position sizing, we have to specify what is the percentage of the portfolio that we're willing to lose on any given trade. Now, you can set your own percentage, but the general rule of thumb is to use somewhere around 2%. What this means is that you should be willing to lose a maximum of 2% of your portfolio on any given trade. Now, you can play with this, right? Some people are gonna be willing to take more risk and they're willing to lose a little bit more than 2%. Some people don't want to take as much risk and want to lose less than 2% per trade. For example, imagine you are using the 2% max loss per trade and you have $1,000 in your account. That means you're only willing to lose 2% of that $1,000. And 2% of $1,000 is $20. That means you're only willing to lose $20 per any trade on your account, right? That means even if you lost 10 trades in a row, even if you have 10 bad trades in a row, you would lose 2% on each of them, which would be 20% of your account, which is you can easily come out of that and have a series of good trades and be profitable. So if you use 2%, you're basically saying that even if you have 10 bad trades in a row, you're only losing 20%, and you can get back from that. Now, if you have a very small account and if you're taking 2% risks, you're not making enough money, and then you want to take a little bit more risk because your account is small and you want to just temporarily take a little bit more risk, you can do that. Generally, when you have more money, you're even going to take less than 2%. So if you have, $50,000 or anything like that, you're going to take less than 2%. So imagine you have $100,000 in your account. You could be like, well, you know what? I want to take 1% max loss per trade. So if I lose 1,000. So even if I lose 10 trades in a row, I'll lose 10,000. I'll still have 90,000, and I can get that back very easily. So you can play with that as you want. I suggest that you start with the 2% because you are going to be starting paper trading anyways. So it's fake money, but just so you see how that affects you. Now, once you have your percentage decided, and we're going to go with 2% here, the steps are this: to calculate how many lots you want to buy. Step 1 is going to be calculate the dollar max loss for the position. In our case, let's assume we have $1,000 in our accounts, because that's how we're going to go ahead and practice here. We're going to start as if we only had $1,000. So 2% of $1,000 is $20. So for me, the maximum amount of dollars that I'm willing to lose is $20 per trade. Okay. Step 2, I'm going to have to decide on my entry price. Step 3, I'm going to have to decide on my stop loss price. Again, you see, I'm not talking about profit. I'm only talking about about loss here. And then I'm going to calculate my position size. And this is the formula to calculate my position size, which is going to be my max loss, which is the $20 here, divided by my entry price minus my stop loss price, divided by 100,000, because that's going to be one lot, the value for one lot, times the entry price. And don't worry, you're not going to have to do this calculation every time that you're going to do a trade. In the next lecture, I'm going to give you a calculator that does all the calculations for you. But we still have to go through it once here so you understand how it's calculated. So let's imagine this. Let's imagine I'm getting on this trade. Okay. Let's put a 4-hour chart, for example. So I'm just going to draw some lines and pretend we're going to do a trade here. Let's say this, and we'll do whatever, okay? Doesn't matter. Let's see, there's a little support here. Might be a little bit of a range. Oops. Kind of, I guess. Okay, so let's say we're looking at this, and we're like, okay, you know what? I wanna do a trade here. I want to buy if this currency falls here somewhere, because there's this range here that I want to trade. I think I could buy here and sell here, buy here and sell here, and do multiple trades like this. So let's say I want to buy if the price falls here, right? Now, if it goes back up, I'll take my profit here. But again, we don't care about profit now. If it goes down, I'm going to take my loss. If it goes down here, below these two supports. So if it goes here, I'm going to take my loss. And again, I'm just doing whatever for example's sake, right? Don't disregard these lines. I just put whatever, which they don't look too bad either. But let's say I want to put my stop loss here. Okay, so if it falls down, I'll take my loss. So my entry price is going to be, let's say, just above here. Let's put it just above this. You'll see that round numbers actually have a big impact, right? I have 134, and you see that it's kind of a support. So let's put it just above 134. Let's put it 134.06. I'll try and get in at 134.06. Let's just put in this in text. So I'll do buy at 1.3406. That'll be my buy price. And then my stop price is going to be, let's say, somewhere around here, 133.57. 133.57. Let's put this in red. That'll be my stop. Okay, now I can calculate how many lots am I going to buy. Okay, and I'll use the formula that we just looked over here, right? I'll just use this formula here. So the formula will go like this. Let's open up a calculator. And we'll go here and we'll put my max loss is what? Is $20. That's what we said. Then we have divided by, and we open parentheses, we have our entry price, which is 1.34006, minus our stop loss price, which is 1.3357, close parentheses, and then we take this number, we divide it by 100,000, and then we multiply it by the entry price. So times the entry price, which is 1.3406, and that gives me 0.061. So I can buy 0.06147 lots. Obviously, your broker isn't going to permit you to have so many decimal places, so you can get 0.06 lots. So you just round it down, 0.06 lots. And if you get this, if you're able to get this amount of lots, right? If you had it exactly, then if the price goes from here and you actually lose, well, 0.06 lots times this amount of pips that you're going to lose is going to give you a $20 loss. So basically, we were able to calculate the exact amount of lots that we should buy, which is in this case 0.061. That will make it that if we do lose and we do take our loss at that price, we will lose the exact amount that we had calculated before, which is the optimal amount that we're willing to lose, which is $20. We don't want to lose more than that. And because of this, we were able to figure out that we want to use this amount of lots so we don't lose that amount of money. So the process you see is very simple. You look at a currency that you want to get into. You know how much money you're willing to lose, in our case, $20. You look at where you want to get into that currency. You find where you're willing to take your stop loss, which is going to be basically outside of some support level, somewhere where you think the currency is going to have a hard time reaching. And based on that, you calculate what is the position size, how many lots you're going to be able to buy in order to not lose more than that $20 that you don't want to lose more than. Very simple. So this was an example of how to calculate your position sizing for a long position. So when you're buying something and your stop loss is below it. Now, if you were actually shorting something and basically you're shorting somewhere, let's say here, your stop loss would have been higher. Now, if this is the case and you're shorting something, the formula is very much the same, but for something small. In this situation, if you're shorting something, your stop loss is higher. So what you have to do is you actually have to do the stop loss price minus your entry price. Otherwise, it would have given you a negative number. So that's the only difference. You can play around with it and calculate it for a short position and see what you get. But I'm not going to ask you to do this calculation every time. I actually don't even, put it into my calculator every time because you can just use a calculator that does that for you. And this is what we're going to be looking at in the next lecture. We're going to be looking at how you can get this calculation done very quickly and efficiently without having to do all of that. So, resources time. I'm going to give you a few resources that you can use to calculate very quickly and efficiently your exact position sizing instead of taking a calculator and calculating it yourself every single time. Now, these two resources are going to be one, this Excel sheet that I've made for this course. And you can download this Excel sheet by clicking just under the lecture in the resources section. And you can just download it. It's an Excel file. And you can use this to calculate your position size. After I show you how to use this Excel sheet, I'm also going to show you a website that you can use, which is this one, where you can calculate your exact position size, very quickly and efficiently. I'm actually going to recommend this website for position sizing over my Excel sheet because, I'll answer the reason for that why as we go through the Excel sheet. But you have both of them. So watch how I use the Excel sheet and then watch how I use the website. And then you can use whichever one you want. So The way this Excel sheet works, and we're going to go over the Excel sheet later on because it has more purpose than just position sizing. You're also going to use this to keep track of your performance, but there is a section for it for position sizing. So this is how this Excel sheet works. You have this section here, which is basically for position sizing. And in this section, you have a few things that you can fill out and a few things that you can't fill out. Whatever is in light blue is what you can fill out. All the rest do not touch. There's formulas in there, so it automatically calculates the rest. Okay, so you don't want to touch anything that's white because there's formulas in there, and you know it has calculations in there. So if you play around with it, you might break it. That being said, the ones you can play with is the ones in blue, and these ones you have to fill. So account balance. We said that our account balance was $1,000. So you put 1,000. Max loss per trade. We want 2%. So we leave it at 2%. So you see here, it tells you that your max loss per trade is $20. If I want to go 1%, then it would be $10, but I'm leaving it at 2%. Your margin access. The margin access is how much your broker gives you to trade with. With Wanda, the margin is 50, so I'm leaving it at 50. If you have 200 to 1, then you can put it here and it'll tell you how much capital you have access to. I'm leaving it at 50, so I have 50K capital. The currency pair you're trading, we are going to be trading this one, which is USD CAD. So I'll just put USD CAD. This doesn't actually do anything, so you don't really need to put it, but it's just for you. Now you have to put entry price and exit price. And you have to go if you're long or short. So if you're long or short, I'm going long, so I'll leave it as long. My entry price. What is my entry price? Is 1.34006. So I'll put this here, 1.34006. And my exit price is 1.33570. So 1.33570. Enter, and you see here, it's going to calculate a few things. It's going to calculate the loss in pips. How many pips I'm willing to lose. And it says here, I'm willing to lose 43 pips. And you can see that the difference between this and this is about 43 pips. Now, it'll calculate how many lots I should buy, right? And in this case, it tells me you should buy 0.6147. And remember our calculation here, 6147. So it's correct, right? So instead of you doing all of this calculations, this Excel sheet is going to calculate it for you. And you see I have the formula here. If I'm long and if this is more than this, then do this calculation. If I'm short, then do this calculation. I set it all up here. Okay. Now, I can't buy 0.06147 because with my broker, I can either buy lots, mini lots. So I can't just trade this. With my broker, the minimum amount I can buy is 0.01 lot. So that's the minimum. So I can go in increments of 0.01. So I'm going to round it down and I'm going to use 0.06 lots. Okay. So that's, that's the optimal amount of lots that's been calculated. And this is the amount of lots that I'm actually going to use because I can't use this optimal amount. Now, it's going to calculate some other size. It's going to calculate my contract value. So how much is it going to cost me to actually get this amount? It's going to cost me 8K. That's okay because I have 50K, my capital that I have access to. Then I have other calculations like the pip value. So I know that the pip value is 60 cents. So that's each pip is going to cost me 60 cents. Pip value in base currency. Then margin requirement. How much margin do I need for this position of 8,000? Well, I need about $160. That's cool because I have 1,000. And then the max loss per trade. How much am I actually going to lose if it goes against me? Well, guess what? I'm losing just less than $20. I ultimately want to lose $20, but since I couldn't get the exact amount here and I got a little bit less, I'm going to be losing a bit less. If I was able to get this exact amount, 0.06147, I would have lost $20. But since I can't buy this whole amount that I want and I can only buy 0.06, I'll lose just below $20, which is okay, right? So this calculates it for me. Now, you can use this for your calculations. There's a little bit of a problem, and the little bit of a problem is I'm assuming that my account balance is in US dollars. So, if you're trading somewhere else, if you're in India or if you're in another country and you're using your local currency, then you have to convert that currency to USD, or you have to make some changes to the calculations, which is a little bit hectic, and it would have taken me too much time into putting all these formulas here because, it'll just take so much time. So you can just use a calculator like this if you're not using base currency US dollars. And here, example, if I was trading in Canadian dollars, I could use this calculator, or if you're using any other currency. So if I'm trading Canadian dollars, I'll put Canadian. My account size, I'll put 1,000, which is 1,000. Risk ratio, I'll leave it at 2%. How many pips can I lose? Well, here I can use my Excel sheet, or you could have just looked at the chart and did the entry price minus the exit price, right? So here, how many pips are you willing to lose? Well, your entry price was 1.34006, exit price is 1.3357, and what you're willing to lose is 43.6, and you have it here, loss in pips, right? So here I'll put 43.6, and then your currency pair that you're trading, you put it in, so it's USD CAD in this case, and then you calculate. And you see here that the calculated amount, if I want to lose only $20 Canadian, is 0.046 lots. So how come is it different than what I have here, the 6.1? Because here it's assuming my currency is Canadian. The balance that I have is Canadian dollars, not USD. Here it's assuming I have $1,000 USD. And this is why I'm telling you, if you are trading with your currency is in actual US dollars, it's cool. You can use this Excel sheet. But if you're trading in another currency, your account balance is another currency, well, then it's not going to be the same amount because you want to lose 2% of, not in US dollars, but in the currency that you have, right? In this case, if my currency was USD and I recalculate, you see where it gives me here? 0.62, which is what I have here, right? Rounded up, rounded at 6.2. So my Excel sheet is going to work if your balance that you have is in US dollars, which, I think about over 50% of my students are in the US. So you can use that Excel sheet. Otherwise, if you are keeping your currency in another currency, since I couldn't do all the combinations here and pull the exchange rate for each currency and not make it too complex, use this Excel sheet, put your account currency in, and you'll be able to do the same calculations that you get from the Excel sheet on this calculator. Now, where can you get this calculator? On the Forex resources sheet that you already have. It's right here in the other resources, my FX book. You can just click on it and it'll open, and it's your position size calculator that you can use. So you have these two options to make your life easier. So we're this close to start trading live, where we're going to put everything that we've learned together to implement our trading. But before doing so, I want to present one last topic. And this is the topic of trade analysis. And basically what you need to do in this section is learn how to analyze your historical trades to see if what you're doing is correct or not correct. There's a lot of people out there that just start trading and never look at their historical trades. They just trade, and at the end of the month, they look at if they made money or lost money, and they never know, if what they did one month is correct and what they did the other month wasn't correct. And that's just like being blindfolded and gambling. That's just gambling, to be honest. It's not trading. Throughout my career and at every firm that I've worked at, and even at MTG where I hired traders, one thing that was mandatory is that each trader looks at historical trades, does some type of analysis on it, sees what he's doing correctly, so he does more of that, sees what he's not doing correctly, so he can eliminate that. And also the company would use this to see which traders are good, which traders deserve more money, which traders deserve less money, and which traders should be fired. Now, even if you're trading by yourself, this is how you have to treat trading. You have to treat it as a business. So you have to imagine it was a restaurant that you opened. And at the end of each month, you don't even look at if you made profits or not. And you don't look at which recipes made you money, which dishes made money, which dishes didn't make money. You wouldn't make it. You have to look at everything at the end of each month or even each week and see what's working, what's not working, so you can increase your profits as a business. So you have to treat your trading not like a hobby, not like some of these guys show you online where they're trading off their cell phone from a beach. You can't do that. You have to treat it like a business. And anybody who's successful in any business, in anything, being a YouTuber, being a singer, being whatever, they treat it like a business. Okay? And this is what you have to do. And because of that, you're going to have to analyze your trades, look at which type of trading works, short-term, long-terms, your longs, your short, which pairs are doing better returns, which strategies, when you're trading off technicals, if there's news, if all of these things you have to look at to be a great trader. And throughout my career, the people that I have seen that do this, that look over their trades and think about it and make changes, are the people who are successful. All the successful guys that I've known all do that. They reflect on it. They have a spreadsheet with all their trades and they constantly look at it. So this is something that you are obliged to do if you want to be successful in trading. And in the next few lectures, I'll show you how to do that. So before I give you the Excel sheet that you can use to analyze your historical trades, I want to talk about two metrics that you're going to see on that sheet. And these two metrics are the batting average and the win-loss ratio. Now, if you've worked at any trading firm, you're going to be familiar with these metrics because it's something that are going to be on each and every single of your reports. And if you are trading on the retail level, again, retail traders most often don't analyze their trades, so they don't know too much about this. So we're going to go in depth about it here. So the batting average and win-loss ratios are something you want to be familiar with. What the batting average is basically the percentage of trades that are profitable. So every time you do some trades, you're going to record them on this Excel sheet that I'm going to give you, or wherever, if you have a trading software that does it for you, all the trades are going to be there. And one thing we're going to calculate is the percentage of these trades that were profitable versus the percentage that were not profitable. So for example, if you have 100 trades, and out of these 100 trades, 65 of them were profitable, then your batting average will be 65%. Okay? This is important just so you know what percentage of your trades are profitable. If you are below 50, then there's a problem. If you have a good batting average, then you know that you're trading this strategy correctly. Now, batting average isn't the only thing you want to look at. You also want to look at the win-loss ratio. The win-loss ratio is going to be the ratio of the average profitable trades divided by the average unprofitable trades. And I'll give an example of that in just a second. This is important because if you had a batting average of, let's say, 80%, which is ridiculously, impossible to achieve, but your win-loss ratio is so bad that when you lose so much more than when you win, then you're not going to be a profitable trader. So you can't just be right most of the times, but when you're wrong, you lose so much that it doesn't matter, right? So your win-loss ratio has to be good as well. So let's do a quick example. Imagine this. Imagine you have, you've traded 10 days, okay? And each day you've made, let's say first day you made $100. Second, let me put this in dollars here. Okay. And let me zoom in. First day you made $100. Second day you lost 50. Third day you made 200. Third you made 100. Then you lost another, $100. Then you made 150. Then you made 200. And then let's say you lost 200, and then you lost 50. Okay, so you have 9 days here. Yeah, let's add another one, and then you made, let's say, 250. Okay, so 10 trading days, and this were your profits. First of all, you want to calculate your batting average, and how do you calculate that? Well, we can actually just count them. We can say 1 positive trade, 2, 3, 4, 5, 6. 6 divided by how many? We have 10 trades. It would be 60%. So it's just basically, I'll do count if, count from here. If it's positive, so this should give me 6. And I'll do 6 divided by the total, which is just count all of these, which is 10. So 6 divided by 10. And this is going to give me 0.6 in percentage, 60%. So that's my batting average. Okay. And this is going to show up on the Excel sheet that I'm going to give you once you put in your trades. Now, the other thing you want to do is the win-loss ratio. Now, the win-loss ratio is a bit more complicated to calculate because first you want to get the average of your winning trades, right? So what is the average of the winning trades? Well, it will be basically all the winning trades, this one plus 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 this one. So we have 6 of them divided by 6, right? And this will give you 166, or you can use the Excel function, which is going to be average if. So you want to average this range, and the criteria is average the ones that are positive. So the positive one, bigger than 0. So 166. Then you want to do the average of your losing trades, average of the losers. And here you can just do average if, and do if they are negative, smaller than 0. And the average losers is minus $100. And it makes sense, right? Why? Because here you have minus 50, minus 100. So that's 150 minus 200. So that's 350 minus 50. That's minus 400 divided by 4, which is minus 100. Okay. Now the formula says the win-loss ratio is the ratio of the average profitable trades divided by the average of the non-profitable trades. So we go win-loss, and then we can do this one divided. Now this is negative, so I've got to put it positive. So you do the absolute of this one, which just puts it positive, removes the negative, and gives me 1.666. What that means is on average, when I win 1.67 times more than when I lose. So if when I lose $100 on average, then when I win, I'm winning $167. Okay. So this tells me that I have a really good strategy here because look, I'm winning 60% of the time. And when I win more than when I lose. That's great. Remember, the casino wins 52% of the time. And when he wins, he usually wins as much as when he loses. So his win-loss is 1-to-1. So that would be great. You can just repeat the strategy as much as you can and make a lot of money. That being said, this is the two things that you might have not understood from the Excel sheet, but now that you understand them, in the next lecture, I'll show you the Excel sheet and show you how to input your data, all your trades, and get results so you can analyze your trades correctly. So this is the Excel sheet that you're going to be using to analyze your historical trades. I've made this sheet specifically for this course and for you to be able to use it to improve on your trading and become a better trader. If you want to download it, you can click under the lecture in the resources section and you'll be able to download it there. So this being said, this is what it's going to look like when you get it. Now, we've already talked about the position sizing calculator and that the only thing you can change on there are the things in blue. All the other things are automatically calculated. It's the same thing for your historical data analyzer. Everything in blue here you can change, but everything else that's in white is all going to be automatically calculated. Even the things here, even the things here, all of this is going to be automatically calculated. So don't touch it. Just touch everything in blue here. That's what you can change. So how does it work? Well, for each trade that you're going to have to input this data here. Date, account size, side, and P&L. The date is just the date of the trade. So let's say I do a trade today. We're May 29th, 2019. I'll put 05/29/2019 and enter. That's it. Now you'll see here that the dates here, they automatically populate. So you have all the dates from the first day all to the next days, right? Then I put the account size. So let's say my account has only $2,000. I'll just put $2,000 in there. The next thing I have to do is put the side. Now the side of my trade is either long or short. Then I go long or did I go short? That's the only thing you can do. So I'll put long, capital L. That's how I write it. Very important that you write it in the same way, right? Long, L-O-N-G, and short, S-H-O-R-T, with caps. Okay, important. First letter caps. Then your P&L. Let's say on this particular trade, I made $100. I'll put 100. And you'll see here it says, okay, well, I made 5% return on that trade. And here on the side, it'll show you that on this date, I made on my longs 5%. My total is 5%. Now let's say the same day I make another trade. I'll add it again. I'll add here. And let's say my account size was 2,000 as well. I put two trades simultaneously. This one was a long trade as well. And this one, I made $50. Well, here's 2.5%. And you'll see here now my longs are 7.5%. Now let's say on the same day, I did another trade. And this one, I did simultaneously, but it was a short trade. I went short. And this one I actually lost money on. I lost, I don't know, I lost $60. So I lost 3% here. Now you'll see here that in my cumulative table, I have my longs were 7.5, my short is 3, total is 4.7. I have my cumulative longs, so cumulative would add up after each day, my cumulative shorts and my cumulative total. And I can keep adding trades. The next day I trade on the 30th, and let's say the next day, let's say I add funds to my account. Well, I have profits because I made $90, or let's say I didn't add funds, but my account is bigger now. I have 150 minus 60, so I have $90 extra. I have $2,090, and I went on a short trade, and this time I made $150. That's how much I made. And you'll see here, this populates here on this day where I had a short trade. A total was this for that day, but then my cumulative here for the longs didn't change because I didn't have a long trade. But for the short, I was -3, but now since I made 7%, I'm +4. And then I have my total cumulative, which is shorts and long, I'm +11%. So this will give you, your rolling profits for, historically for longs and shorts. Now you keep doing this and you keep adding your trades. 2019. And let's say one day you just add a lot of funds to your account. Well, let's say I added some funds here and my total account value is now $5,000 because I added some more funds. You have to input this here because if your account size fluctuates, then the dollar amount of money that you made is different in percentages. And what you care about is percentage returns. Because imagine this, imagine you have an account that's small, you keep losing money, and then you add a lot of funds, you have one good trade, and then your account shows that you've made so much money. But that in percentage, it wasn't real because your account size was a different size at different times. So you have to keep track of your account size to make sure that, if I make $150 now, if let's say I go on a long position, I make $150. Well, $150 on $5,000 is only 3%. And $150 on 2,090 is 7%. So it makes a difference. So important to know that. Now it's going to keep adding here to your profits and losses. And let me just add some more variables in and we'll continue from there. Okay, so I've added some more trade data here. I've added about, 15 trades, some of them long, some of them short. And let's now go see what the Excel sheet can calculate for us, right? So we have here the daily returns, and we see on each day how much we've made for our long positions, for our short positions. Sometimes we have both long and shorts in the same day. Then we have the total. Then we have the cumulative for the longs. So that's just adding up the longs. And I can see here that the longs, they grew up. So I made about 27% on my long positions. Now on my shorts, I started negative, then I went positive, then I lost again a bit. So I finished only 3% positive on my shorts. And my total cumulative, which includes the longs and the short, is at 30%, which is great. Okay. Now other things that were calculated here are, so here I have the total P&L that I've made in dollar value. I have it split for the long trades and the short trades. So in the long trades, I made $1,190, but for the short trades, I actually made $0. And we can just add this up. Look, these are the short trades here. Okay, I can add them up. This one and this one, and then this one, and this one, and this one, and this one, and this one. If I add all of them up, it's 0. So 60 and 150, 200, 110, 200, 200, minus 200. These, if I add them all up, will sum out to $0. So even though it shows that I made 3% for the shorts, I did make 3% because at different points, I have different values in my accounts, right? So in percentage, I did make 3% because sometimes my account was smaller and I made more percent profit. So I keep that in track. But then I had more funds later and I lost a smaller percentage, but was a bigger dollar value. So when I do the dollar value, I actually made 0 in dollars. But this shows you in dollar value as well. Okay. Then you have your total return, which is for the longs, shorts, and then for all the trades. You have your average return per trade. So I can see here that my average return per trade is 2%, which is great. You're not going to get something this high. This is just because, I'm putting fake data in. And long trades, I have 3.3%, but my short trades aren't as good. I only have 0.4%. So this already can tell me like, oh, my short trades aren't that great. Why is that? And I can look into that. My total number of trades, I have 15 trades. Obviously, you want to get more trades before you can be certain about anything. You got to get at least 30 trades in to just even, as a sample size, 30 is the minimum to have any type of meaningful data. But, here I have 15 trades. My long trades are 8. My my short trades are 7. Batting average. So I'm batting 67% of the time and my win-loss ratio is 1.33. Amazing. On my long trades, I'm actually batting 75% and my win-loss is 2.2, which is pretty good. But on my short trades, I'm batting only 57% and my win-loss is sub 1. So when I lose, I actually lose more than when I win. So here's a problem and I got to look into that. Here you see your cumulative returns. And you can see here, the green is the cumulative returns for longs, which I've made a lot of money on the longs. Here you see the cumulative returns for the shorts in gray. And you see in the beginning it was going well, but then I started losing. So maybe something's up here and I have to look at these short trades, what happened wrong here. And in orange, I have my cumulative total, and this adds both of them up. And again, I only have these days here, so then it just flatlines. But I can see that this is a pretty good graph so far. I might want to look at my shorts. Here I have my daily returns, and I can see my daily returns split between the longs, which are green, the shorts, which are gray, and the total, which are orange. And I can see here that I have some bad trades here, some big ones here, -6%, -7%, which I need to look at, right? Again, you're not going to be losing this much on any given trade because, you have a stop loss and you have a 2% that's put in. I just put some dummy data in for us to get some data here. And here you can see everything and you can use this to analyze your trades. Now, I've also added a little something extra for people who are more advanced, which is this here. This is called the Sharpe ratio. Basically, we're calculating, and this is outside of the scope of this course, so I'm not going to go into it here. But you can Google it if you want. You can take a look at it. It's a little bit outside of the scope of this course, but I do have it for my traders who trade in-house at MTG. And this basically looks at the longs, the shorts, and the total. It looks the average return per trade, but it looks at the standard deviation of each trade as well. So how volatile, or the standard deviation of the trades. So how volatile the returns are from one another. So the more volatile they are, the more risky it is. And then it does the Sharpe ratio, which is the average return divided by the volatility of those returns. And the higher the Sharpe ratio, the better. And you can see here the Sharpe ratio for the longs is amazing, but for the shorts is not so great. And, a rule of thumb is that a Sharpe ratio above 2 is good, is very good. Above 3 is amazing and then you should trade that strategy. It's good. Over 3, it's amazing. That being said, this is the Excel sheet, and this is what you need to use to analyze your trades. You can use this Excel sheet for, your whole Forex trading strategies and put everything there. Or you can even create several copies of this Excel sheet. And for each type of strategy that you're trading, you can have an Excel sheet to analyze the returns of that strategy. For example, you could open a trading account and then open several sub-accounts. And one sub-account could be for your, medium-term trading. So swing trading. One of them could be for longer-term trading. One of them could be for shorter-term trading. One of them could be for, trading based on technicals only. One could be based on news only. One could be based on, a specific indicator. So, reversals or, channels or whatever it is. And you can separate them so you can see which strategy or which type of trading you're really good at and gives you good returns, and which ones you're not great at. And the ones that you're not great at, you can stop, or you can paper trade, or you can eliminate. And the ones you are good at, you can then start trading them live. You can add more money to them. And if you do this, this would be, the best way for you to figure out what works best for you and leverage these positions. Just like in any business where they have people looking at everything and seeing what works best and they leverage those positions, this is what you should do. So feel free to make several copies of them and several trading accounts. And again, in the beginning, you're trading on demo. So you have a demo account and you're doing different trades. You can have multiple demo accounts, doing the different trades in each of them and recording the historical trades in a different Excel sheet for each of them until you see which one is really the best one and which one you're willing to go live with now. And then even when you go live, you record the trades and see which one you put more money into, which one you don't put as much money into. And this really will optimize your trading and give you the best performance possible. In this section, we're going to do some live trading. Now, the purpose of this section is for us to use as much of the things we've learned in practical examples. So things like technical analysis, using the calendar, using a calculator for position sizing, money management, everything that we've learned, or most of the things that we've learned, how are we really going to implement them when we're starting to trade? Because this is one of the things that most of my students request is, well, when we put all of this together, how does it work? Can we see you do it? So this is going to be the part of that. Now, the section isn't, or the objective of the section isn't for me to show you that I can make a lot of money, because this would be very easy to do. I could just record only winning trades and tell you, look, I can make this much money, but that wouldn't be realistic. What I want to do is have a very realistic scenario that you can learn from, right? So what I hope for is for us to get some winning trades and some losing trades, okay? I really hope we don't get just winning trades. I really hope we don't get just losing trades. I hope we get a combination of both. Because when you are trading live and when you get to a certain point, you are going to have some situations where you have a lot of winning trades in a row. You might come in and you have 8 winning trades in a row, and that happens. And sometimes you have 5 losing trades in a row. That could happen too. But those scenarios are less often. What's more often is you have a few winning trades, 1 losing trades, 2 winning trades, another losing trades, 2 losing trades, then a series of 4 winning trades. So you have this, combination of losing and winning trades, which I hope is what we're going to get. I'm going to do a bunch of trades. Basically, it won't be exactly the same trades that I would have wanted in real life because, again, we're recording this video, so I'm going to try and make as many trades as possible. I hope I'm not going to push and get into trades that I might not have wanted too much just for the purpose of the lectures. So hopefully there will be some good opportunities at the moment for me to get into. That being said, when you start trading, please do not start trading live. Start with a simulation account. The only reason I'm doing it live is just to show you how it looks like, which it'll be the exact same thing. It's just some people want to see the live trading. So it will be with live money, but please, when you start, make sure you're doing simulation until you're extremely confident and then go live. I cannot stress this enough. Okay, so without any further ado, let's open the MetaTrader account. And what I'm going to do is I'm going to log in with my live account now. Like I've told you before, you can have multiple sub-accounts. And this was the practice account I had created for this course. Now I'm going to log into another account, a live account, that I have, that I've also created for this course. I just transferred a bit of money in it and will log into it now. So I'm going to go into my website. You can't see this, it's on another screen. It has all my personal information, so I'm going to keep it there. And I'm going to find the sub-account that I just created. I'm going to take the account login. I'm going to paste it here. I'm going to take my password that I have for it, and I'm going to put that here. And then lastly, here, if you are trading with Owanda and MetaTrader 4, you will have the server here. I can see it under my sub account. For me, it's live 2. So I'll go in the server Owanda live 2. So they have different servers based on where you're located. If you're going live, if you're going practice. So this is the account that they have for that sub account. Every time you create a sub account, it might go on a different server, but the one I have here is under this one. So I'll just put all the info here, click login, and here we go. I have now my live account that we're going to be trading with. And this live account here, you see it has $1,000. So you just transferred $1,000 from one of my other accounts. And this is one thing that's nice with Owanda. You can just transfer money between your accounts. I created this new sub account for this course. And then I transferred $1,000 from one of the other accounts to that account. And now we have a fresh account that we're going to start off with. And we're going to be placing some trades starting in the next lecture. Okay, so I'm scrolling through my currencies. I'm leaving the time frame on daily to see if there's something that looks really good on the daily chart. And if something looks really good on the daily chart, then I could take a look into it on a smaller time frame if I want to intraday trade it or if I want to do a little swing trade. But I start off looking on the daily chart most of the time to see if I can find something on there. Now, I just looked at USD-CAD, which we've been looking at throughout this course, and we've already drawn all these trend lines and supports. And look at this. I have the USD-CAD that's been trading in this range here for a bit, and right now just dropped and is hanging on the support level here that we've drawn throughout this course in the technical analysis section. And you see, as soon as it dropped here, it just stayed on this support that we have previously drawn. So it looks like a good place to buy if we're trading off technicals, and that's on the daily chart. Now, you could just place a trade on the daily chart and just enter here, have a stop loss a bit lower. But depending on your time frame and what type of trader you want to be, that might be too long of a time frame. For example, if you would have bought here, that would have been beginning of October. And if you would have sold here, you would have sold in beginning of January, which is literally 3 full months here to execute this trade. Now, I'm not saying that's a bad thing because this is a lot of profits from $1.27 all the way up to $1.36. This is huge, right? This is huge. But if you don't want to, wait for such big movements, you want to trade on a shorter time frame. Now, for the purpose of this course, I want to trade on a shorter time frame because I want to finish recording this lecture and upload it. If I input my trades and I have to wait 3 months for them to get executed, this course is never going to be up. So I don't want to trade on this time frame, but you might want to trade on that. So for example, my business has a lot of revenue that comes in from US dollars. And I live in Canada, so I use Canadian dollars. So I'm very aware of USD-CAD fluctuations. And whenever we're, getting at a high level around here, I'm always selling all the USD I have, converting to Canadian. Whenever I'm somewhere low like this, I'm not converting the USD and I'm holding on to it for a bit. So, when you get used to a currency like this, you kind of know the ranges and the zones, when it's cheap, when it's expensive. So at this time, I know that I don't want to exchange a lot of my USD for CAD. I'm leaving it for a bit now. And right now in my trading, I actually think that USD is undervalued to CAD and it should gain more value. Thus, more CADs would be required to exchange for $1 of USD. This being said, I want to buy on the support level. Now, I'm going to look at a different time frame. I'm going to look at a 4-hour chart, but you know what? Sorry. Before looking at a different time frame, now that I have an idea that I want to trade USD CAD, I just want to make sure if there's news or not, real quickly. Okay. So I go on my calendar. Okay. And in my calendar, I see that today, June 10, 2019. Let me take a look here. The only thing where we have, really critical news is on the pound sterling. Okay. Which is not what we're trading. Let me take a look if there's something coming tomorrow. Still only pound sterling. So that's cool. I have no issues getting in a trade on USD CAD today. Now I'm going to look at different time frames. I want to look at the 4-hour charts, which you will see the trend lines and everything that I've drawn. They're still there. And I want to take a look at the 1-hour chart. If I can find something on the hour chart, I'll trade this chart because it's a way tighter range. Okay, and I see here that, okay, if this is going to be my buy, where would I put my stop and where would I put my take profit? I don't want to put it somewhere high here again because it's too far. But I see here that there was a support at this level, and that support broke. And we know what happens when a support breaks, it becomes a resistance. And you see it's around the 134, it's at the 134 level. So at a round number like usual. So I'm just gonna draw a trend line here. Okay, again, you can see that prices, there was resistances here, then it broke, it became a support. Now we broke again, and now we're hanging over here. So what I want to do is I want to get into a long position. I'm going to use this here to just draw it out for me. I want to buy right now at the price it's at now. Okay? And then, and let me zoom in now. Then I want to put my take profit just below this resistance line. Okay, because I think the price can go up, and I actually believe that in the long term, in several months, it might go up all the way up. It might, but I want to do a short-term trade. I want to be in, I want to be out, and then I want to do more trades. So I'm going to put my take profits somewhere around here, because the price might hit this resistance level now and come back down. So what I want to do is get out of it real quickly. So if it comes back down, maybe I buy it again and sell it again, and I trade as much as I can like this. So at about this level is where I will be going out, and this makes about 100, you can see it here, 126 pips in profit. Okay, now the loss, because the most important thing is the loss. That's how we're going to calculate what's the position that we're going to get in, right, based on the loss. So where would I put my stop loss? I could put it somewhere just below this support, and this will give me a big position because it's I'll put it very tight. Like, example, if I put it like this at 32 pips, my position sizing formula will tell me to buy a lot, but I want to make sure that I don't get stopped out. Imagine it just goes down and comes back up right away. I want to make sure I don't get stopped out. So you know what? I'll look here at 132. This is the next support level or round number that I see, and I'll put it just below that. So just below 132. So maybe at 131.96. So maybe the price is just going to break this support level and come here and then come back right away. In case this happens, I want my stop to be far enough that I don't just get stopped out and then the price comes back to me. So this looks good to me. So 72 pip loss potential and 126 pip potential profits. And if I look at it, I'm going to look at it on a 4-hour chart. And this is what it would look like. Entry here, exit here, and stop loss here, which makes sense. You see here at 131, there's also some kind of support here, slash resistance. You can see it here. So it would be a good place to put my stop just below that. All right. So I am confident. And let's actually look at it on a daily chart. You see on a daily chart, I am just doing this mini trade here from this level to here or here for a loss. So little trade. Perfect. Everything makes sense. Now let's see how much of this I should buy. Okay, I have here, and let me put it down. I have my entry price, which will be at the current price, which is 132.67. I have my stop loss, which will be at 131.96, and my take profit, which will be at 133.94. Now, what I need to take is my entry price and my stop loss to calculate my position sizing. Okay, so I'll get the position sizing calculator from here, and I'll enter all the required information to see what's the lot size that I should use. Okay, so account currency is Canadian. That's what I'm trading with. Account size, I put $1,000 Canadian in there, and this is why I'm using this, because I didn't put USD dollars. I put Canadian. I'm not using the Excel sheet because the Excel sheet works only if your account currency and the base currency is the same. In this situation, it's not, because the base currency is USD and my account currency is CAD. So I'm using this website to do my position sizing, which is what I recommend you use as well. Now, risk. I'm risking 2%, right? Risk ratio percentage. Switch to money? No. So it's in percentage. Okay. Stop loss in pips. So I can look at the chart here, and I can use these prices that I've looked at to calculate my how many pips. But I can actually look at it from here. You see that the stop loss is 72 pips away, 72.1 pips away. So I can come here and put it 72.1. Just put 72. That's the same. Currency. So what did we say? We said USD CAD. That's the currency I'm trading. USD, and where's CAD here? Oops. Don't have my glasses. Okay, USD calculate. Here we go. So if I want to use 20 bucks, I should trade this amount, 0.02. Now, it's very close to 0.03, okay? So what I am going to do is I'm just going to round it up to 0.03. Usually, I always recommend rounding it down, because now if I actually lose, I will lose more than $20 because I'm trading more than what I should trade. But since, and let me zoom in here. But since it's so close to 3, I'll just use 0.03. Usually if I had 0.023, 0.025, I would also round it down. But now it's so close that I'll just use that. But just keep in mind that if you do round up slightly, you will lose slightly more than your optimal amount. So I'll use this 0.03. That's how much I'm going to buy. Okay. So I go on my MetaTrader. I know that I want to buy USD CAD right away. I'm in my live account. You can see here. I'll go and see USD CAD. You see that right now it is here. USD CAD is here. Okay, so USD CAD, I'll just open the chart. Okay, and I'm just going to place a market order because I just want to buy it. I know that the current price is the price where I want to buy. So I don't need to place a limit order waiting for it to go to a certain price. I just want to get in. So I'll place a new order. I'll do this by clicking on new order here. And I have here USD CAD, perfect. Volume 0.03 lots. Then I could put simultaneously as I enter my trade. Remember, I can market execution, get it right away. Or I can do pending order, which is a limit order where I place the order and I wait until the price gets somewhere so I can get filled. I'm going market, like I've just said. Simultaneously, as I get filled, I can send my stop loss and my take profit order, which I'll do right now because I know where they are. So let me just open my trading view right now and see here the prices. Okay, so I have my stop loss at 1.3196, like we said, and my take profit at 1.33946. Here we go. Buy market, yes. And I bought my position. So you'll see here that my trade just got executed right away, right? And I have here my buy, which is where I just bought at. I have my take profit here. You see it says TP, and there's this red dotted line. And if I go down here, you see here there's my stop loss. So if the price comes here, I'm going to be taking a loss. If the price goes up here, I'm going to be taking a profit. You can see here at the bottom, you have the buy, 0.03, USD CAD, the price, you have the stop loss, the take profit, and you'll see at the end the profit here, which is I'm losing 30 cents because I just got into the trade, and if I get out, I'm hitting the bid, so losing that. You have your balance, your equity, other numbers down here. You have your exposure now, where it tells me that I'm exposed to CAD, okay, at the moment, and then you have account history, which now, since I haven't closed any trades, there's really nothing here yet. And you have your journal, which will have your trades and all of that stuff. So you can take a look at all of these things here. So what I'll do now is I'll just let this trade play out. It might take a few hours or it might take a few days for it to either reach the stop loss or take profit. When it does that and it reaches either of these points, I'll record another video and I'll put it with this one. So we see how it actually played out. So I'll see you guys when this trade closes. Hey guys, so I'm back here to go over my Loonie trade, so USD CAD. I got filled on my take profit yesterday, so I just want to go over it now to see what happened. So we entered as we were hitting the support level here. which we actually had from the daily chart. And I can zoom out here. So I had this range playing out on the daily chart. We wanted to get in an entry because that's a pretty good entry just on the support level. We didn't want to hold it for the whole move up because we want to do some shorter term trading. So we went on the 4-hour chart and we took the trade there. So we had our take profit at this level and we had our stop loss at this resistance level here. So I got filled on it yesterday. Now let's go over in our MetaTrader account and see how much money we've made on this one. So if I go on MetaTrader, you can see here in account history, I can click on that. And you'll see in account history, I have my, so all my trades are executed now that I've recorded here. And USD CAD, my buy, I bought 0.03 lots. And this was my entry price, my stop loss, and my take profit. And you see here, can I put USD CAD? Well, you can't see the orders anymore because they're executed, but you can see here that it's green. It means that I did my take profit is the one that got triggered, not my stop loss. So I made money on it. And then if I go all the way until the end, here's the amount of profits that I made, which is $37.53. So 37 bucks. That's amazing profit on a trade like this because you got to remember you're trading with $1,000, right? So when you're making $37 on $1,000, that's 3.7% return, right? 37 bucks divided by 1,000 times 100, that gives you 3.7% return. You can imagine that some people invest very long term and they make yearly, 7-8% returns, right? Well, that's 3.7 on one trade, which is amazing, right? Which is really good. So because some people, when they look at this, like, oh, it's only $37. Well, yeah, but the balance was 1,000. So you got to think in terms of percentage, right? So if you're trading with 100,000, right, this would be way bigger. So you got to always think in percentage. It's not because you have a smaller balance, then you got to look at your dollar value and be like, oh, well, it's so small. No. You don't want to take huge risks. I could have doubled my position and bought 0.06. So instead of 2% max loss per trade, I would have put 0.4%. So double. So that would have made me buy double the amount. So I would have made double the amount. But the problem with that is, yes, you make more money, but there is the risk that when you lose more money as well. And as a beginner trader, your objective is going to be to take the least amount of risk possible, right? I tell you, in this business, you do not become successful by taking on more risk than you think you should. It's by taking on less risk. Your main focus is reducing risk. So whatever money you make is good, right? But reduce your risk so you don't lose. You don't lose a big amount. You can lose small amounts. That's part of the game, but you don't lose a big amount. So yeah, that's a very good trade. 3.7% on one trade is extremely good. Okay, that was and you see it really played out how we thought. This was a very big support, and USD CAD is one of my favorite currencies. I've said that before because a lot of my funds come from US dollar sources. So I always time my entries and my exit when I convert my money. So I see it playing it out. So I know that this price was a very low price considering, historically how it's been moving recently. So very good entry, very good exit. And that's a very simple trade that you can do based on support line and resistance lines. Very simple, very straightforward. You calculate how much you want to buy, how much you want to buy based on your risk and where you want to put your stop loss. You enter your trade, you have your stop and your take profit already in there. So you can leave them and you let them play out. You don't need to, stress about it. It plays out. And when it plays out, you can log in and see it in your account. There's nothing more for you to do after placing those orders. So that being said, that was the trade. I'm pretty happy with it. And I'll see you guys in the next lecture. So the next trade here is going to be on Euro USD. I'm scrolling through my currencies here, and I found this pretty solid downtrend on Euro USD. So I have it on the 4-hour chart. And what I'm going to do is I'm actually going to put it on a 1-hour chart so I can see if there's any smaller time frame ranges that I can trade. And again, looks pretty solid here. what I want to do is I want to enter somewhere at the resistance here. So I could place a limit order, but to be honest, where we're at now, we're so close and it already hit the resistance and bounced back off of it. So it might not even come to retest it. It might continue down, or it might, retest it, or it might break up. But since we're so close, I'm just going to get in it right now instead of placing a limit order. I'll just execute it with a market order. Now, where would I put my stop loss? Where would I put my take profit? So stop loss, I could put it somewhere very tight here, right? Or if I want to be less risky, which is what I always like to do, I'll put it above the next round number, somewhere around here, right? You can see here that even at 134, kind of a bit of a support resistance. So I'll put it just above here. Now, as for my take profit, I can see here there's a bunch of other supports. So we have a downtrend, but there's kind of like a triple bottom here. I don't know if you guys can see it. Yeah, we have like a triple bottom. So I wouldn't obviously want to hold until all the way down here, because you see we bounce off of it here, we bounce off here again, and we bounce off here again. And what price is that? This is literally just on the 111, right? So at $1.11, that's where it's at. So my line is not exactly at that price, but you can see here, if I can just move it a bit, it's at 111, okay? Now, that being said, do I want to hold all of this? Again, I'm trading on a 1 hour chart. If I would have traded on the 4 hour or even on a longer term, I might want to hold all of this. But again, for the purpose of this lecture, I want to have very small trades so I can finish them in a few days or in a week. I don't want to hold something for a month in this lecture. So we'll go on the hourly chart. I'll see if there's any other supports that I can buy just above of, because I also want to make some money simultaneously. I want to do a good trade. And you can see here that there's some kind of a support here as well, right? You can see here, and this is at what price? It is at 112. So there's another round number, right? We have prices who bounce off of this. It was a resistance. We broke over it, and we had one bounce off of it. So, there's a likelihood that it bounces off of it. So, you know what? If I'm to get out, and I could have, tried to buy somewhere around here. If I'm to get out and I want a very small trade, this is the closest support, I'll just buy above it. So I'll take my profit here. So this is going to be a short position. I'm going to enter right now. And my take profit here, let's put this all here. My take profit is going to be just above this support, so somewhere around here, which is about 66 pips. And my stop loss is going to be, well, now this looks a little bit far as a stop loss because I'm only making this much profit. If I was to trade, this full range, I would have put my take profit somewhere here and my stop loss somewhere here. And this would have made a lot of sense. 85 pip stop, 192 pip profit, looks pretty good. But now I just want to make a way smaller trade, get out here. So I'll kind of put my stop maybe a bit lower as well. So let's put it somewhere around. The problem here is that there isn't any other resistances. There's no other resistances. The closest resistance is the 114 that I see here. So I'm kind of stuck putting it here. So we'll do this. We'll do a trade where my stop is going to be at 84 pips and my take profit is going to be at 56 pips. Now, ultimately, on this trade, in my way of trading, I do have a lot of longer term trades as well. I really would have wanted to take the full profit here. For the purpose of this course, let's leave it at this. But for you, keep that in mind. Now, this being said, it's a good opportunity to talk about something. A lot of traders, what they do is they say, and when I'm talking about traders, I'm talking about retail traders, people from home, people on YouTube, which don't trade professionally. They think that the only way for you to be successful if your take profit is always twice as much as your stop loss. So example, if you have 100 pip potential loss, then you need to make at least 200 pips in profit. That's not the case, because it doesn't only depend on how much profit and loss you're taking, but the probability that you lose or the probability that you win. So I might have something like this where, yes, if I lose, I'll lose more than if I win, but my odds of winning are so much higher that if I repeat this trade so often, I'm going to win so many times that even when I lose these few times and I lose more, it's okay, because in the long term, I'm making more than I'm losing. So it's not just about how big it is, but the probability that it happens. Anyways, this is going to be the trade. So I already looked at my calendar and I know there's no news on Euro USD. So I'll get my Forex calculator here, my position sizing calculator. And let's see, the currency that of my account is still CAD, $1,000, 2%, that's all good. The pip loss is 84.5, so 84.5. And then what currency am I trading? Euro USD. So let's take a look here. Euro USD. Okay, calculate. And this is the current, what do we have here? Calculate, current, okay, this is for CAD. Okay, so here it is. So 0.018, again, it's so close to 2, I'll round it to 2, 0.02. This is how many lots I'm gonna get. Perfect, so I'll go on my Wanda account here, and I'm going to find my currency, Euro USD. Let's see if it's here, first one. Open chart, and let's zoom in here. Okay, so I know that I want to short right away, so I'll place a new order. Again, it's a market order again, market execution. It's going to be a sell, remember, because we're shorting, we're selling it. Now, my stop loss is going to be higher. It's going to be at what I've put up there, 1.14028. And then my take profit is going to be lower, which is going to be at 1.12528. That's what I put here. Okay. Sell. Oh, not 0.3, sorry, 0.2. I was almost going to make a mistake. So 0.02 lots. Okay. And I'm ready to sell. Click on sell. Good. It's done. And you already see it. I already have my position. I have entered here, and you can see this is my sell. You can see my stop loss is higher. If the price goes up, I'll take my loss. If the price goes down, I'll take my profit. And you can see now I have my two positions here. I have my buy and my sell. This is my long position. This is my short position. And here we go. You can see the profit on each of them, the total profit on both of them. You can see the other numbers. Same thing with this trade as with the other one. I'll let it play out. And once the trade is executed and I'm out of the trade, I'll continue the video and we'll see how this plays out. Hey guys, so I'm back here to go over my trade on the Euro USD currency pair. So we had a order here. We actually, not an order, we got filled right away. If I remember, we sent a market order. We got filled on a short position at this price here. And our take profit was down here and our stop loss was over here. So what happened is the currency pair actually went up. It hit the resistance level that we have here another time and then went down. And I remember I wanted to potentially just put my short order here and try and get a better price, because if I did get a better price, I would have been able to buy short a bit more, and then I would have made more money. But I didn't want to potentially miss it, because this could have just went down right away. So we entered right away here, which is good. Now the price did drop and I got out because I had to take profit here. So I got out at this price. So we'll actually go over it here real quick. I have my MetaTrader account open. And then if you go in account history, you see the trades that were executed. And here is my Euro USD trade, which got executed. I can see the price. I can see the stop price and the limit price. And here's Euro USD. And I can see that the take profit price is green because I got filled on my take profit, not on my stop loss. And how much money I made is $16. Great, right? $16 on a $1,000 account is 1.6% return on only one trade. That's amazing. Imagine having a bunch of trades like that. Pretty cool. Okay. Now, I did get out here. I could have held it longer if I wanted to. So example, you see this very solid downtrend, right? You see it here. So I could have just held, expecting it to go down even further, because there is here a support line here. So I could have potentially tried to make more money. I could have said, look, I want to make this amount of money. And if this trade wasn't for the purpose of this course, I might have done that, because this looks like a very solid downtrend and we might really drop all the way down here. Or you could have even looked at another support. There's another smaller support around this level here, which is right here. So I could have just held a bit longer until here. Really depends on you, but for the purpose of this course, I wanted shorter term trades. So if you want to do short term trades, you tighten a bit how much money you're making and how much money you're losing, and you make more trades like that. So I didn't want to wait, you know, this might take a few days longer. It might take a week longer to reach. And I just want to finish recording this course so I can upload it. So I wanted something tight, and I wanted just, you know, this amount of profit at the nearest support line. I didn't want to, you know, potentially have to go through several supports and it taking longer. Example, if I short here and I wanted to wait all the way down to here, it takes a while, right? But if I want to short here and just want to take a small trade and it's very fast, then I could take that money and use it elsewhere on another trade as well. So it's not necessarily always better to hold longer, but it's not also necessarily better to just have shorter term trades. It really depends on you and how active you want to be and how much time you have to devote to this. You know, if you're doing a 9 to 5 and you're working and you have a family or whatever, then you just want to enter here and put a take profit somewhere further and just make all that money. It takes a while. It takes several days. It takes a week, 2 weeks, but it's cool. You have that time and you have multiple trades simultaneously. So it's not the end of the world. But for our case, we did take a small trade. But even with that small trade, a 1.6% return on a trade is pretty good. So I'm happy with it. And you see, this is a very simple trade. And this is the type of trades I recommend you start trading based on. So based on supports, resistances, something very obvious that you can see on your chart and other people can see. And you gain experience doing simple trades like this. And you know what? Simple trades are often some of the best trades. So that was the Euro USD trade. And I'll see you guys in the next lecture. So the next trade we're going to have is going to be on the Aussie, so Australian dollar USD pair. And if you look at it here, you can see that there's a triangle. I don't know if you can see it right away, but if you can't, with time, you're going to get better at this. So you have like a little downtrend here. Again, resistances becoming lower and lower. So sellers selling at lower and lower prices. And you have the support that was at a robust price, which was at 70 cents. Now, this level broke, and you can see it here. It was here, right? So we had like this descending triangle, okay? And usually with descending triangle, they end up breaking downwards. Sometimes, more often than not, sometimes they break upwards, but you want to wait until the break happens for you to execute a trade. So it broke downward. Now, one thing we could have done is shorted here, and taken the profit at wherever, or waited for a pullback and then shorted here and then taken a profit lower. So this is what the triangle looked like. And again, the support here now becomes the resistance because we broke below it. So we have a resistance here. So our objective is to find a short that we could get into and make money on it continuing in that direction. I'm going to put it on a 1 hour chart again. And let's see if I can find something. Oops, let me just take this off. Okay, so first of all, I don't want to short right here because here is too low. I would like to short somewhere around the resistance. Okay, so in this situation, I'm going to place a limit order to short only if the price goes up to here. Okay, so it might never actually go up. It might just keep going down and I might miss this trade. But a lot of times, this is what's going to happen. You're going to place orders in case the price reaches a certain level, and then if it reaches it, then you get executed on your trade. But often, and sometimes it's not going to get there, and you're just going to cancel your order in a few hours or in a few days or whenever, and then just move on to another trade. So we might never even get filled on that, but we'll try. I want to short somewhere around here. Okay, just below the resistance level. Now, where would I take my loss? Well, I might want to take my loss somewhere just above this resistance level. I could just find a resistance level here. Okay, there are several supports and resistances that I can find, and I can just place my stop below that. But you know what? I want to take the least risk possible, so I'm going to put it a bit far here. Now my take profits, I could just put it at the previous low, but you know what? Here at 69 cents, there's also some kind of support. Let's see here. We have this support here, and then, so I want to make a quick trade. I'll put a take profit right here, just above this support. So at 92 pips lower, and I'll put my stop loss here at 147 pips higher. Now again, you could do different things. Let's put a 4-hour chart just to look at it. You could really play this more risky, and you could put your stop somewhere around here, okay? Because there is also a support/resistance here. See, we bounced off of it again, and it's another semi-round number, so 70 cents and a half. You could put it there, so you could put your stop loss here instead, right? And let's actually see what our position sizing calculator would tell us to buy if we put it here versus if we put our stop loss here. Okay, let's see the difference. Okay, if I put it just above this level, okay, just above this level, I would put it at 58 pips away. Let's see how big of a difference it'll make for us. So I'll get my calculator here. And again, I've already looked at the calendar. There's no news coming out on Aussie, Australian dollar, or USD. So currency CAD 1,002, that's the same thing as we've always did. And then here, the stop loss in pips is going to be 58. That's if I put it at the closer, just above the closest resistance level. So 58 pips. I'll put 58 pips, and the currency is Australian USD. Australian USD. Calculate, it'll tell me to buy 0.026 lots. Okay. Now imagine this. Imagine I would have put my stop loss way further. Instead of 58, I would have put it above, I don't know, here. Just above here. A little bit higher, actually. Just above this resistance level. That's very strong and everybody sees, right? Which would be a good place to put a stop. So let's say just above it, 140. So I could lose 140.7 pips. If I'm willing to lose 140.7 pips, guess what? I can't buy as much, I can't short as much quantity because I'm willing to let it go way further. So if I let it go that further, then I'll lose way more money. So I need to buy less quantity. So if I click calculate, you see now that now the quantity is 0.011. So if I do that and I put my stop there, I'm buying way less. And guess what? If I buy way less, then when I make money, I also don't make a lot of money. Right? I could put my stop right here. And then I'll short a big position. And if I do win, I'll win a lot because my position is big. Or I could put it way further. I'll have to buy a way smaller position because I only want to lose $20 in case I lose. But if I win, I'll win way less because I didn't get as big of a position. So what I always say is don't be greedy. Don't think about the profits. You always want to think about the risk. Okay, you're not going to make it thinking about profits. You're always going to make it when you think about risk and you want to minimize risk. So don't be like, well, okay, well, I'll just take the closest one because the closest one is going to make me the most profit. If it goes my way, that's the wrong way of thinking. And if you think in that way, you'll not make it in the trading. So whenever you don't know between two options, take the less risky option. So this is the one I'm going to take. Oops, sorry, not this one. This is the one I'm going to take. That's what I mean. So this is the one I'm going to take, the 140. So that's it. We're ready to go. Now I'm at 0.011, so I'll round it down to 0.01. And let's execute this trade. So I'll open my MetaTrader here. All right, let me just move this out of the way. I'll open my MetaTrader, and now I want to find my Australian dollar USD. Here we go. And I'm going to open a new chart. I'm going to just zoom in here. And what I want to do is I want to place a short, okay? Now, I don't want to short right away. I only want to short if it reaches 6996. You see here, right? I only want to short if the price reaches, let me put it on a 1 hour chart. I would like to short if the price reaches here. But right now the price is here. I don't want this. I want to short if we reach 0.69973 or 69967, sorry. This is where I want to short. So I'll put a limit order, so if the price goes there, I'll short. Now, let's place this here. I can click on new order, and I'll put here not market execution, but pending order. I want to place a sell limit. So it's not a buy limit. I don't want to buy, I want to short. So a sell limit. And what is the price I would want to sell at? I want to sell if it reaches 0.69967. Is there an expiry? Do I want it to expire in 10 days, 5 days, 20 days? I'm not going to put an expiry because I'm going to closely watch these currencies. But then if you don't look at it too much, you can put it on a whatever expiry. You can have it expire in a few days, in a week, whatever you want. So it's not just there. Now, if I do get triggered and I short, then where is my stop loss? My stop loss is going to be higher. It's going to be at 0.71374. That's what we decided on up there. And then my take profit is going to be lower at 0.69047. Those are the prices we have here and here, right? Here and here. Okay. So everything is in. The quantity, 0.01. I have everything in place. Double check it. Oh, where's my sell? Okay. I don't know what happened with my price here. I'll just put it again. 0.69967. Okay. Here we go. Everything is good. Place. Now, my order is here. You'll see that when I look at it, I have a order to sell here. Sell limit 0.01 here, but the price is lower, so I'm not filled on it yet. And I have a take profit and a stop loss. Now, if the price goes down and I haven't got filled, this is not going to get triggered because I don't even have the position yet. If the price goes up, then I'm going to get triggered here. And then the take profit and stop loss will become active. So if you take a look at my positions here, you see that I have two open positions right now, but this position, the one that I have now, is not opened yet. The other two positions are the one from the previous lectures, my long and my short, but this one is still a sell limit. It's not sell yet. It hasn't been executed yet. And you can see here that the commission and, the profit is, there's nothing yet because I'm not executed in that trade yet. I have to wait until it happens to get executed, until the price gets there for me to get executed. Now, this being said, I'm going to let this play out. I might get filled on it, and then I might take a loss, or I might take a profit. We'll see. Or I might not even get filled on it at all. Either case, I'm going to follow through with it, and we'll see what happens. And I'll come back when things play out. Hey guys, so I'm back to go over my Aussie trade, so the Australian dollar to US dollar currency pair trade. So I had placed a order to short at this level here. Now, I didn't get filled on it because the price just went down. So what I had expected is I expected the price to go up. I get filled on my short order. Then the price doesn't go up further than that because of this resistance level here. And then for the price to go back down and for me to take a profit somewhere around here. Now, this doesn't happen because since the price didn't go up here, I didn't get filled on my order, so I don't have the short position. The price just went down, so I didn't get this trade, right? And I'm happy I didn't get it because I want you to experience or see that this often happens. You often place orders in anticipation of something happening and you potentially getting filled on the order, but then the currency goes in the other direction and you just don't get filled on it. It happens very often. So in this situation, you just cancel it and you move on. Okay. So what I have to do now is just cancel my order. So I open my MetaTrader account And you see here I have my order for the Aussie trade. I have my price, where I want it short. It's a sell limit order, my stop loss, my take profit, everything here. And I can see it here, right? This was the entry price I wanted. Didn't happen because the price kept going down. There's my take profit here and my stop loss, which are both not active because I didn't even get filled on my entry order to begin with. So yeah, it's too late now. I gotta cancel it and move on. Now to cancel this, all I have to do is go at the bottom and click on the X here and to cancel it. Or I can right click and click on modify or delete order and then click on delete order. Now, this isn't actually going to work right now because it's Saturday here. So it's the weekend and the Forex market is closed. So I cannot actually modify my orders as the Forex market is closed. That being said, if I click delete, it'll tell me market is closed. Please, try again later. So I'm going to close it. I'm going to cancel it when the market is open. Now, I did want to cancel this earlier, yesterday, I guess, because I already saw that it wasn't reaching my entry price and it was too late, but I wanted to do this on camera. The thing is, I mostly can only record on weeknights or, weekends because I'm very busy during trading hours during the week. It's a very busy time. That being said, this is going to happen often to you. So if you have a trade like this, if you place an order in anticipation of something doesn't get filled, make sure that when you don't want the trade anymore, you just cancel it. For me, when the price reached my take profit, and not only that, it didn't bounce off of this support level. Well, I guess, now looking at it, you have another support here, right? Touch this level 3 times, right? So you can have another one here. But I was like, okay, this is over. I don't want this trade anymore. And I'm going to move on to something else. So you just cancel it, okay? Because some people they just leave their orders open and they forget about them, and you have a bunch of orders open and you get filled on things you don't want anymore. So you got to be quick with just canceling orders for things that didn't play out and moving on. So for this trade here, we actually didn't even get a trade. It just didn't happen and we move on. So this is it for this trade, and I'll see you guys in the next lecture. So the next trade we're going to do is going to be on the Canadian versus the Singapore dollar currency pair. So I'm looking at this pair here, and what we're going to be using is going to be the RSI, so the relative strength indicator. Now, usually when I use the RSI and I'm using the 70 and 30 level, I like to look at the daily chart, but since I want to do a shorter term time frame, I actually want to make sure that whatever I'm looking at is going over the 80 level, not just the 70 level. So again, whenever you're using RSI or any indicator, based on the time frame you're using, you want to test out different things. You want to look at it historically, how it works, and make sure that it's working for the time frame that you're using. So when I'm trading on smaller time frames, and I sometimes trade on 15-minute candles, right? It depends. But for this situation, I'm going to use a 4-hour candle here. The shorter time frame I go, the bigger I would like the RSI to be to get a trade, okay? So in this case, what I want to look at is I want to make sure that the RSI goes over the 80 level or under the 20 level instead of using the 30 and 70 level. Now, I want it to peak there, but then after it peaks, I also want it to come back below, not the 80 and 20 level, but the 70 or 30 level. For example, here, I went over here, right? I went over the 70 level. I didn't go over the 80 level. And then I went back down. Do I want a short? No. What I want is I want situations where I actually go over the 80 level, like here, right? I went over the 80 level. Then I want to wait until it gets below the 70 level. Then I short here. And here would have been a perfect short. Or same situation, if it drops, here it dropped. I don't want to wait until it just gets the 30 level. I want to make sure it hits the 20 level. And then after it hits the 20 level, I want to wait until it breaks over the 30 level and then I buy. And then this again would have been a really good long. So all these little trades here below the 30, I don't want them. I want to make sure it goes all the way down to 20 and then goes over 30. And same thing up here. I don't want all these RSIs that went over 70. I want to make sure they went over 80 and then came back down over 70. So in this case now, I'm looking at it, and I can see that historically this worked. And this is like some type of backtesting that you can do visually. Just look at something and see historically how would have it played out. Go back in time and look at it and make sure it would have worked well on that currency pair, on that time frame before implementing your trades. Right? So on a longer time frame, you might do it a bit differently. On a shorter time frame, a bit differently as well. Now here, I'm looking at it, and right now, this currency pair, or the RSI for this currency pair, went over 80. So that's great. Now, I don't want to short right now. I want to wait until it goes below 70. Now, what am I going to do? I don't know what price it will be at when the RSI goes below 70. I don't know that. It might be, the price could be whatever, right? And I don't know when that will happen. So what I'm going to do is I'm going to place an alert. And this is something you can do through TradingView. I'm going to right click here and on the RSI, and I'm going to click on add alert on RSI. And then this is going to pop up. Okay, well, I have the RSI closed. So I want TradingView to alert me when the RSI line crosses the 70 line. And when that happens, I want to get a notification, and I'm going to go into my MetaTrader and I'm going to place my trade, because then at whatever price it's going to be at, I know the RSI crossed below, and I'm going to get into my short. I'm going to do my calculations at that time for the stop loss, take profit, and I'm going to get into my short. Okay. So this is going to happen sooner or later. The RSI is going to cross below, and sooner or later I'm going to get in. I just don't know when. So what I'll do is I'll check RSI crossing the value. Which value? 70. Right? Because when I clicked I clicked wherever, so it was 75, but here's 70. Options, once per bar close, once per minute. Okay, options, the alert will only trigger once and will not be replaced. So that's what I want. Expiration dates, I'm going to give it, I don't know, a week. Okay, it's probably going to happen very shortly, but put it a week. Or you can put it open-ended, it never expires. When do I want to get alerted? Or how do I want to get alerted? Notify on the app, okay. Show pop-up, okay. Or you can send email. You can also actually receive SMS, a text message, okay. You can have it play a sound, or you can send SMS. So you can actually get a text message, okay. But I'll just leave it at that. And my computer is right next to me, so I'll hear the beep when it pops up. And that's it. I have the message that I would receive by email and by pop-up, that the relative strength index crossing 70 on this currency, and that's it. I click create, and then I have my alert. Now, you have all your alerts here, okay? So you can have, I have a bunch of alerts on different things, lots on Bitcoin here, but you have your alerts right here, and when that alert is triggered, it won't show up here anymore. But if ever you want to remove some of the alerts you've had previously, you can just click on the X and just remove these alerts. Otherwise, they'll remain here until they either expire or they get triggered. Now, you'll also see a line here on your alerts. So you'll see it on your chart as well. This is why TradingView is pretty nice, because you can add lots of alerts on your indicators, not just on the prices. And when something specific happens with an indicator, then you'll get alerted and then you can place your trade. So for this one, we'll wait until I get this alert. When I get it, I'll sign back in, I'll record entering this position, and we'll see how this one plays out. Hey guys, so we're now about 16 hours later after I had put this alert for Canadian dollar, Singapore dollar currency pair. Now, I was a bit busy, so I missed it. I don't want to say I missed it, but you see here, I got the alert for the RSI crossing below the 70 line, but I was busy doing something, so I didn't want to enter the trade without recording my entry, and I'm only available now to record it. So anyways, here I am recording my entry, but I could have got it a bit earlier since, you know, as soon as it crossed this point, I should have entered. As soon as it crossed. So I would have been able to get maybe at this price. But again, I was busy. That's okay. But usually when you're trading, as soon as you get the alert, log in. You can log in from your cell phone and enter. You know, it's just me. I need to record it, so I couldn't do that. That being said, I'll still get in now. It's at a worse price, but the trade is still active, so I'll get in. But usually I would have really wanted to get it right away. So let's get in now. I'll get in at the current price. It's a short position, so I'm entering here. I'll put my stop loss at just below this. You can see here there's some type of resistance, and it's at 103. So I'll put it just above 103. So maybe 103.00. If I could put it 001. Okay, 005. Just as close as I can put it. Okay. And then my take profit, I don't know where my take profit is going to be because my take profit isn't based on price. Oops. It's not based on the price here, but it's based on the RSI. So I'll explain to you in a bit how I'm going to get out. Let's just get into the position quickly because we've already missed a big part of it. So let's just calculate how much we need, and then I'll explain to you my take profits. Okay, so let me get this here, and I'll actually move this out of the way. So currency is CAD, $1,000. Account size, 2%. Stop loss, I have it set up here. Let's see in pips how much it is. Oops, no, I don't want any more alerts. I have about 13.05, and that gives me, where's my entry price? Okay, so the current price the price keeps dropping. Okay, so let's see if we can get it now. Okay, 13.03. Okay, I don't know why it's not showing. I'll just calculate it real quick here. So my entry price is going to be my stop loss is going to be 1.03003, and my entry price is going to be 1.02546. Okay, so that's going to be how many pips? 45.7. That's how many pips I'm going to be risking. So I'll put 45.7, and we have the currency pair CAD. Where's CAD Singapore? CAD Singapore. Okay, so on this website, they actually don't have that currency pair there. CAD Singapore dollar. So you know what? I'll just use my Excel sheet. And we can use my Excel sheet because my currency is Canadian dollar, and here the base currency is CAD. So we can use my Excel sheet to do that, and we'll get the right value, no problem. So 1,000 here, 2 margin, that's okay. CAD Singapore dollar, entry price, which we've had it here. I'll just put 1.02542. Let me get this. 1.02542, and then that's my entry price. It's going to be a short position. My stop loss is going to be 1.03003. So here 46. Okay, so 46 pips max loss, and it tells me that the amount I would want would be 0.045449. So I'll round it down to 0.04, and this is how much I'll be risking to lose. So that's okay. So 0.04. I'm going to open Oanda, and here's my Oanda, and I want to get CAD Singapore dollar. It's not here, so I gotta add it. I'll right click, I click on symbols, and I'll see where I can find Singapore here, CAD Singapore. Now, it's here. I could just add this whole group, or I could add currency by currency. You know what I'll do? I'll just add the whole group. I'll show this whole group. So now all of these currencies will show up here. I'm going to put them in order of, can I put them in this order? I can put them in this order, but you know what? I can see it just here. CAD Singapore dollar. So I'll just open this chart, and you see, I could have really got it way earlier here, but it is what it is. So I'm going to enter right away at market. Now enter here, new order, 0.04. and I'm going to market execution. I'm going to add a stop loss to it, but not the take profit, and the stop loss is going to be at 1.03003. Everything is good. Sell market. And here we go. So right now, and you see this is my fourth potential trade here. I had already inputted one, which I'm now in profit in. The other one, which I'm still not in profit in, and then this one that I just entered right now. Okay, and the fourth one, the other one before that, which was just an order, still hasn't got filled yet, so it's still open there. Now I have my 3 open positions and 1 open order to get into my 4th position from the other lecture. Okay, I'm in. So now let's have some explanation. It would have been great if I was able to get in earlier, because if I was able to get in, let's say here, then I would have been able to get a way better position. So a way bigger position, because my stop loss would have been tighter. So I would have been able to get more loss. Like if I got it here, I probably would have been able to get 0.04 instead of 0.08 instead of 0.04, so double. And then I would have already been in the money so much because it would have went my way this much. So it does make a big impact timing your entry. But again, this is for the course, so it's hard to have time to record this midday. That being said, when am I getting out? So how do I get out on this? I get out based on the RSI. So looking at this, I usually want to get in when it crosses the 70 line, and then I want to get out. Some people are going to be like, okay, well, I'll get out when it gets to the 30 line below. So, okay, I'm getting in when something was overbought and then stopped being overbought. And then when it becomes oversold, then I get out of it. Well, I don't want to do that because this is too far. Because a lot of times you'll see, let's say in this situation, let's see what happened here. We broke over the 80 line. We broke over the 80 line. Then we broke under the 70, and here we want to, well, in this case it did hit the bottom line, so it would have been good. But you'll see that in a lot of cases we don't hit the oversold line, okay, the 30 line. Now sometimes people are going to be like, okay, well, I'm going to get in as soon as it touches this line, so the 70 line, and I'm going to get out at the midpoint, at the 50. I find that too soon. So what I usually do, and it depends on the currency and it depends on, I guess, the time frame that we're trading, but I would put somewhere around the 40 or 45 line. So here, this is the 40 line. I will put it here, right? And when the currency touches the 40 line, I'm like, okay, you know what? It's time to get out, because yes, it's not sold yet, but I don't want to be so greedy to wait until it becomes oversold. I just want to make some money, and when the currency becomes a bit oversold, so just below the 50 line, so in this case at the 40, I'm going to get out. And if it was the inverse, if it was a long position, I just would have inversed everything. I would have bought when it came from down. So let's say, oops, I would have bought if it touched the 20 line, came over the 30, I would have bought here. So if it touched below the 20 and then it went over the 30, then I would have bought here and I would have got out at the 60 line. That's it, if it was a long position. But since it's a short, I'm going to get out here. Now, when will I know that this happened? Well, all I have to do is right click on it, add alert on trend line, and then when would I want to get alerted? Well, when the RSI crosses the trend line. That's it. Super simple. And how do I want to get notified? In these same ways. Create alert. That's it. I can now go be on my day, do whatever I'm doing, and whenever this touches it, I'm going to get alerted. Now, this is important because I don't know what the price of this currency is going to be, because it depends on the next candles. Depending if they're green candles, red candles, I might get out somewhere here, or I might get out somewhere here or here. It depends on how the candles are going to look like, the value of the RSI. But until the RSI hits this, or I hit my stop loss, I'm not getting out. So it might be a lot of money, it might be a loss, I don't know. But I don't know where my profit is going to be and if I will have a profit. And because of this, I have to put the alert, and I can't put the profit price on MetaTrader 4 as long as it has been played out. So it's important for you to have the alert on your phone, and when you get the alert, you can just log in from your phone and execute your trade and cancel this other order. I can just put my take profit order and take this out. Now, when I get the trade, if I'm busy, I'm not going to get out of it because I want to get out of it on camera. So I might, get a worse price again, but it's not the end of the world because, again, it's for the course. So, yeah, I'll let it play out. I'll go back and do whatever I was doing now. And whenever I have my profit or stop loss, I'll come back and I'll keep recording this video. Hey guys, so it's the middle of the day here, and I just got an alert on my phone that said the RSI has crossed below the line that I had drawn here. Now, as soon as that happened, I wanted to close the trade, but I remembered that I have to record this. So it was a few minutes ago and I was able to get here on a computer, but it can't stay for long. So I'm just going to record myself closing this trade. And then after the day finishes, I'll record, going over the trade exactly. But yeah, that's it. So I got the alert that you see the RSI here just crossed below this line. You see, since my entry, it actually went up a bit, stayed there for a bit, went down, up, and then dropped. And the RSI, you see, the reason why the RSI now is lower is because these red candles, these last two red candles are actually bigger than these previous green candles. But if I had smaller red candles, the RSI would have stayed here. And if I had one big red candle and lots of one big green candle and lots of mini red candles, well, the RSI might have been high and I would have still been at the same price or the same profit. So really the RSI isn't going to tell you how much profit you've made. The RSI could have been low and I could have been losing money or making way more money, depending on the series of candles that happened. But yeah, that said, here we are, two big red candles, and that made the RSI drop. Now I'm starting to get into an oversold place. Oversold starts at 30 all the way down, all the way below that. But I want to get out. I don't want to hold any longer because that's my strategy. I don't want to be greedy. So I'll log into Wanda here, and I'm actually out of my two other trades. And what I'll do here is I'll see I have my CAD Singapore dollar pair, and I have entered at this price level, and I have my stop loss here. I didn't have a take profit because that was based on the RSI, but what I'll do is I'll just close this trade. Now I can close it by entering new trade and closing it, or I can just come here and where I have my position, just click on the X. So I've made $12.6, which is pretty good for this very quick trade. And I'll just click X. It'll tell me, do you accept? Because I'm just closing it. I'll say yes, and that's it. My trade is going to be executed. Here we go. Okay, perfect. Now, what else do I want to say, or do I want to say this after? One quick note that I want to say, because if you don't want to trade based on an indicator because your take profit isn't set and you're going to be busy all day, which it doesn't take a lot of time to get out of this trade. You have your phone, you have MetaTrader on your phone. You can, if you're working, you can just go in and close the trade or whatever it is. It's not that intensive. For me, it's because I have to record it, but it's actually not that intensive. But if you don't want to have any trades where you have to be available whenever you get the alert, you can just do the trades where you can send your take profit and stop loss ahead of time. That way you don't worry about getting an alert and having to implement the trade. Otherwise, if you're really interested on doing trades where your exit or your entry is based on an indicator, not just on price, so you have to be there when that indicator triggers, well, what you could do through MetaTrader is code your strategy within it. And if you code your strategy within it, it can all be automated, 100% of it. So a strategy like this, we can automate it. I'll actually develop another course on how to fully automate Forex strategies, where you can have a strategy like this one or like another that would be fully automated, entries, exits, and you just do the coding, you tweak it a bit, and it rolls for you. So that'll do at another point. So that being said, I think this is pretty much all I have to say about this trade. It's a pretty good and straightforward trade here. We made $11.6 on $1,000 balance, which is 1.1% return on a quick trade like this. Is pretty good because, you can have plenty of these trades running simultaneously. So pretty good trade. And yeah, that's the RSI trade. If you have any comments about it, put it down in the Q&A section, and I'll see you guys in the next lecture. So in this lecture, what I want us to do is go over our live trades, see how much money we've made, and input this information in our historical trades Excel sheet that I provided to you, so we can keep track of our performance. And this is a habit that you have to keep, okay? Is always record your trades and go over them. Now, you don't need to use my Excel sheet. You can do it whatever way you want, I've always developed my own things. Before, I used to put them on paper, then I put them in Excel, then I did some calculations. I've always, had my way of doing it. So you can do it whatever way you want, right? This is just an option that I provide to you. But, keep it as a habit. Always record your trades and do it often. Do it as often as you can. If you want to do it every day, do it every day. If you want to do it every week, do it every week. So what I'll do is I'll go here in my MetaTrader, and I'll go in my account history where there is the results for the previous trades. And I'll just put this on the side here. So I'll have them here. And then I'm going to put my Excel sheet on this side. So what do I have to do? I got to put date, account size, side, and P&L. So I'll put the date. I have the date here. The date is 06/10/2019, right? I have it right here, 06/10/2019. Account size, my account size was $1,000. When I did all these three trades, I did them simultaneously. It was $1,000. And what was the side for this trade? I can see here buy, so it's a long trade. And the P&L is 37.53. Here we go. That's it. Second trade in the list that I did is on the same day, 06/10/2019. My account size 1,000. And then this one was a short. So it's a sell here. I see it. So it's a short trade. And the P&L is 16.07. So here it is, sell. Now the third trade I did was also a sell. I did that on the next day. So I actually did it in the same day. I sent my order on the same day, but it was a limit order and it got executed on the second day, right? So I believe so. Okay, I can't remember anymore, but yeah, I believe so. I sent it, or this one was the one with the RSI maybe. Sorry, I trade so much that I often forget. This one was probably the one with the RSI, so I had an alert set up. Yeah, I had an alert set up, and then when I got the alert on my phone, I logged in and I entered the trade. That's true. Okay, so that one was 06/11/2019. Account size was still 1,000 because that's when I had initiated to enter that trade. It's a short position as well, short, and then P&L on that was 12.45. And you see, this is the return I made for each of these trades. 3.7, 1.6, 1.2. Now, this really sucks because I really wanted to have a losing trade so I can show what it shows on here. And again, this is all 3 trades is not enough to have anything realistic. I could have had 3 losing trades, or I could have had 3 winning trades. The reason I have them all winning is not because I'm good or because I'm bad. It's just because that's not enough results to actually show you anything. Just 3 is not enough. I really could have just had 3 losing ones. Even though I'm a good trader, I could have 3 losing ones, or I could have had 3 winning ones, because 3 is just really not enough. So that being said, I wished one of them was negative. So we show on the Excel sheet. But anyways, when you're trading, you really want to accumulate a lot of trades before coming to a conclusion that you're either good or bad, or that you need to learn, or that you need to change things. Make sure you're getting more trades than that. Okay. So that being said, if we go over it here, then some things are going to start populating. Here, my total P&L, $66. My long trades, I did 37 on my long trades, 28 on my shorts. Total return here, for all of them. Then for the longs, for the shorts, I have my average per trade. Well, here my average per short trade is 1.43 because I have 2 trades. So this is divided by 2. My batting average is at 100% because I have no losing trades. So again, it sucks that we don't have one. So we don't see all this information here. My cumulative return, again, there's not a lot on there because it's just one day. But you can see here as well, I have my long, my shorts, and my total. And then my shorts on the next day, I had 1 trade. And then I have my cumulative for the shorts, my cumulative for the longs, and my cumulative total. And then I have other stuff here. So my average return. Then I have my longs. The standard deviation is giving you an error here because I don't have any losing trades. So I need losing trades before even calculating these things. So these things are not good because I don't have enough trades for them to be meaningful. So I'm not going to look at them yet. And again, like I've said, you want to have something like at least 30 trades. And that's 3-0 before you come to any conclusions. So yeah, make it a habit. And now if I go here back on my account and I look at my balance, and yeah, before I look at that, something that you're going to realize is that there's going to be some fees here that you are charged or you make. These are called swap fees that you either get paid or you get charged. So there's going to be a negative or a positive. They're very small for now, and swaps are outside of the scope of this course. I'm going to go over them in the advanced course, but for now, you can read about them if you want, but they're very negligible for the type of trading that you're doing for now. There's other types of trading that can be based on this, but it's more advanced, so I'm not going to go over it here. It'll be in the advanced course. But yeah, this being said, this is the profit we made. If I go back on my account, you'll see that now in my account, I have $1,065.86. So my account grew. So I have a bigger account right now, right? So whenever I'm trading going forward, I'm trading with more money. So if I'm going to place a trade today, and you don't need to change this all the time, like every day, but maybe every week or every month if you're trading longer term, I can change this here and say I have $1,065. So right now, or I can even be more precise and put even the cents if I want. Why not? And 86 cents. So right now, if I want to risk 2% of my account, well, 2% is now $21.32, not just $20. And then next time I trade, let's say I'm trading today, which we are, what date are we? We're the 15th. If I'm placing another trade today, well, what is my account size? Well, my account size is 1,065. Sorry, 1,065, right? I'll even put this. That's my account size. So then if I have another trade, let's say I do this exact same trade. I short something and I make 12.45. Well, 12.45, now that I have a bigger account, is not 1.25%. It's smaller. It's a smaller percentage return. So as your account grows, if you make the same percentage return, you're going to make more dollars, right? So it's pretty nice. The account is growing already. And, so the total account growth is 6.6. Again, here it doesn't take into account the finance fees that I just showed, the swap fees, but those are very small, right? So it's not the end of the world. But, about 6.5% return, 6.6% return on street trades. That's amazing. You are going to have some losing trades though, and losing trades do have an impact on your account, right? Because it wipes out some of your gains. So it really has an impact. So make sure that when you are trading, you're accumulating lots of trades, about 30, and then looking over your results. Make sure that you have a habit to look over your results. And again, remember that our max loss per trade is 2%. So even if I lose 3 trades in a row right now, I'll still be positive because I've made more than 6%. And this is why you have to cap your max loss. So even if you have bad trades in a row, you're never losing more than 2% on any trade, but sometimes you're making more than 2% on a trade here, you see? So yeah, keep it a habit. You already have this Excel sheet. It was provided in other lectures. And that's it for this lecture. And I'll see you guys in the next one. Hey guys, and welcome to the most important section of this course, which is the section on trading psychology. Now, the reason why I say it's the most important section is because even if you know everything else, if your mental game is not strong enough, when the time comes, you will not apply the things you know already, right? So you have to be very strong mentally and understand yourself and understand how the situations that you're going to face are going to affect you, because whenever you're faced with situations where you can make a lot of money or lose a lot of money, emotions get the best of you. And we know that when there's emotion, logic is not always there. So this is a very important section. Now, this section is the same regardless if you're trading stocks, currencies, cryptocurrencies, whatever. So the next few lectures I have here in this section are actually the same lectures that I have in my stock trading course. So I took these videos as is and I put them here. The reason why is because it's the exact same thing. So I just don't want to repeat myself. It's the exact same content. So I just took the videos as is. I've put them here. Trading psychology really applies to everything that you're trading, regardless if it's stocks or something completely different. So just a heads up, because the videos will seem a little bit different. I might look a little bit different because I recorded them a while back. Now, if you've already done my stock trading course, you don't need to go over these lectures in this section because you have already seen them. But otherwise, this is a really important section. So make sure to go over these lectures. Now, even if you did my stock trading course before, I actually would recommend re-going over it, because if there is a section that you should go over more than once, it's the section on trading psychology, because as I've said, it is the most important one. So without any further ado, I'll see you guys in the next lecture. Hey guys, welcome back to our Foundation Stock Trading course. In this chapter, we're going to be talking about trading psychology. In this lecture specifically, we'll just be covering the importance of psychology. In the future lectures, we're going to talk about loss aversion, endowment effect, status quo bias, anchoring effect, confirmation bias. So these are all biases that humans have and that affect us when we're trading whatever product there is to trade. We're also going to talk about genes and instincts and how that affects us. And then at the end, we're going to cover misconceptions about trading psychology and ways to improve on your psychology. So that being said, let's get into it. So trading psychology, why is it so important? Okay, why is trading psychology so important? Everybody knows it plays a major role in your success as a trader. You never hear anybody, failing at trading because, they weren't good enough at technical analysis, or they weren't good enough at, fundamental reading the news or whatever. It always comes down to them not being able to handle their emotions, right? Not being able to take their loss, not being able to take their profits. It always comes down to them doing something that they know they shouldn't have done, right? And why would they do something like that? Basically just because they're not able to handle the stress, the emotions, and everything that goes on in those times. So that being said, how important is trading psychology, right? Because you have a lot of things you can look at. You have risk management, money management, technical analysis, fundamental analysis, macro news, a bunch of different things. How much time should you take to get good at, trading psychology or handling your emotions, right? For me, trading psychology is honestly one of the most important aspects in trading. Now, is it more important than risk management, technical analysis, having a solid strategy? Yes, absolutely. Because if you can't handle your emotions, no matter how good your strategy is, no matter how strong your risk management is and technical analysis, you're not going to follow it. You're not going to follow your rules because you're not going to be able to do what's right when the time comes. So, if your psychology, if your emotions aren't in check, nothing else matters. No matter what, no matter how good you're at it, you're not going to be able, to follow your rules and do what you should do, right? So for that being said, psychology is by far the most important aspect in trading. And thus it should, you should give it the time it deserves, right? Now, obviously, when I'm giving a course like this, I can't spend 50% of the time talking about psychology because it's not a psychology course. And the thing with psychology is it's a little bit different for everybody. So whatever affects somebody might not affect somebody else the same, right? So it's really dependent on you. Now that being said, even though I believe it accounts for more than 50% of, your success as a trader, I can't put up 50% of the course on it, but you should focus a lot on psychology. And again, that's one of the most that's one of the reasons why a lot of people struggle with trading psychology and handling their emotions, is because they don't give it the time it deserves to learn it and to get good at it, right? I see a lot of traders, they have a bad day and you'll see them brushing up on some technical analysis, reading a new book on money management, risk management, or whatever it is that they think they're lacking on. And I ask them, well, don't you already know all the technical analysis you need to? Don't you already know how to do money management and risk management? So if you lost money today or this week, maybe it wasn't because of your technical analysis skills or your risk management. Maybe it's because you couldn't handle your emotions and you didn't do what you know you should do, at that time. So maybe you should brush up on, how do you handle your emotions, how to behave right under stress, how to behave logically under stress, right? Because we all know that when you have a lot of emotions, you don't act right. You're not rational, and that's why a lot of people tell you, don't make hasty decisions, or don't make decisions when your emotional weight and think, and then the next day make your decisions. Well, the reason why they say that is, again, emotions make you completely irrational. So when you're trading and you're playing with money, right, you can either win or lose a lot of money. Don't you think that brings in a lot of emotions? Obviously it does. Money is synonym for being able, to feed your family, have shelter, everything that matters to us as humans, right? So obviously it brings a lot of emotion with it. Now, the problem with that is you usually don't know when you're struggling with your emotions, right? You don't know that. So you might lose money in a week and think it's because you're not good enough at analyzing stocks, but you are. It's just you're not good enough at handling your emotions and doing what you set out to do, following your rules, taking your losses when you have to, because your emotions were too strong, right? We all know somebody who goes to the casino, loses $100, and he just goes and he takes out more money until he blows it all, because he can't handle the emotions. So that being said, it's extremely important that you give it the time it deserves, okay? And throughout this chapter, we're going to be talking about ways to improve on it, because again, a lot of people just think, well, they're good, they can handle the emotions, and they're good. Let me just read on technical analysis. Let me read on that. But no, you're not. The bottom line is you're not. Nobody is. It takes time to work on this, and it's super important aspect in trading. So that being said, I'll see you guys in the next lecture. In this lecture, we're going to be talking about loss aversion. So what is loss aversion? Loss aversion is actually one of the multiple biases that we're going to be looking at. And when I'm talking about biases, I'm just talking about human behaviors that affect us, in this case negatively, when we're trading. And these biases that we all have and we all share to a certain degree are the ones that I've seen throughout my career have affected most traders and have affected me the most. And that I was able to really become more successful when I was able to control those biases and really understand them. And obviously, before you're able to watch out for something or know that you have a certain bias, then first of all you have to know about it, right? You got to know about it, and then once you know about it, you're going to start realizing that you have this certain type of behavior that doesn't really make sense, and then you can start changing it. So that being said, let's get into it. Loss aversion is the first one. It's one of the most important ones, actually. What is loss aversion? Loss aversion is a theory that states that losses have a bigger negative impact than equivalent gains have positive impact. And this theory says that it's about twice as much more negative. So what does that mean? It means basically that if I'm telling you, hey, let's play this game. Okay, imagine I come up with a game and I'll tell you, let's play this game. Let's play head or tails. And we're going to play head or tails for $5,000. Would you play with me?
Probably not, right? Why? You have a 50% chance of making money, 50% chance of losing money, and it's the same amount of money, right? So it's a zero-sum game. There's no loss, there's no gain. But for you, you perceive that the gain, the loss, losing $5,000, as being way much more painful than the possibility of making $5,000. So you don't perceive the gains and losses to be equivalent. You perceive losses of equivalent amount to be way worse than gaining that same amount, right? So let's say if I Google loss aversion, okay, so the definition would be in economics and decision theory, right? Which this is super important because that's mainly what we're going to be doing, decision theory, right? Loss aversion refers to people's tendency to prefer avoiding losses to acquiring equivalent gains. It's better to not lose $5 than to find $5, right? Some studies have suggested that losses are twice as powerful psychologically as gains. Now, to further develop on this, I'm going to look at a study here. Most of the studies that I'm going to be referencing in this chapter are going to be from this study, this report. So this is the anomalies, the endowment effect, loss aversion, and status quo bias by Daniel Kahneman, Jack L. Netcher, and Richard H. Thaler from the Journal of Economic Perspectives, winter 1991. So a lot of these biases that I've looked at, I actually, looked at through reading multiple studies like this one, and I've read over 30 different studies in the sort, and these are the ones that really stood out the most, and these are the ones that come out the most, right? So it's not like I believe that they're important, but they're tough to find, or not everybody knows about them. These biases are widely known and widely studied, and in economics and in decision theory, so they are very important. So we're going above, the simple, greed and fear model. There's biases that are specific and that, you can target and change, right? So in one of the studies that was cited here for the loss aversion, what they wanted to do is to prove, okay, that there is a certain loss aversion, and that we do feel that a loss is way worse than an equivalent gain. And what they've realized is that loss aversion is always based on a reference point. It's always based on where you're at right now. So they actually came out. Let me get this rolling here. Oh, let me get this up. Okay, so let's see here. Okay, so what they did is they actually took a group of people, and they told them, okay, look, you have a job right now. Okay, this is your current job. And in your current job, the contact that you have with other people, okay, contact with other people is kind of isolated, right? And your commute time, the time it takes, your commute time is about 10 minutes. Okay, so it takes you about 10 minutes to get to work. Okay, now we're gonna give you two different choices, two different jobs that you can choose from. Job A, which is gonna have a limited contact with other. So you see, it's better than being isolated, but it's gonna have a 20-minute commute time, right? And then we're gonna give you another job, another option, which is gonna be called Job D. Job D is moderately social, right? So better than this one and better than the other one. but this job will take you 60 minutes to get there. Now, which one would you prefer? Which job would you want to go to? Okay, this is your current job, and now we're giving you two options. And I'll let you decide which one would you prefer. Would you like to go from this job to job A, which is going to have better contact with humans, so more contact, but it's going to be worse on commute time? Or are you going to go to job D, which has way better contact with others, but way worse commute times? So probably you, like most of the people, have selected this one, right? Job A. You've selected probably job A. Okay, so most people selected job A. So what they've done next, okay, because that doesn't really prove anything. What they've done next is they've said, okay, well, we're gonna come out with a different reference model, okay, reference point. So this is your reference point. This is where you start off. That was your current job. Well, imagine your current job wasn't isolated, but it was. It has very pleasant, very social, and had 80 minutes of commute time. So if you had these, okay, now which one would you have selected? Would you have selected job A, which is worst on the contact with others, so you go from very social to just limited, but it's gonna be way better on commute time? Or are you gonna go to job D, which is, a bit worse? So here you go from very social environment to a limited environment or a social environment. So in either case, you're losing on the contact that you're getting with others. On commute time, you're gaining in either case. So which one would you prefer, job A or job D? Now what they've realized and what the test has proven, right? What the respondents have actually said is that they preferred job D. So they preferred going from a very social environment and a 80-minute commute time to an environment that's social and 60-minute commute time. They were not willing to go to something extremely limited in contact with others. So even though it's the same two jobs, people chose differently. Okay, people chose differently. And why is that? Why did they choose a different outcome based on where they started, based on their reference point? It's because basically they were looking at what they're losing on, right? You can see that the choices that made them choose, the reason that made them choose which job was what they're losing on. So in the first scenario, when they were isolated and they had 10 minutes commute time, what were they looking at to make their choice of job A? They weren't looking at the fact that they could have a better contact, better social environment. What they cared about is that they were losing on commute time and they didn't want to lose too much. So they decided to choose the job where they lost the least, right? Where they were losing the least on commute time, because they were losing on commute time, right? You're in the first scenario, isolated contact with others and 10-minute commute time. Well, people are like, okay, well, I can't go and start making 60-minute commutes. I was only doing 10. This is the max I can do, 20 minutes commute. And I'm having better contact, but whatever. This is what I'm focusing on, what I'm losing on. Because what you lose on counts way much more than what you gain on, right? And when they changed the scenario and you started off in a scenario where it's very social and 80-minute commute time, they weren't looking at like, oh, I can go from 80 minutes to 20 minutes. I wanted that. They didn't even look at the commute time. They were looking at what they're losing on. They're like, okay, I'm going from an environment that's very social to something that's limited. No, I can't do that. Okay, I'll at least go to something that's just social. So they were making their decision based on what they were losing on. And basically that's because whatever you're losing on is what impacts you the most. You feel way more when you're giving up something than when you're gaining something. Okay, and that has a very strong liaison with trading, because people always view trading or their losses as way worse than their gains. And I'm gonna get back to that. Now, in the same journal, they've done another study, and this study was by Visicus and Magat and Hubert. And it's where what they've done is that they documented similar effects in a more realistic setting. Their respondents were recruited at a shopping mall. So they went to a shopping mall in a hardware store. The respondents were shown a can of fictitious insecticide. Okay? A can of fictitious insecticide. And were asked to examine it for use. The current price of the can was said to be $10. So I had this can here. Okay? This is insecticide. And it's $10. Okay? Use your imagination. Now, the respondents were informed that all insecticides can cause injuries if misused, including inhalation and skin poisoning. And in households with young children, child poisoning replaced skin poisoning. Now, the current risk level was said to be 15 injuries. So 15 injuries over 10,000 bottles. So for every 10,000 bottles sold, there would be 15 injuries. Respondents were asked to state their willingness to pay to eliminate or reduce the risk. So how much were you willing to pay to reduce this risk, right? This is the risk we have here. How much are you willing to pay to eliminate or reduce this risk? Now, in household without children, the mean willingness to pay to eliminate both risks was so willingness to pay to eliminate the risk was $3.78. So people were willing to pay on top of the $10, $3.78 to have a risk of 0 over 10,000. So just eliminate that risk completely. The respondents were also asked to state the price reduction they would require to accept an increase of 1 over 10,000, right? So to have a total of, instead of having 15 over 10,000, to have a total of 16 over 10,000, right? How much would they accept, right? What's their willingness to accept to have an additional 1 over 10,000 risk, right? How much can we give you as a rebate of that $10 price tag? Now, the respondents were asked to state the price reduction, blah, 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 in each of the two risks. The results were dramatic. 77% of respondents, okay, that's 77%, a huge amount, okay, in this condition said they would refuse to buy the product at any positive price, meaning they would refuse to buy this product at all, okay, at all, for any positive price, okay, even if you give it to them for a cent, they wouldn't take it if you increase the risk by 1, right, which makes absolutely no sense. Makes absolutely no mathematical sense, because if they're willing to pay $3.78 only, right? They're not willing to pay infinite amount of money. They're not willing to pay $1,000. They're willing to pay $3.78 to reduce the risk by 15. Then how come just for 1, they're not willing to get, a few dollars or $5? So it makes no sense. So you can see that losing is perceived so much more negatively than gaining, okay? And they say the striking difference between willingness to accept and willingness to pay in these studies probably reflect the large difference in the responsibility cost associated with voluntary assumption of additional risk, in contrast to a mere failure to reduce or eliminate existing risk. Which again comes out a lot in trading, right? You can have 1,000 shares in a stock, and the stock is plummeting, and then I'll tell one of the traders, well, okay, this doesn't look like a good position, you should get out of it, reduce your risk to 0, and be like, no, I'm sure it's gonna go up, or whatever. I'll tell them, okay, well, buy another 1,000 shares, buy another 500 shares, and tell me, no, I don't want any more. Well, why? Isn't it a good trade? Why wouldn't you want any more? So, there's always this fear of losing or taking more risk than just removing the risk you're holding. And they say again here, the asymmetry reflects both blame and regret after a mishap, and the anticipation of blame and regret in turn could affect your behavior. So when you're in this situation and you're given an option to pay to reduce your risk, which you give it maybe it's $3.78 to reduce all 15 over 10,000 risk, or get paid to take an additional one risk, and you're literally not accepting that at all for any price, which again doesn't make sense. But it's because you're anticipating, or you're fearful of this happening, and then you feeling regret and feeling blame, right? So blaming yourself and regretting is something that you don't want to feel, to a point that just anticipating having those feelings is really bothersome, right? And because of that, it makes you take risk or bets that are not very good for you, right? So in this situation, this does not make sense. You willing to pay $3.78 to reduce that, but not willing to take any money to increase it. So I'd obviously increase my risk for if I can increase it by one for $5, for sure I'll take that. For sure I'll increase it by $5, get it half price for just one additional risk. If that was what I was willing to pay to eliminate all that risk, then for sure that's how much I would be increasing it by. So how this affects our trading, right? How would it affect our trading? Well, it affects our trading in a bunch of different ways. First of all, when you have a gain, and a lot of people have been in this situation before, where they buy a stock, and let's say they buy it at $10, it goes all the way up to 20, and then drops back to 15, right? So maybe they invested $10,000. So in this situation, they were up 10,000. But once the stock dropped all the way back to 15, they're only up $5,000, okay? In both situations, they're up money. They're making money. But once they get out of their position here and they bank $5,000 in profit, they're not happy, because they now assume that their reference point is here. That's where they were. So for them, it's like they lost $5,000. And they're not looking at the fact that they made $5,000. Or they know that they made $5,000, but the loss of that $5,000 weighs way much more on them than that particular gain, right? So then they become unhappy, and they don't take their profit. It's not a loss, it's actually a profit. They don't take their profit because they have so much pain, or they feel so sad or regretful and emotional about that position that they have now from that reference point, that they're unable to make the right decision and take their loss. So what you need to understand is losses will seem bigger to you, and they'll feel way worse than similar gains. But that's just a human bias that we all have. We have this bias where losing something is so much painful, way more than gaining it. But if you let that emotion take control of you in trading, you're never going to make the right trades, because you're not going to be mathematically, correct in your trades. Meaning that a loss will seem bigger to you than it actually is, and a gain won't seem as big to you than it actually is, which is going to skew all your trades, because you're going to want to make way bigger trades to fail, to compensate for the losing trades that you've gotten, and that could be a major problem in your risk management and taking your losses and not taking your losses. So I think that covers a bit loss aversion. We're going to get back to loss aversion in some of the other biases, because you're going to see that they actually feed a lot off of each other. So that being said, I'll see you guys in the next lecture. In this lecture, we're going to be talking about endowment effect. Now, what is the endowment effect? This is another one of the biases that we're going to be covering. The endowment effect is a theory that states that we place more value on something that we own than if we didn't own it. So we place more value on something merely because we own it. So it's basically saying, whatever you have, whatever you own, your bag, your binder, you place more value on it than if you didn't own it. So if you didn't own that bag, you wouldn't think it's as worthily as it is to you now than if you own it, right? So whatever you own, you actually place more value on it. Your clothes, your cell phone, your computer, whatever, anything that you own, you place more value on it than if you didn't own it. Okay, so if you had the opportunity to buy that same thing off of somebody else, you wouldn't place as much value on it. And if we actually just Google here, endowment effect, in psychology and behavioral economics, the endowment effect, also known as divestiture aversion and related to the mere ownership effect in social psychology, is the hypothesis that people ascribe more value to things merely because they own them. And you're going to see how that impacts a lot of our trading. So I'm going to quote a few studies that were done on this particular bias. And again, it's in the same article that I've read from in the previous lecture. So in one of these studies, what they've done is actually they went in an economics class, so in an advanced economic class, right? So not your regular people, so people that are quite smart, and they decided to do a study on those on the students of that class. What they've done, and let me just get this up here. All right, here we go. So what they've done is they split the class in two. Okay, they had the full class. They split the class in half. Okay, so you have a bunch of people here, a bunch of people here, and what they did is that they gave half of the class some mugs. Okay, they gave them some mugs. Okay, and the other half of the class, they didn't get anything. Now these mugs are mugs that are sold at the school's supply store. Everybody knows about them. They're nothing special. And then what they did is they asked to half of the class that got the mugs, okay, how much they were willing to accept for these mugs, right? How much were they willing to accept to sell these mugs? And for the other people who didn't get a mug, they asked them, how much are you willing to pay for these mugs? Now there was a staggering difference. The mug owners, let's say, were willing to sell them for about $6, and the people who didn't own them were somewhere around $2.50, somewhere around that range. Okay, maybe not the exact prices, but it was about 2 times difference. So then what they said is, well, maybe that has to do with bargaining habits, because we know that humans have bargaining habits, and when they want to sell something, they usually overprice it because they know they're going to bargain down. And when they want to buy something, they usually put a lower price because they're going to bargain up. So they said, okay, well, we're going to introduce a market. So this is going to be a market, and people can buy and sell from one another, right? And we know that when there's a market, there's an open market, we eliminate bargaining habits and we actually figure out the actual price. After they introduced this market where people were allowed to buy and sell from one another, what they realized is that the buyers were now willing to buy at $2.75, and the sellers were at $5.25. So even though it did have an impact, on the willingness to accept and willingness to pay, there was still a difference of about, the price being twice as much, right? For the same mug. So the ratio was about twice as much. So basically that was telling them that these people who have the mugs they're willing to sell them at twice as much the price than the people who don't have them. Why is that? Is it just because they own it that they're valuing this more? So they decided to do something else. They decided to say, okay, well, look, we have the buyers, okay? We have the sellers who can sell. We're going to introduce another group. So they went into another class and they did the same experiment, but they had other people who were the choosers. Now, we know that the buyers don't have a mug. The sellers were given a mug. Now, what they did is they said, okay, we're going to go at every price increment. So let's say $1, and we're going to ask the buyers, hey, would you want to buy a mug for $1 or not? Okay. And if they say yes, well, okay. The sellers, we would ask them, would you want to sell your mug for $1 or not? And they might say, okay, well, no, we don't want to sell it for $1. The choosers will ask them, do you want to get the money or the mug? And they have a choice. They can say, I want the mug, or I want the money. Okay, they can choose. And then we'll go $2. For the buyers, are you willing to buy the mug at $2? For the sellers, you're willing to sell your mug at $2. And the chooser, which one would you choose? And they did all of that, 3, 4, at every price range. And what they realized is, the people who didn't have a mug, the buyers, were willing, the maximum, the average price that they were willing to buy at was about $3. That's where for them, okay, I'm not willing to buy that mug at any price above that. The sellers, again, were somewhere between $5 and $6. That's where they were willing to sell their mug for that money. Now, who would we expect the choosers to act like, right? The choosers are in the same situation as the sellers, right? Because they can choose between the mug or the money. Same thing as the sellers. The buyers can't. The buyers have money, but they can buy the mug or not, right? They're allowed to buy the mug or not allowed to buy the mug. But the sellers have the mug and they can exchange the mug for money at any time. The choosers can choose between the mug or the money at any time, right? So we would, since they're in similar situations, we'd expect them to have a similar outcome, right? But what actually happened is that the choosers chose something extremely similar than the buyers. So they were behaving exactly like the buyers, even though they were in the same situation as the choosers, right? So how come the choosers decided to take money over the mug at $3, and that is the same price that the buyers were willing to pay for the mug, right? That's the point of where they changed their what they wanted to do. But the sellers that have the mug weren't willing to sell it at 3 or 4 or 5. They were only willing to sell it at somewhere around 6. Well, because the sellers actually own the mug. Like, the only difference that differentiates the choosers from the sellers, because they're in the same situations, is the fact that the sellers have the mug in their possession. So they own the mug. They have it on them. And because they have it on them, they're valuing it more. Right? So that was the experiment that they've used to explain and to show that actually just owning something, the fact of owning something, then not owning it, affects your behavior. Okay? And you value something more just because you own it. Because again, if you're in a situation, somebody else is in the same situation but just doesn't own it physically, it's not on him, he doesn't make the same decision as you. So that really explains, the endowment effect. And there's a bunch of different studies by, different authors, and they all come out with the same conclusion, that endowment effect is based on the fact of you owning something. And again, whatever you own, right, you value it more, right? Whatever it is, if it's a t-shirt, if it's a sweater that you like, whatever it is, you value it more than if you wouldn't have owned it, right? And the problem with that is the longer you own something, the more you actually value it, right? And that's why when you're in a relationship, the longer you're in a relationship, the more you value that relationship. The shorter, the less meaningful it is. It is to you. There's less attachment. So you actually value something more than it actually is when you own it, right? So then they started to think, well, why is it that they value it more, right? Do they value it more because they actually perceive that it's better? Well, what is the reason behind that? So they actually did another study, and let me read it up here. A recent study by Lowenstein and Kahneman investigated this issue. Half the students in a class were given pens. The others were given a token redeemable for an unspecified gift. All participants were then asked to rank the attractiveness of 6 gifts under consideration as prices in subsequent experiments. So basically what they did is they gave them something very similar than this, right? Something very similar. And in the end, they asked them to rate the attractiveness of that product. So they gave them a survey where they could rate that mug. Okay, can you please rate that mug for us? Tell us how you perceive that mug. And what they realized is that the owners rated the mug in the same way that the non-owners rated it. So they didn't perceive that the mug is better. It's not because they owned it that they thought it was better. And what that actually led the researchers to is that it's not the fact that they perceive that whatever it is they have is better because they own it. It's that they perceive the loss associated with giving it up to be way bigger than it actually is. And that's what loss aversion is about. When you lose something, it feels way worse than when you gain it. And loss aversion is highly correlated with the endowment effect. So when you have something, the fear of losing it, or losing it, is you feel that it's so much more painful than when you gained it, right? And this is what they say. This suggests that the main effect of endowment is not to enhance the appeal of the goods one own, only the pain of giving it up, right? So when you're endowed with something, when you own something, it's not like you perceive it as being better than it is. It's just that the pain associated with giving it up is so big that you value it more. And this has an extremely big impact on our trading, right? It has an extremely big impact on our trading because once you get into a position, once you have a stock, you're instantly endowed. You instantly have this bias that affects you, where you value it more than it actually is, right? It's not worth as much as you think it is. You think it is worth as much just because you own it, right? And it's not because it enhances your appeal, but because you're scared, or the fear of losing it, not having it. You think that that would have a super strong negative emotion with it, right? Not having it. So if you buy a stock and then you're in doubt with it because you have it, you don't want to get rid of it because you have this fear of, if I get rid of it and it continues going up, and then I did it, I got out of it at the wrong time, then you're gonna feel these emotions of pain and regret and blame. So you don't want to feel those. So then you keep holding on to it, right? So that's the endowment effect. And there's a bunch of traders that they have a stock, they'll buy a stock somewhere here, the stock tumbles down, it's going down, and you tell them, okay, well, are you gonna get rid of it? No, I don't want to get rid of it. It's probably gonna go up. Okay, well, where are you gonna get rid of it? Okay, here, goes here, keeps holding it. Are you gonna get rid of it? No, soon, no. And then you ask them, well, just get rid of it, okay? sell it, take your loss, and I'll come back in 10 minutes and buy it back in 10 minutes. Just get rid of it for 10 minutes and buy it back. Okay, they'll sell it, and 10 minutes later I'll get back to them and tell them, okay, buy it again. And they'll be like, no, actually I don't want it. It's not as good anymore. So just the fact that you don't own a stock changes completely your behavior and your decision making. As soon as you own it, you have to understand that, this bias is going to be there. You're only human. So it is going to affect you, and you're going to feel that whatever you're having, you're going to be endowed with it. You're going to feel it's worth way more than it is. Again, not because you think it's better now, but because you have, this fear of losing it. All right, that this pain of giving it up. There's a pain of giving it up because you're always scared that you might miss on an opportunity of you not being in it. This is something you want to watch out for all the time. As soon as you buy a stock, know that your decision making has changed because you're in that stock. And that's why your decision making has to be put on paper, and you got to have a trading plan, in a sense that you have to follow that trading plan to the point, to the note, because once you're in the position, you can't trust yourself to make the right decisions if you don't have something systematic written on paper that you are going to do. And we're going to cover that in the next course when we're talking about trading plans. But that being said, that should do it for this bias, and we're going to cover another one in the next lecture. In this lecture, we're going to be talking about status quo bias. Now, what is the status quo bias? The status quo bias says that we prefer staying in our current situation or state rather than changing our situation or state. So if we actually Google it, let's put it up here. Status quo bias. Okay. Status quo bias is an emotional bias, a preference for the current state of affairs. The current baseline or status quo, right? And you've heard that before, is taken as a reference point, and any change from that baseline is perceived as a loss. So this is what the status quo bias says. Now, there's been a bunch of studies on it, a bunch of studies, and they've all proven that we have this bias. It is within us, and you know that because you've probably felt that before, where you don't like change. You know that people dislike change. It's hard for them to change. They like being where they're at, and this is just a bias that's within us. It is part of us humans to behave that way. Now, that being said, how did they figure that out? So in most studies, what they've done is that they selected groups and they put them in a current situation, or they gave them a current product, a mug or a pen or whatever it is, and asked them, would you like to change to that other product or that other situation? And you realize that most of the time people wouldn't change. They would stay with whatever situation they were left in. And then they took different groups and they asked them to choose. And I could basically say, okay, well, if I took 100 people, put 50 on Instagram and 50 on Facebook, and tell them, well, would you like to choose platform or remain where you're at? Most of them will remain. They're not going to change. But if I had taken all 100 people and asked them to choose for themselves, it might be that 80% of people would go in a certain direction than the other. And that's what the tests proved. So they took a bunch of people, asked them to choose something, and most people would choose something. But then when they decided for people didn't change. They would stay where they were placed. And what they actually realized is that the more choices you give people, then the stronger the status quo bias becomes. So if there was only two choices, then there is still a likelihood that somebody says, okay, well, you know what? I prefer being there or having that product instead of this product. But then if they have 20, 50 different options, then it becomes way harder for them to change, and they'd rather stay where they're at, right? And the question was then, why is it we behave that way, right? Is it that we really like, our current situation. We don't, we love it. We don't want anything else. No. The reason why we like to remain in our current state is because we actually fear losing what we have. We don't wanna give up having what we have, right? So it comes back to loss aversion, right? It's another one of the biases we've looked at, where when you lose something, the perceived pain of that loss is so big that you don't want to lose it. So most people want to remain where they're at, not because they're fearful of going somewhere else, but because they're fearful of losing what they currently have. Now in trading, that affects us enormously, right? Because you buy a stock, and most people are gonna want to remain in that stock and not deviate and not buy something else and just stay in their position. And it's understandable because you have 8,000 different options, 8,000 different stocks you can choose from. So it becomes extremely hard for you to get out of that status quo. So you can have somebody who buys a stock, let's say at this price. The stock is dropping. That person holds it. The stock is not moving, fluctuates, and he's been holding it for months and months and months. How would that make sense? Why would you be in that stock when it hasn't been going your way, when you have 8,000 different stocks to choose from? There's a bunch of other opportunities there. You're just carrying dead money that way, right? You have to jump out of this and jump into another one of them. But no, people are going to remain in it because they think that soon enough it's going to turn around and it's going to make them money. So it's not that they like this stock a lot. It's just that they're fearful of not being in it, going out of it, and then the stock goes up, and then they're going to feel, pain and regrets and blame and all of these emotions that they don't want to feel, right? So in order to avoid feeling these emotions, right, what they do is they just stay in the stock. They stay in the same position. And they end up holding it for so long and not making money or even losing money, right? Just because they couldn't change their situations, change the product, and just get out of this one, get into something else. Again, it's not really, well, I don't want to say it's not their fault, but it's human behavior, right? These are biases that exist, they exist and they're well documented. You can read about them. And they affect us in a way that they make us behave that way, right? They make us behave in a way where we'll hold something that's not going for us for months or years, instead of just saying, okay, well, I was wrong. Let me get into something else. And, not be affected so much by this, this bias and, loss aversion as well and all of that. So you have to be careful with it. You have to realize that we all have this bias, the status quo bias, and that when we're in a certain situation or we have a certain product, we like to remain in that situation or with that product, and we have a hard time changing. So you have to push yourself, to get out of that zone, get out of your comfort zone, and be willing to change what you have. And one of the things that I tell my traders to do is, in their strategy and in their trading plan, okay, and again, trading plan, we'll do that in the next course, they have to put a timeline on how long they can hold something, right? They gotta have a timeline on it. So they could say my max holding period is gonna be 10 days or 1 month or whatever. After that amount of time, they have to get out of their position. They have no choice. They have to follow their rules. They have to get out of their position. And this rule is basically put there to kind of eliminate that bias. Otherwise, you're going to find yourself holding things for far too long, and you're going to be missing out on way more opportunities than you risk on losing in this one. So that being said, that should cover this bias. Again, if you feel that you need to learn more about these biases, there's a bunch of articles and studies that have been written there. about them. So you can just Google them. You'll find so much information about them. And the more you read about them, the more it's going to make sense to you, and the easier it is going to be for you to actually break out of these biases. So that being said, I'll see you in the next lecture. Welcome back. In this lecture, we're going to be talking about anchoring effect. So what is the anchoring effect? The theory behind it states that we anchor to the first decision or information when making subsequent decisions. What does that mean? So let's actually get the Google definition. Anchoring effects. So anchoring effects is a cognitive bias that describes the common human tendency, right? That's the biases we're looking at. Common human tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. During decision making, anchoring occurs when individuals use an initial piece of information to make subsequent judgments, right? So this is something that, again, it's another tendency that all humans have. And this is something that there's a bunch of studies on it. You can Google it, where they actually test how we anchor to specific pieces of information. And, I'm not going to go through the specific studies, but I actually advise you to do so because it's pretty interesting. But we actually do that. We anchor to the first piece of information or the first decision we've made. Now, this is very troublesome when it gets to trading because it really does affect our trading. So if you had the stock, right? Let's say stock ABC, okay? And you believe, you've read some news on it. There's some news that came out that says that this company is coming out with a new drug, okay, that might cure a specific type of cancer, okay? And everything's looking good on it. Reports are saying it's good. Clinical trials are saying it's good. And you get in. Okay, you buy here. Now you expect the stock to go up, right? But the stock doesn't. It starts fluctuating. And then there's news that, the CEO sold some shares. But then you still believe that, this is good. They're coming out with this drug and this drug is going to work. And then there's some reports of some patients where, it didn't work on them, but then you still believe that, it is going to go up because this new drug is going to work. And then, it comes out that, they fired a few employees, so they're cutting down. Again, all negative signs stipulating that maybe that this drug isn't, the clinical trials aren't going so good and it might not be released, but you're anchoring to that first piece of information. You're still anchoring to the first piece of information that you see. And this is something that everybody does. You get in a stock for a specific reason. Then with time, things change. Other things happen. But people anchor to that first piece of information and they overweigh it, right? They overweigh that this first piece of information where maybe they had good clinical trials, right? And they overweigh it, they give it more importance. And what happens is that they actually underweigh new information that comes out, right? When new information comes out, they underweigh it, they disregard it, they don't give it as much importance because they're still biased, they're still anchored to that first decision that they made, right? And again, this is something, since it happens so much, I let my traders know, right? When you make a decision about buying or selling a stock, then every single other new information that comes out that has an impact on what you think can happen, you have to evaluate it fairly, right? And you have to forget about your first anchor and value it based on what is going on now, and completely forget, the main reason that you're in it if there's other reasons that come in. So you give them a fair value, a fair chance to compete on your decision making with your previously used anchor. Okay, so this is again one of the multiple biases that exist, and it is one of the important biases as well. But But I think that pretty much covers this one. It's a quick video. Honestly, it's a quick bias. If you want to read more about it online, there's a bunch of articles that you can find and studies. You can read the full research on it. And that should be good for that one. So that being said, we have still a few more to see, which we're going to cover in the next lecture. So I'm going to see you guys in the next one. Welcome back, guys. In this lecture, we're going to be talking about confirmation bias. Now, what is confirmation bias? Confirmation bias theory states that we search for information that confirms our beliefs. So let's actually Google that real quick. There we go. So, confirmation bias. Definition. I do not have a definition. Definition. Oh. Okay. So confirmation bias. Let's actually find something better here. The tendency to interpret new evidence as confirmation to one's existing beliefs or theories. Right? So this is the tendency to interpret new evidence as confirmation of one's existing beliefs or theories. Right? Let's see, in trading, did that have it? Investopedia has one. A psychological phenomenon that explains why people tend to seek out information that confirms their existing opinions and overlook or ignore information that refutes their beliefs. Okay? So that is what confirmation bias means. So, that being said, confirmation bias is going to be basically you, okay? Imagine you go online and you search for why milk is bad for you. Then what are you actually doing right now? You're actually trying to find reasons to confirm your belief. You believe that milk isn't good for you, so therefore you go out there and look for information that confirms that. This is not an appropriate way to seek information, right? Or to challenge you challenge your beliefs, right? So if you believe that milk is bad for you, what you should actually be doing is go and look for a reason why it's good for you. So the inverse of what you think. So most people are going to go online, search why is milk bad for you, and obviously, what are they going to find? Reasons why milk is bad for you, right? If I open a page right now, if I go on Google and I write why is milk bad for you, right? What am I going to find? I'm going to find a bunch of websites. Milk is bad for you. Milk and debunking the why milk is bad for you and for your bones. 11 reasons why milk is bad for you. 12 frightening facts about milk. Is milk bad for you? What 30 studies have said. 7 reasons milk is bad for you. So everything I'm going to find is going to tell me that milk is bad for you because that's what I looked for. So this is really the main thing with confirmation bias. You know, a vegetarian going online and looking why meat is unhealthy. You're going to find reasons why it's unhealthy, obviously, because that's what you looked for. So what you are supposed to do is go look for reasons that contradict your belief. So if I want to cut out milk, instead of finding reasons why milk is bad for me, I should go and find reasons why milk is actually good for me. Because then if I find reasons that contradict my belief, then maybe my belief is wrong. And that's, the process that you should be following. Now, this greatly affects our trading because you can look at a stock, okay? And most people, you just glance at a stock, glance at a chart, and you already kind of have an idea or a belief about where it should go. You believe it should go up or should go down. And this is very dangerous because once you have that belief, then confirmation bias is going to make you find reasons that support that belief, right? So if I look at a chart and it looks good, right? Imagine I open a chart here. Let's take this off. Imagine I open a chart. Let me turn this on. There we go. Imagine I open a chart and I see this stock that's constantly going up, And just by looking at it, I feel that it could keep going up. So what do I do at that point? I go online and I try to find reasons to buy it because I believe it's going to go up. The problem with trading is you can find reasons to support a buy, and you can find reasons to support a short at any given time. And you can find hundreds of reasons, right? There's so many indicators, there's so many ratios you could look at. So at any given time, you can find a reason to buy or to short a stock. So if you're looking for a reason to buy a stock, look, you're going to find a bunch of reasons. So the idea is to not have a belief and then try and prove it, right? It's to have a belief and try and contradict that belief. If you think a stock is going to go up, find reasons why it shouldn't go up to see if you can actually find any. And if you can find some, then you're wrong in having that belief, right? And because if you just go on trying to support that belief, you are going to find reasons that support it, right? Now, the other problem with confirmation bias is not only does it affect our belief in where we value information differently, but we actually, so the first pieces of information that we see where that tell us, okay, we think the stock is going up, every other information that comes after that, we don't give it as much value as the first piece of information that gave us this belief, right? And that's where anchoring effect also ties in with confirmation biases, where the first piece of information kind of gives us that belief, and then we get stuck, and then we try and find more reasons to support our belief, and we discredit, reasons that don't support our belief, which what we should be doing is giving more weight to what discredits our belief and less weight to what supports our belief. And this is, again, if you decide to become a vegetarian and for you that seems healthy, well, whenever you're reading information about that or new studies come out about that, you should give less value to the information that supports your belief, because that's already your belief, okay? So you have to understand that you're already giving it more weight than you should be, right? And information that discredits your belief, that says that, not eating meat is unhealthy, well, you should give more value to that information, because that's going against your belief. Thus, you're not valuing it as much as you should. So this is really something that's extremely important in trading. Again, most of the times people are going to look at a stock and they're already going to want to have a belief about if they think it's going up or down. And based on that belief, then they're going to go and seek information to buy and sell, which you should extremely watch out for that, because what you want to be doing is looking at the information objectively and based on that information, building your belief, right? And if new information comes out that discredits your belief, then you should change beliefs, right? And not continue to, find more reasons or discredit those reasons, and actually give them a fair shot at your decision making. So that pretty much sums it up for confirmation bias. In the next lecture, we're gonna follow a few more points about psychology. So I'll see you guys in the next one.
Welcome back, guys. In this lecture, we're going to be talking about genes and instincts. Now, we've talked about all the biases that humans have and how these biases negatively affect us in our trading. All these biases have been, widely studied and accepted by economists and psychologists. The thing is, why do we have these biases that affect us so negatively and make it almost impossible for us to be successful in trading and stop us from reaching our success, right? It makes it so damn hard. Why do we have these biases? Now, again, the psychology part of trading has been something that's been very interesting to me. So I've dived in it for a long time. I've read about it because I saw the correlation between the more I understood about it and my level of success. The more I understood about it and the more I understood myself, the more I was able to, cut losses and generate more profits. So
basically my question was, okay, I know I have all these biases, but why do I have them? And that brought me to this conclusion. So this is a bit of my theory. So obviously take it with a grain of salt, but this is my theory on how we came about, to have all these biases. So this is basically it. The way I see it is we all have instincts, right? We have instincts to behave in a certain type of way. If you have a cat, if it falls off a high ground, it has the instinct to turn around and land on its feet. A baby, when it needs something to eat or drink, it has the instinct of crying because it knows it's going to get somebody's attention, right? You have a bunch of different animals. Sharks, they're born, and as soon as they're born, they're on their own. They know that they need to hunt. They know what to do without anybody really telling them, right? So there's these instincts, right? And these instincts actually come from our genes, right? So the instincts, they come from our genes. So we actually, information is passed through genes, and you can learn through your genes. So the problem with that is it takes a lot of time to learn through your genes, right? So basically, this brings us to evolution, right? So through evolution, information is passed on, and offsprings of people share the same type of genes as their parents, right? And that's what brings us to survival of the fittest, right? So survival of the fittest means that it doesn't necessarily mean, a lot of people have a misconception of what it means. They think it means that the strongest survive, but it's not necessarily that. Survival of the fittest actually means the survival of whoever is capable to survive in that environment, right? So if you had the traits that were good for that environment, you would survive. Example. Let's say giraffes, which is one of the simplest examples. And excuse my drawing, I'm a mathematician and not an artist. So imagine you have a giraffe. This is going to be the weirdest giraffe ever. You have a bunch of giraffes, and giraffes all had, small necks. Their necks weren't as long as the ones we have now. But some giraffes were born with a longer neck. Okay. By chance. Why? Because when people mate or animals mate, sometimes there's a genetic, how would you call that? There's a genetic mutation, and one of the babies can have something a little bit weird, right? It happens. Now, the thing is, these infants, and for example, this giraffe that was born with a longer neck was better able to survive because it could reach higher in the tree and eat from parts of the trees that were still there, right? Because maybe everybody had eaten the lower part, right? So they were better able to survive. And because they were able to survive, they were able to mate with other giraffes, okay? And have babies that also had long necks, right? So giraffes had longer necks, not because they needed to evolve their necks to be able to reach and survive in that environment. Not because the longer neck you have, the stronger you are. No, it was really just by luck. You had genetic mutation. Somebody's born with a specific mutation, but that mutation was good to survive in that environment. And because of that, they survived. They were able to reproduce and give their genes to their offspring, right? Same thing with, let's say, bears, right? Bears were all brown, but then you had one bear who was born white, and that bear was better able to hide in the snow and camouflage, so it was better able to survive, and thus it was able to reproduce and give its genes to its children. So its children had genes that had this white chromosome, and then they gave it to their children. So it wasn't really that white bears were stronger or anything like that. It just happened to be that they were better suited for that environment. Now it's the same thing with humans, right? Humans, we've been on Earth for 200,000 years. Okay. So this is a timeline of 200,000 years. And when I'm saying on Earth for 200,000 years, I'm not talking as monkeys. We're talking about Homo sapien, right? Or Homo sapiens sapien, one of probably sapiens sapien, the first one. Okay, so we're still like cavemen, right? Now, this is how long we've been on Earth. When you're looking at this timeline, the people that lived 200,000 years ago, right? Actually, let's say, yeah, this is minus 200,000. Okay. Minus 200,000. And this is going to be the present. People who used to live there, they were in a completely different environment, right? Their environment was completely different. They were constantly being attacked by wild animals. You constantly had to hunt for your food. You had to find shelter. It was not the same environment as we have now. Now, the people who were able to survive in that environment had specific traits, right? The people who survived in that environment were not people who tried new things. Because if you tried new things and got out of your comfort zone, you might probably get killed. They weren't people who were risk takers and going out in the wild and venturing out, because you'd get killed. People who were like that died. They didn't give their genes to their children, right? And again, if you think about all the biases that we looked at, let's say the status quo bias. So somebody back then that had this status quo bias, who liked staying where they're at, doesn't like change, well, he would survive. Somebody who liked change, who liked leaving the camp and going in the woods, liked doing something different, they probably die, and they didn't give anything to their offsprings. Now, let's say another bias, like the endowment effect. So if you're endowed with something, if you have this feeling where when you have something, you value it more, you don't give it away, you don't want to lose it, well, our ancestors that had that feeling, they survived because they didn't give their things away. They kept it for themselves. Somebody who just gave his food away, gave his gear, his stones or whatever, they didn't survive. So they didn't give us their genes. So all these biases that we've looked at, and you can correlate all of them back to that environment, they were extremely good to survive in that environment. They were very good. Having loss aversion, feeling that when you lose something, it's way worse than when you gain something. That's good for them because they didn't want to lose anything that they had, and they felt people who didn't mind losing their stuff. Well, they all died. We don't have their genes. We only have the genes of the ones who have those feelings that we just looked at, right? So we have the feelings of these guys, right? We have their genes. Now, genes evolved through time, and they change through time, but they're extremely slow to change, right? So we have the best genes and the strongest algorithms. So let's say when you're looking at Google, for example, let's say we're looking at Google's facial recognition. Google's facial recognition is going to be extremely good, but if I put some sunglasses on, I trick it. It's not going to notice me anymore. If you take a 1-year-old kid, he knows it's you. If you put glasses on, he's still going to know it's you. Why? Because the eyes of a human is the best facial recognition algorithm that exists, because it's been millions of years of evolution that brought that, right? Now, the problem with that, the algorithm is amazing, but it's slow to change. So we have extremely strong algorithms in terms of the way we think, but they're still stuck for that environment, right? Because when you look at this time chart, it was only 5,000 years ago. Okay, it was only 5,000 years ago that we had the first civilization, so people living together, and it was only 200 years ago, okay, that we had in the industrialization, right? So people working in industries. So that being said, and now us sitting on desk working on computer, that's like just super recent. The problem with this is that we're in a new environment, right? We're in a new environment, an environment where there's no tigers running behind you. We have our house. We can go sleep in a warm bed. We have social security. We're good. Right? But we still have these same genes and emotions and waves of behavior as our ancestors that were in a completely different environment. And the problem when you're trading, is that you're playing with money, right? And money represents shelter, represents, status. It represents being able to reproduce, again, having enough money to cater to kids and having a family. Being able to have food, right? So the same things that were scary back then, shelter, producing food, all of this stuff, when you play with big amounts of money, you get the same feeling as somebody back then, felt when he didn't have enough food, or when there was, a tiger running behind him, right? So you're feeling the same type of feelings that somebody would feel there, and that's showing the same, fight or flight responses and the same types of feelings that you would get, right? Again, we have the same biases as the people who survived that environment. That's why we have these biases. Again, that's my belief. So really, the way I view it is our environment is different and we're not suited for that environment. And this is why so many people fail at trading, because our brain isn't wired to trade. Our brain isn't wired to sit on a desk for 7 hours a day and look at a screen, and when we're losing or making money, which again can be viewed as losing food, shelter, or being, chased by a wild animal, to act rationally and think rationally, right? We have certain type of biases that we, got accustomed to, and our ancestors that had them were able to give us, that we're kind of stuck with. And going against your genes and what you learned through your genes and your instincts is extremely hard. And this is why a lot of people struggle with it. But once you actually learn and you give your mind the chance to learn new ways of behaving faced with these circumstances, and you see the profit, then it becomes way easier to change. But you have to trust yourself to go against your instincts and what you feel in the beginning, to actually see that it works, and then have an easier time changing that. Again, this is really a theory that I think explains a bit of our biases, regardless if you want to subscribe or not to this way of thinking. The biases are still there, regardless, and they're still as valid, regardless if you agree or disagree with my theory about that. So that being said, I'm going to see you guys in the next lecture. In this lecture, we're going to be talking about misconceptions and ways to improve on handling your emotions. Now, let's start off with misconceptions. I'm pretty sure, and I can bet my life on it, that you've heard a bunch of times people saying, hey, it's fear and greed, the emotions that, kind of ruin people in trading. Everybody is too fearful or too greedy, and that's why they lose money in trading. And even, in most trading movies, you're going to hear that. Fear and greed, fear and greed. So, when does greed come in from, popular theories? Well, they'll tell you that if a stock's price is going up and you don't take your profits, okay, and then you end up just holding the stock and it going down and you're actually losing money because you were too greedy. You wanted to make too much money, right? And whenever you're losing money on a stock, okay, and you just get out of the stock, then the stock keeps going up, it goes up after, and you took your loss, you got too scared. You were fearful and you didn't make the money, right? Because you got out and you just lost money. So they tell you fear and greed are going to be the emotions that, make traders unsuccessful, okay? Because of those emotions. Now, I actually don't think that greed has any implication for traders who are not successful. I actually think that greed is not a bad emotion when it comes to being in business, because if you want to make more, you're going to work harder. You're going to find new strategies. You're going to do more things. It doesn't mean that you're going to make a bad decision when you're trading because you want to make more. That greed isn't going to affect you in that way. The only things that affect you in that way are things that you fear, right? So it's all fear. And again, I've had the biggest struggle with my emotion becoming, trying to become successful. And I struggled with those emotions for the longest period when I was starting out. And that's the only reason why I wasn't successful earlier, because of fear. So when you're actually in a position like this, why do you keep holding it? Not because you're greedy and you want to make more money. The actual reason is because you fear getting out of it here, right? You fear getting out of your position. And then after you get out of your position, the stock continues to go up, right? You're scared to get out here and then the stock increasing, right? You're scared to get out here and then the stock just keeps going up. Why? Because if this happens, you're going to feel a lot of regrets, a lot of blame, right? And you fear feeling those emotions. So in anticipation of future emotions, you keep holding it because you don't want to get out of it. And then it keeps going up. And then you have this regret and all these negative emotions. So you just keep holding it. So the reason why you keep holding it wasn't because you're greedy. It's just because you fear that it continues going up without you being in it. And when you're losing money, again, you're fearing holding it, and then it keep going down, and then you blaming yourself that you held it. So it's always fear that's gonna control you, right? And just look at anywhere in your life where you're struggling. It's always gonna be related to fear, fearing something, because you're running away from fear, and that makes you do the wrong decisions. When you're running towards something, and could be greed, could be whatever, that's not going to negatively impact you. What's going to negatively impact you is you running from something, which is usually fear, right? So different fears, but it's always going to be fear. So that's really one of the misconceptions that I feel. Now, ways to improve on your trading psychology and on your emotions. I feel that in the beginning, you should have a diary, right? And I still have one right now where I write notes in it about my trading and what I did right, what I did wrong, what I should change. I don't use it much. I might look at it once every month. But when I started off, I was using it every day. And as you get better, you start using it less and less, and then once a week, and then once every 2 weeks, then once a month. So you use it less and less. But in the beginning, it's very important for you to use it every day. And you're going to have to make daily reviews on them. So at the end of your trading day, when you look at what you did right and what you did wrong, did you do your technical analysis, your risk management, all this stuff, where you need to work on. But then I challenge you to actually look at how you handled your emotions during that day. Is there a type of emotion that affected you in a negative way that if you had that under control, you would have made more money or you would have lost money, right? So if you didn't take a loss because you felt it was going to come back, or you interpreted information in a different way, you changed your stop loss, well, that has to do with your emotions, right? So what emotion caused that? And how can you prevent that in the future, right? So you really want to treat your emotions and how you handle your emotion as just another facet of trading that you have to improve on, right? And now you want to look at, is there a specific bias that affects you? And if you find one at the end of your trading day, you put it on paper, you note it down, and you put on paper what you should do next time when that situation arises. So for example, if once you get into a position, you got into a long position and you think it's going up, but then there's a news that comes out that it's not too good, but you still think it's going up, right? So you were anchoring to the first piece of information. And then the stock drops and you lose money. So at the end of the day, you look at it and you tell yourself, okay, well, look, I anchored. So I'm going to note it down. I have this tendency. I'm going to put it on paper. And next time that I get into a position, I'm going to put it down that if a new information comes out, I'm going to give it, and it goes against my initial position, then I'm going to give it more weight. I'm going to give that news more weight and take out my position if it doesn't seem right. So then you leave that on a piece of paper and it stays in front of your screen like all your other rules. And, that way you don't forget about it and you improve on it. And when that's done and you're good at controlling that type of emotion or that bias, you move to the next one, right? And you move slowly but surely, you start removing biases and you start improving on how you handle your emotions. Okay? So that being said, that should cover this one. And that covers actually this chapter. And I'll see you in the next video, which I'll make just to conclude a bit about this course.